preparing. Todd, good morning, buddy. Good morning. We got Jerome Powell speaking this morning at 10:30. These are my plans for today. We got Powell speaking today at 10:30. Wonder what that's gonna bring. Special shout out to Big Ben, who had a great week last week. Let's keep in mind that Jerome Powell is speaking today at 10:30. But for now, my plans are a 640 strike with a 642 entry. Taking that to the 645 area, possibly a 648. And if we come on down, I'm looking for a 638 strike with a 636 entry. It's going to be in this area right here, taking on down to 634 and then a 632 4. Pretty much whatever the market says today, I don't believe it. If the market bounces, I'm looking to short the bounce. If the market dips, I'm looking to buy the dip. A lot of confusion going on right now. Market is still red for the year, red for the month. But she is starting off today with a nice bounce. Up $5 from Friday's close. Up over $10 from the low of pre-market. Very interesting day we're going to have today. And we got Jerome Powell speaking at 10:30, so definitely have to be on the lookout for that. Yes, sir. Thank you, buddy. Hope you had a great weekend, too. Hope everyone had a great weekend. Looking to get back into a little bit of normalcy, if that still means anything in the market. Anybody else have any plans that they would like to share? If so, feel free to put them in the chat. Let me know what you're thinking about, what you're looking at.
Not on the Strait of Hormuz.
That's not what I'm talking about. I'm talking about those nations that rely on it that does go through the Strait of Hormuz. Yes, I know it's not us.
They are out of luck, so to speak. You're right. I'm trying to, I don't want to conflate the two. I'm just saying that it could have been ours.
All right. All that said, should the market be up today? Does it, I mean, can you?
It's the tweet. It's the posting. The posting says, hey, listen, you guys who want to sell, wait to see what's going to happen. And then what happens is everyone just kind of sits here and gets their head bashed in at the end of the day. It's not been a great strategy to believe that the president has something going.
That said, Jim, Friday was, I guess, more dramatic than recent days. S&P's only been green 3 weeks of the 12 weeks so far this year. It's one of the worst weekly big starts to a year ever.
One of the 14 worst?
Yes, by days, yes.
Yes, and without a doubt, if I were the president, close to a bear market. Any major companies. If it doesn't matter, then I'm in a bear market, then I'll just say what I want. If it matters and I'm in a bear market, and I better start doing something that would make it so that it matters, or just say, you know what, I don't care about stocks. I want to own Iran when this is over. And then at least you'd kind of know what was happening. David, we come in here every day, and we are to believe that we're very close to peace. And meanwhile, we're bombing the heck out. Is that peace?
Yes. Peace is, what is it? What's Orwell? No, how does Orwell, yeah.
Oh,
war is peace?
Easter
Not war and peace. War is peace? Yeah. I don't know, Jim.
Right, well,
no.
I'm saying that it's not us. It's not up to us. We don't want to do that. We're not war strategists, okay? We're not going to talk about how many drones we have.
I know.
We're guys who say that I would buy, that there are a lot of stocks that are down too much.
They are. So should I be putting this to the side and say, look at Meta, the stock's down 20%.
Yes.
Look at Microsoft, the stock is down 26%.
We have an amazing,
let's have a debate about at least whether that's an opportunity right now.
We have a giant bifurcation between some stocks that are down between 20 and 28%, are very big, very big. And then we have other ones that are not down that much, but still could be down 12, down 15. The little guy, if you did the S&P, the rated, with the evenly rated.
Yes.
You would see
evenly
a lot of
weighted.
stocks.
Yes.
Yeah, evenly weighted.
Yeah.
But the problem is that the stocks that we often talk about are just getting, with the exception of Apple, really getting crushed.
Yeah, of the Mag 7, Apple's probably the least worst, down 8.
Least
to David's
worst.
point about Microsoft, down 26.
Yeah.
Melius today has some charts on Apple and whether or not a Siri revamp is going to create some energy.
Yeah, and look, I think that he believes in own it, don't trade it, Ben. Ben Rees writes.
The analyst there, yes.
Yeah, well, he writes topical stuff, okay?
No, he does. That's why we quote him almost every day. Because I think he has a rule that he's got to be out every day with something in print.
He is prolific.
And we say,
we bite.
What he got today? We bite.
I've never spoken to him. Is that what he does?
It's
Jesse
a
Swanson's letting us know down off the 200 moving average on the 1 hour chart. Before that, scalps up.
For Ben.
We actually do
Thank
have
you, Jesse.
Morgan Stanley reiterates an overweight on Meta, which, according to them, Jim, is the second most oversold since the IPO.
I spent the weekend working on Meta.
Meta's down again this morning.
And this notion of
$21.
tobacco moment, the plaintiffs spent a fortune on the case that they barely
Meta's down huge.
won.
Tesla's down huge.
Remember tobacco. Let's put it in perspective. Why did tobacco work as a suit? Because everybody who had lung cancer was able to say it was tobacco. This is a series of things. People are all different about what social media has done, or what psychology has done, or what different. There are many different spurs to what happens. It's not just social media. I think social media can run the table behind the next decision, which is Alameda School District. That's not till May or June, so you can buy the stock based on this. And the plaintiffs' bar has often had tremendous mind share among journalists. They'll give you everything you want. They're fabulous. They have a dossier. You
And Kosey's in the building. Shout out to you.
Points. You're right. But layering this risk.
My plan's coming into today.
Free cash flow at the company has disappeared as they spend.
Call above the 642 area.
For the AI future.
Looking to take that to 644. I'm sorry, 645, and then 648.
You even point to the fact that an advertising model is not great to slow down.
Right. If we have anything close to a recession.
638 strike. Looking to get in at 636.8, take it down to 634, 632.4.
Those were significant layoffs. I think that Meta's a buy, and I think Meta's a buy because you had this, of the $300 billion that was lost, I think most of it was because the plaintiffs bar put it out as a tobacco moment. And that way they're able to get plaintiffs. One of the things, if you're a plaintiff, it's a business, okay? The plaintiffs bar is a business, and what they got to do is they have to get they need customers. So you win one, and you hold up the flag and say, join us. This is what happened to J&J. And then J&J was doing class action, and J&J said, you know what? We are going to make it so everybody who wants money has to try individually. And that's bad for the plans market. It costs a lot of money.
It costs a lot of money to do that, right?
Look at J&J since they decided. See, if we could look at July of last year when they decided, you know what, we're done with this. We're done with this. You can see how that stock's done.
And you did, to your credit, you stayed away from it, and then you got positive on it.
Yes, because I realized that they were going to win.
That said, you've said to be buying Meta for a while now, so you've been saying to buy it all the way down.
I've been wrong on Meta. I thought that, like Carl mentioned, I thought that the layoffs and the idea that they would have a better ROI has not panned out yet. But I'm not giving up because I think the last leg was tobacco. So maybe I'm doubling down.
History would show that you buy Meta when it's down because ultimately they win.
But I've been wrong so far.
Zuckerberg wins.
I've been wrong so far, but I'm buying I'm not buying the tobacco plaintiff's case. I'm just
You're not a believer in the tobacco.
I'm not a believer.
Right.
Yeah, I wouldn't leave Meta if I tried, frankly. Who wrote that? Because it's not the monkeys.
Yes.
It wasn't the monkeys. Who was it? Wasn't like Paul Anka or something?
I think so.
Was it?
I think so. Okay,
wouldn't be
If I got that, that'd be amazing.
Take a look at the pre-market.
You know, introduced me to Paul Anka.
Donald Trump. Donald Trump.
Great news.
Great song, great money manager, great songwriter, great money manager.
And you were at was when you were at the Polo.
Oh my God.
Yeah.
There actually are some upgrades today of a CrowdStrike, Expedia, Carnival. We'll get to them in a minute. Got a few gainers pre-market. There's a look at SanDisk. We'll talk about where memory stands at the moment. As got a busy few days of data, not today, but we'll get ADP claims and, of course, the jobs number on Friday. We'll get Cramer's Mad Dash countdown to the opening bell. And then later this morning, an exclusive with Fed Governor Myron. We are back in a moment.
Anybody have any thoughts or plans for today that they would like to share? Feel free to put them in the chat. Let me know what you're thinking. We got Jerome Powell speaking at 10:30 today. Jerome Powell is speaking at 10:30.
Welcome back. A little more than 7 minutes before we get started with trading here on a Monday at post 9 of the New York Stock Exchange. The mad dash is Colgate. Why?
Yeah, Deutsche Bank put out a piece today. It is a devastating piece. We're talking about a whole slew. I mean, more than 20 CPG companies that they say they have to cut the price.
Read in Kosey's post. He said, my last week, then I'm gone for 3 months. Once he gets acclimated to his new shift, then he might try some end-of-day trading. Oh, man, we definitely going to miss you, teammate. We definitely going to miss you. It has truly been a pleasure. Shout out to Nkosi. And we will be right here looking for you, buddy. Let us know when you're ready to come back for some of that end-of-day trading, man. We mess around and join you, and we'll join you on that, buddy, just so we can trade again. Big shout out to Nkosi, and thank you for being a dynamic teammate.
I just say, David, well, he's on his way out, isn't he? Yeah. I love the guy, but what it says is that this is a group. Every time you buy it, whether it be General Mills, whether it be Kimberly, it just doesn't work. And that's because all numbers are too high.
Except for but Colgate is an exception. I'm sorry.
Well, they still like Monster. They like Church and Dwight.
Okay.
But when I read the thing, the only one I really want to go buy is I want to buy Colgate because they think that Colgate has some real upside. 90 to 98, hold to buy. They took Celsius hold to buy. The problem with Celsius is that Costco's going against it. And I find that when Costco goes into Kirkland goes against you, whether it be Tito's, whether it be Scott, whether it be toilet paper, you're done.
Right.
You're done because Costco's too powerful. But this is the one I would buy.
All right.
I think it is. I think it can go higher.
We got a lot of other stocks to watch this morning when we get started with an opening bell that's about 5 minutes from now. Don't forget you can catch us anytime and anywhere by listening to and following the Squawk on the Street Opening Bell podcast.
Watching shares of NVIDIA today, set to open in the green. Still struggling, though, on the year. Underperforming the S&P. In fact, Goldman over the weekend wrote the stock now trades at par or to a slight discount to the S&P on a forward PE for the first time in 10 years, adding that NVIDIA alone still expected to contribute 21% of the indice's growth this year, Jim.
Well, I mean, 10 years ago was when I first decided to go hard on it, and I think it was because I said, look, this thing's selling like maybe 13 times earnings, and he would not dispute that because he didn't understand why the market didn't recognize what was going on, but that was because they didn't know that he was more than just a game company. Do I think it's a buy? Well, I've been consistent, David, just saying, listen, on it, don't trade. Obviously, the last 50 points have been brutal, but sometimes you have to have a brutal staying power for NVIDIA. I'm advocating staying power.
I know you are. As the multiple continues to drop.
Contract.
I do wonder, though, this question of, well, who is the marginal buyer that's going to send it higher?
I think it's CoreWeave.
You think CoreWeave's going to buy shares?
I think no. CoreWeave's going to bet on stock. They're going to buy the chips.
But they're sold out. That's not an issue, is it?
Well, I mean, some people think, you know what? They're not sold out. I agree that they're sold out. I think there's a lot of people who feel, wait a second, the guys who are the hyperscalers who want them are very challenged.
Again, we come back to the bigger issue, the bigger question, which is there's no hyperscaler that has pulled back on its plans to spend more and more money. None. Zero.
So therefore, they have no cash flow.
They have no cash flow. It all goes to this company.
Look, what am I going to say? You can't have it without it. I have ARM on today, and I'm going to talk about how ARM has got a seat that will help them. But it costs a lot of money to build these places, and not a lot of money places don't know how to do it. There's constantly about Oracle today. You need to have Oracle be building, but I do think there is no slowdown. No one cares about the multiple right now. I think once they see it, they will. But we're in a very bad time for anything involving hyperscalers.
There's a look at the open and the CNBC Real-Time Exchange. At the big board, it's women in financial markets, advancing women in the financial industry. At the NASDAQ, it's United and Make-A-Wish, granting life-changing wishes to children with critical illnesses. Pretty decent breadth here at the open, Jim. But you're right on Oracle. 5-year CDS, very much in focus today. On Friday, we got close to those levels we saw going into the financial crisis.
Yeah, and I come back and I say, well, I think Oracle is better at what it does. It builds, and maybe there isn't as much risk. I'm just there. I am echoing Wall Street, and I know Wall Street wants Bernstein wants. Look, Bernstein is not owned by Oracle. They don't want any investment banking. They're using a $310 price tag. So they say the story is better than they think. I prefer others, but I will say, David, once again, that the world is short compute, the world is short memory, and that is driving a lot of these companies. Witness what happened with OpenAI and Sora.
Right, well, that was a compute issue, and you're right. In terms of memory, there is a shortage. It seemingly will continue for quite some period of time, given in previous cycles when they built memory, then they got burned, and so there's not as much. You pointed this out many times. As you take a look at Oracle's 5-year CDS, by the way, we were the first to point that particular instrument out many, many months ago, and when we started doing so, the stock started to change direction in a significant way. Given, of course, free cash flows disappeared at the companies, it has spending plans on into the future of great consequence, and the belief that if you build it, they will be there to use it. They being the likes of all of any number of their customers, including OpenAI being a key. You mentioned Sora and OpenAI's decision to mothball that, if you want to call it.
Rather serious decision.
Right, the video generation tool that we had Bob Iger and Sam Altman join us not that long ago talking about a partnership that they had in which Disney was going to invest as much as $1 billion in the company and license or allow its characters to be used by those who are using Sora. There they were talking to us. That was back on December 11th. You see that. No longer. Sora not happening, and it goes back to compute.
Yeah.
It's a finite resource right now. The usage of compute was enormous for Sora, and it didn't it cost them money every time
Right.
anybody went on to create their whatever it was, Carl. And so, given all of the different efforts they have underway at OpenAI and the need for compute they have, broadly speaking, I'm not sure what we're looking at there.
It's a cat riding a figure
this.
skater.
There you
Oh,
go.
okay, right.
National security drone. What is that?
So these are the various things you could create. Amazing. But at OpenAI, given the war they're in with Anthropic especially, and the need and the finite need for compute that they have, or the need for compute they have that is enormous, Sam said no more.
Right. Now, I did a Sarah Fryer on this, CFO of OpenAI. I think that they are really, they're trying to be enterprise, maybe 50-50 enterprise. That doesn't fit with enterprise.
No.
Enterprises are not looking at that.
That's a consumer tool, Sora.
Right, so you don't want the consumer portion of your business, other than ChatGPT, to really explode.
Well,
ChatGPT
and whatever
did very well.
device they may have in with the Johnny Ives designing, right? That's
Well, we're waiting. She said that
Yeah.
Johnny Ives is going to surprise us. It's going to happen
I
soon.
hope he surprises us because they paid him so much money. Oh my. Or at least they, right, for his company. I mean, I'd have to go back and use OpenAI to find the exact deal terms.
Do you think that
But
the
I think it was
Meta-
as much as $6 billion.
Do you
It was
think
an
the
enormous
Meta
amount.
option program, some of those guys are going to take that? The one where if they get to a certain level, they get trillion, they make a fortune?
I don't know.
I don't know, because you see, you only need to get rich once. Many of them are already fortunate.
Many of them are already quite wealthy, but Meta has gone on a surge of picking people off from companies such as OpenAI. And in fact, in that journal story we referenced about Sora, one of the creators of Sora was at least considering jumping to Meta, but then OpenAI apparently raised his pay
Well, I might
as
have
well. Listen, guys,
What do you have?
I can't wait until OpenAI and Anthropic are both public companies, and so when we sit there and discuss them, we can see how their stocks are reacting. And that, I don't want to overlook that. I mean, we are
No.
moving into a period, and we'll see what
and
happens,
SpaceX.
where a year from now, SpaceX, OpenAI, and Anthropic, not to mention the likes of some other companies, maybe a Databricks, also of Darling,
Databricks, yeah, was
could
that
be
at the
all
conference?
public companies.
It's going to be very exciting for us. It will be.
Say again?
It'll be exciting for us.
Totally.
We intend to be in charge.
Because we
of the
have to
cover-
talk about OpenAI and Anthropic every day because they are amongst the most important companies in the world right now. And yet, it'll be nice when we can actually see how investors are treating them
I know.
on a second-by-second basis.
True. Now, there is something happening today that is actually truly amazing.
Sorry, with what?
Something happening today is truly amazing
Oh,
when it goes.
okay.
Microsoft is up $3.
Microsoft's up, yeah.
Now, this itself is an extraordinary thing, an extraordinary feat. And the question is, how long can it last? I feel like going to Kalshi and just posing. When will it go?
you can make
below?
make
Right.
your bet. Like with Bitcoin,
I'd like
what's it
to-
going to be in 5 minutes?
I've always wanted at this age to, kind of fiddle my life away, playing games. And there we go.
Do you have any recollection in a period during your incredibly long career when Microsoft has been down 25% in this short amount of time, if at all?
I don't even think it was down this much when Joel Klein went after it in 2011. Justice Department.
Right.
Well,
Just
certainly Meta is below the 200-day by the widest margin in about 4 years.
That one I think can change, but you need to see Mark come out. They're not hiding, but they have a message which is dominance, and all we hear about is it played through Entergy. We hear about it played through Lanier from the tobacco side. We hear about it played by their options strategy. But the one thing we don't have is their CEO. I mean, one of the things I liked about OpenAI was Sarah Fryer comes on the show, talks about everything. It was refreshing.
Totally.
Yeah, refreshing.
We should hear from her as often as possible.
Right. Well, Dario likes to talk. He's a good talker.
Dario Amodei, the CEO of Anthropic, talks all the time, as
All the
does
time.
Jensen Huang,
Well-
your friend, who I have said literally will communicate with anybody at any time. Probably the #1 most important guy, and it's interesting to see that he makes himself so available.
I think that's a cheap shot.
Why is that a cheap shot?
I just probably say it.
Where's Jensen talking today? Honestly, this week, where's he going to be?
I don't know.
Okay, will he not be talking somewhere?
Look, he has a lot of. He gets up at 4. He goes
I'm
through
not saying
everything.
there's anything wrong with it. I prefer it rather than not.
Well, you just knocked the stock down. You killed Nvidia.
I had nothing to do with anything that's going on in NVIDIA. You are literally a walking NVIDIA. I know the dog was named NVIDIA years ago. Now I'm just going to call you NVIDIA.
And I don't mind that. I'd like to be
You
the
would
best.
answer to NVIDIA.
I am the best
Okay.
performing.
We'll give that a
one.
shot.
What's your middle name? You got a middle name? You don't want to share it?
The middle name.
Chevron? No?
No?
No, I don't really have. Not yet.
You're NVIDIA Meta
I used to-
Kramer? What
I
are
used
you?
to be Mr. Softy. I'm no longer Mr. Softy. I'll tell you that much. Whoa.
You mentioned Bernstein, Jim. They did come out today in defense of some crypto stocks, and we do have Bitcoin in the green today. 60% discounts from the 25 highs, they argue. Robinhood's green, Coinbase among the leaders.
You know, I was working on the Robinhood decline and fall, and it's just, it turned out to be just crypto. Robinhood was crypto. There was not more to it. I mean, I know they got some really interesting IRA thing and whatever, but you know,
He's got his venture fund now. What do you mean it was all crypto? What do
Well, I'm
you mean
saying
when
that
you say that?
if you overlay it, they tend to look the same.
That's interesting.
You know, but I mean, Vlad talks. He'll go to a JP Morgan conference. He'll talk.
Yes, he will. Prediction markets are important there as well in terms of getting access to them
But we
on
don't
both
talk about
Robinhood
it.
and obviously Kalshi.
You're right. I mean, I'm looking at 5-year Bitcoin to hood. They track.
They're track. I mean, it turns out that we thought it was tracking your IRA. That's Morgan Stanley. I like Morgan Stanley here.
You like
get
Morgan
enough love.
Stanley as a stock or
I
just
like
as
Ted
a?
Pick. I think he's doing a good job.
You like Ted Pick? Big Rangers fan. Tough year to
Is
be a
that true?
Rangers fan.
Rangers fan?
Yeah, tough year to be a Rangers fan.
I thought he was a UConn basketball fan.
Yeah. That was that game incredible.
That was bananas.
Incredible.
I'm glad we talked about something.
And I guess yeah.
And
there it is. Oh my God.
The 10-second miracle.
Why did you throw that? But
Havlicek stole the ball.
amazing.
Wow.
Yeah, up until last night, number 1 seeds that were up by 15 at the half were undefeated. Now it's 134 to 1.
Wow.
Wow,
Well, you know,
that
that's
kid, he's
probably-
a freshman. Amazing.
Well,
all right, guys.
There's this momentum down 22.
It's an M&A Monday because of one deal, and it's a really interesting deal, even though it
Oh,
involves
yeah.
one public company buying a private company. And it's a company that Jim knows about well because
Very
of his
well.
experience in the restaurant industry. But let me just give you some of the quick details here. Cisco, that's with an S, the restaurant distribution giant, is buying a company called Jetro Restaurant Depot for $29 billion, about $25 billion, I think, in equity. The rest, the $4 billion or so in debt. It's a company that has $2.1 billion in EBITDA, $16 billion in revenue. That is the private company, Jetro. And by the way, based in my hometown of home borough of Queens, I would not have known there was a company worth $29 billion in Queens. Now, we almost had a company worth over $1 trillion there. If not for the likes of AOC, it would have been called Amazon that was going to be partially headquartered there. That didn't happen.
Mr. AOC.
But this is an interesting deal. A company that has been very quietly growing for a very long period of time. 20 plus years ago, it was doing about $120 million in EBITDA. Now, as I said, $2.1 billion in EBITDA. 70% of the considerations in cash, the remainder in stock. The family that founded this company owns about 70-odd% of it as well. And 20% of it is owned by the private equity firm of Leonard Green, interesting to note, that has been there for 22 years with this investment. So people can talk about the difficulty in getting exits for private equity. That is a real thing, and it's a real issue because, of course, it's hard to raise new money when you can't return money from previous funds. That said, you want to put it down in terms of on a blueprint, this is certainly the way you'd like it to go. A very long hold period, but an enormous return. By the way, the company's been paying lately, I'm told, $1 billion a year worth of dividends as well. 14 times, over 14 times EBITDA is what they're getting here. That's a nice multiple. And Jim, I want you to hear about your experience with the company, but this has been an asset that has been coveted by many companies, I am told. Not just Cisco, which has wanted to buy it for a long time, but others as well, in that it has just been seen as a jewel. But tell me about the
First of all,
business
it's
itself.
a brilliant acquisition, and Kevin Hercombe was on early on, and the fact that the stock's down, people don't understand what the companies do. Because candidly, in the old antitrust regime, with Linacon, this would just be denied. And the reason why is because these are two suppliers to restaurants, small to medium size in particular, for Jethro. You go to Jethro when you're in the gym. It's like, oh my God, I'm out of this. I mean, I used to go from my inn. Oh my God, I'm out of it. I'm out of this. Very quickly, you go to Jethro.
It's called cash and carry, so you literally go in there as a restaurant owner.
Well, you have to have a card. I mean, I'm not some.
And you load up with what? Like, what are you getting?
Okay, I have gone there to get beef. Now, when you go to here to get beef or you get seafood, I got to tell you, it's like, Mackage, M-A-C-K-A-G.
Yeah,
you need those jackets. I mean, it's like freezing. I went in there with a T-shirt. I said, you got to make it warm. This place is the place you go when you're in a jam, or when you're also a very small proprietor and you can't afford Cisco to deliver. Cisco, and when my restaurants got more upscale, Cisco was our delivery. I went to Jethro when I was really in a jam. You go to Jethro because their prices are amazing. You go to Cisco because you know what the hell you're doing and they bring your food every week. This is fantastic. To have the two is amazing. To have the two, that you own both parts of this restaurant business.
Right.
I mean, yes, you can use Boldor in New York. Boldor's really expensive. But we use Cisco. They're cheap. When you Jethro for a jam, they're the cheapest I've ever seen. And you can just get everything at Jethro. It is so great. But Cisco if you're a well-run outfit, and Jethro if you're in a gym, and Costco if you want to. That's the only place you can go.
So yeah,
This
a
is
very
amazing.
large deal.
It's a one-of-a-kind
Cisco
property.
stock is getting hit. There's going to be substantial ownership on the part of those who own Jethro right now in Cisco itself, even though much of the consideration is in cash, because Cisco's not that much larger in terms of its overall market value for what it's paying
But
here.
they're talking about year four accretive.
Yeah, they're talking about year four accretive. $21 billion of new debt and hybrid debt is going to be taken on by Cisco to help pay for this
I
acquisition.
just can't believe what a lucky company Cisco is, because everyone knows that Jethro is the only game in town for small, medium size.
Jethro started
What
in,
a
in this
business.
metro area. It's about 50 years old. Its founder, I believe, family-owned, and is 94 years old.
Yeah.
And so part of it is generational.
I went to one in
guess the
Philadelphia,
children-
across the street I was really in the jam for the restaurant. Across the street from the Link in Philadelphia, and there was a big hole in the roof, and it was pouring. I said, guys, what are you doing? I said, what, you're not happy? Go somewhere else. There's no other place to go. I was like, sitting there, I needed a raincoat, I needed an umbrella, but I would never step away from Jethro. They had a level of beef. Bring the customers. What? How many places can have a roof leaking, it's pouring rain, and you just don't care? What a business.
There has been some examination, Jim, of what's happened to restaurants overall, at least as far as share price goes. CMG, not a healthy looking chart year to date. I mean, Texas Roadhouse has kind of rolled over.
I had to blow out of Texas Roadhouse after a big spike up because the beef herd is 75-year low, and there's no relief in sight. None.
Right.
No relief in sight unless you let Brazil put in all the cattle. Send your meat. Look,
And that's kind of, you could trace it back to what the crop will do this year and trace that back to what fertilizer, whether or not it will be available. They've already bought it.
It's just a very, it's a vicious cycle down. Plus, I mean, like I had a cow, right? I had no idea it was even like pregnant. It's like hard to sit. You got to really know what you're doing. I didn't. But then suddenly, 8 months later, bingo! And I'm like, how'd that happen? The answer is that, well, that they have a long gestation period and they have human gestation period. They don't, it's not like they're, the mayfly.
That's fascinating
Yeah,
information.
that's true.
Thank you for
It is.
sharing that.
Yeah.
Yeah.
And
Cows make cows.
I named it Fine
Who knew?
Touch after another cow that I've lost.
Okay, Jim. Thanks. Meanwhile, I thought you kept telling us beef prices had bottomed. Had topped, and things were gonna start to
We
turn.
had 3 months in a row where beef prices had leveled, and I thought it was going to be the time. And then the Gulf upset everything. It's fertilizer. People don't understand fertilizer's from there.
Yes. I think people are everybody's getting a lesson in just how interconnected things still are.
You missed the Chem 7. I came up with a definitive list with my friend Frank Mitch about the chemical stocks. They're the ones to watch. Dow's one of the Chem 7, LyondellBasell, Chemours.
CF.
BBCs are killing it.
Yeah. I like that
Owen,
little
Chem
hospital
7.
jargon.
Look at these. Look at the Chem 7. This is just today. Can we have like a 1 month chart of the Chem 7 or the price? Look at this.
Wow.
Even Tronics. Look at the Chem 7. Now, put that up against, say, Meta and Microsoft. You think Microsoft's as good as polyethylene, you're dead wrong. Do you think that Satya knows that polyethylene's killing him?
I don't know. I think he's got a lot on his mind right now. Probably not about polyethylene.
Really?
Yeah.
David knows.
Yeah.
We went to hear him at the David Morgan conference.
Meantime, we're trying to hold these opening bids. Dow's up a couple hundred. VIX still above 30. As for bonds, we mentioned some of the relief we've seen, at least in the front end, as the 2-year gets back below 385. 10-year 435. 30-year still within 10 bips of a 5 handle. Stay with us.
Big Ben waiting to see if this 637 area holds as resistance. It did on the 2-minute chart. We broke it, came back, retested it on the 2-minute chart. Waiting to see what it does here on the 5-minute chart. Definitely like this area. Also want to keep in mind Powell is speaking today at 10:30. Powell is speaking today. I'm probably take it easy till after Powell speaks. Tell you whatever market does today, I don't believe it.
Today, like Colgate, like Expedia, Crowd strikes another one as Wolf goes to buy.
A little bit of mixed right now. The market is mixed.
Mythos might actually drive spending.
We were laughing about this last week, George.
Meta's up now. Everything is green except Apple. So let's keep that in mind, especially with Powell getting ready to speak at 10:30. So protect yourself very closely with that put, Ben. We got the right area. Just waiting to see if it's going to be the right time. Looking for that break and retest. We're starting to get the retest now, potentially. Back up to the 637.5 area. And then we'll love to catch it on the way back down. per se, Your Honor. Which is an area that I wanted to get in. 636, 8 area. I'm going to drop that down just a little bit. 636 area. A 638 put is still holding. We might not even get that retest. It might keep going. All right, good. He said he's safe. Sir Night is in the building. That's the right mindset. Don't believe nothing they talking about. Powell is the most honest joker they got. For sure. 10 o'clock hour coming up right now. Again, leading towards the larger time frames. Monday morning, no need to rush anything. Plenty of time to make a nice, beautiful trade. Let's see what the market wants to do. And then we'll go from there. Nice scalp, Ben. Nice scalp.
Stock is down. If you get an opportunity to buy it. Renee is very good. This was something he pulled off. AMD and Intel did not expect it. So.
Jim, we'll see you tonight. Mad Money,
great
of course,
show, guys.
6 p.m.
Welcome
Eastern. When we return, the Fed chair in a moderated discussion at Harvard. We're going to bring that to you live. First, though, an exclusive with Fed Governor Myron. Don't go anywhere.
Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are all back at Post 9 of the New York Stock Exchange. Coming up this hour, Federal Reserve Governor Stephen Byron is with us as the Fed's path gets cloudier here amid surging energy prices tied to the war. Plus, Fed Chair Jerome Powell expected to speak and take questions at Harvard this morning. We're going to take you there live for those remarks. And Council on Foreign Relations President Emeritus Richard Haas joins us with the latest on Iran as he warns that a, quote, stable Middle East is a long shot at this point. We'll kick it off, though, with the outlook. Rising energy prices, mounting stagflation concerns. They have some believing the Fed's next move could actually be a rate hike before the end of the year. Our next guest has been dissenting in favor of bigger cuts at recent meetings. Fed Governor Stephen Byron joins us now for a CNBC exclusive. Welcome. Good to have you.
Good morning. Thanks for having me back.
Has your view changed at all as a result of the rising oil prices and diesel prices and fertilizer prices about the outlook for inflation?
Yeah, so traditionally the Federal Reserve looks through an oil price shock. Now the reason why we do that is because oil price shocks tend to boost the price level immediately. They flow through into prices very quickly. Gas prices move higher, but monetary policy only hits the economy with lags. It doesn't, if you change monetary policy today, it doesn't affect economic growth, it doesn't affect unemployment or inflation for 12 to 18 months from now. Right? So if the oil price boosts the price level today through the gasoline price and other things, but not 12 to 18 months from now, monetary policy simply cannot affect that. Now, the way that that wouldn't work, that this traditional logic the Federal Reserve has always observed, the way that this logic would not work is in one of two scenarios. One is you get a price-wage spiral, where wages start moving higher and then prices start moving higher too. There's not really any evidence of that thus far at all. And with the labor market on a gradual cooling trend for the last 3 years, that seems extremely unlikely. The other way that you would get the oil price shock boosting inflation 12 to 18 months out is if inflation expectations started to get affected. And when you look at the inflation expectations, you don't really see that. So I like to look at CPI swaps. CPI swaps for the next year moved higher because prices move higher immediately, exactly as you said. When you look at forward rates, when you look at inflation expectations, 1 year forward, 1 year, 2 years forward, 1 year inflation, 3 years forward, they haven't budged. And when you look at medium to long-term inflation expectations, like 5 years forward, they've actually been coming down since this entire thing started. So in order to get an inflation shock from oil that the Federal Reserve can affect, it needs to affect inflation beyond a 1 year horizon, and there's thus far no evidence.
All of that is true, but you know, there was evidence, first of all, that the Fed's inflation target was higher. I mean, that inflation was higher than the Fed's target going into this, right? And that what this will do is, even if it's in the short term, will have an impact on headline CPI, on PCE, you know, the longer this lasts. And it's now, what, we're 5 weeks in, and there are concerns that it will have a bigger impact on underlying inflation, even if you're not seeing it necessarily in those expectations or wages.
Yeah, so if I saw one of those two things happen, if I saw a wage price spiral or I saw evidence that inflation expectations were starting to pick up, then I would get worried about it. But as I said, there's no evidence of it thus far. And you can move the monetary policy rate all you want, you know, today, tomorrow, but it's not going to affect inflation the next couple of months, right? It can only affect inflation.
Way to stay safe, team. Way to stay safe and not chase this down. I believe it still has the possibility to go down, but I want to see it break this 637.5 area and then come back and retest it, reassuring that this is going to be resistance and not just break through it. And then let's look to short it potentially on the way back down.
As a result of this, and maybe they'll tell you otherwise. I can only speak for myself. But what I just outlined is traditional Federal Reserve logic and way of treating
the market has completely moved as a result of this war. It's taken out all the price cuts and now started to, I mean, we're not fully there, but increase odds of a hike.
Absolutely. Look, we're in the middle of a war, right? And if there's ever a time when markets are going to be volatile, it's in the middle of a war. So in a time like this, I'm disinclined to sort of disinclined to read too much into that. But you know, markets will do what markets do.
Would you argue it's made your ability to persuade would-be fellow dissenters, made it tougher?
I don't think that the Iran war has really done that. But look, I think that the labor market was on a gradual cooling trend for 3 years running into this. I don't think that there's anything that I've seen to convince me that that trend has changed, and I doubt that others will come away from what's happening in the Iran war and have a different view than that. Right? If you think about it, higher oil prices, higher gas prices, they suck money out of expenditures that consumers would be making on other products, and so it leads to lower overall aggregate demand. And in a time when the labor market was running in the wrong direction from the Fed's mandate to begin with, that makes me a little bit more concerned about downsides to the labor market. And it is the type of thing that I think the Federal Reserve can accommodate.
So you're more concerned about weaker growth and higher unemployment than inflation, clearly. And it feels like that's the reverse of most of the other folks at the Fed. Fair?
Well, I mean, I can't speak for the others. I can only speak for myself. But what's happened?
That was Powell's message at the last meeting, really, is inflationary risks are rising, unemployment is kind of stable.
What's happened has made me more concerned about that. And as I said before, I just gave you what would make me more concerned about inflation. It's seeing inflation expectations pick up more than a year out. It's seeing wages pick up in a way that was feeding a wage price spiral and not driven by productivity gains. Right? Wage growth has been coming down even with high productivity growth. Right? That tells you that the Fed is holding back labor demand in a way that I'm not sure that I don't think is appropriate.
So how much easier should the Fed be at this point?
Well, I think that at the moment, I think that we could be about a point easier, gradually done over the course of a year.
So you'd like to see now 25 basis point cuts?
That's what I voted for
meetings.
the last two meetings, 25 basis point cuts.
Yeah, it doesn't feel like that doesn't feel like that's not even consensus. But do you have anybody at the Fed agreeing with you on that?
Well, look, I'm clearly dissenting I'm clearly dissenting at each meeting. That puts me out of consensus, but that doesn't stop me from saying what I think. I think the labor market has been on a gradual cooling trend for the last few years. I think the Federal Reserve should be intervening to arrest that gradual cooling trend, and I think inflation is heading back to target, a year to a year and a half from now. So that's where my policy outlook comes from. Others can speak for themselves.
When I hear you talk about the labor market, I can't help but think about longer term, what I would argue is the largest single issue for it, which is AI. And I'm just curious as to how you're thinking about it. Obviously, we've got a lot of near-term concerns that we're talking about here, but the big unanswered question that nobody seems to know the true answer to is there going to be a significant dislocation of jobs that will then ultimately, we will see replacement jobs that we can't think of, or is there going to be a seminal change in the way work is done with an enormous amount of efficiency and productivity added, but hardly any jobs, in fact, many going away? Do you think about it? Do your colleagues think about it? Because in the next 3 years, we're going to be dealing with this.
Yeah, we spent a lot of time thinking and talking about that. I'm not convinced that anybody really has a very strong handle on those questions. And when somebody comes to me with a very strong handle on those questions, I just, I'm not really persuaded. I think there's too much uncertainty.
Yep.
What I will tell you is that throughout all of human history, technology destroys jobs and it creates new jobs too. And I have not yet been convinced that AI is somehow different. Right? I think that AI will create lots of new job categories that we just haven't imagined yet because people haven't figured them out yet. But I do think that will happen. Now, in the short term, so that's sort of a long run view, right? In the short term, that doesn't necessarily happen right away. And so you can have dislocation where jobs get destroyed before new jobs get created. That is textbook, sort of a textbook case of sectoral reallocation that a central bank would accommodate. Central banks should not prevent those new job categories from being created. That's very basic macroeconomic intro macroeconomics, right? The reason for a central bank cutting rates, sectoral reallocation is classic. So AI, I don't know exactly what the long-term outlook looks like. I have a really hard time quantifying it.
You're not alone, by the way. You can talk to any expert you want with the deepest experience, and nobody knows. They really don't. How can they?
Yeah, they don't. But one other thing we know is that, look, higher oil prices are a negative supply shock. AI is a positive supply shock. It pushes the price of making stuff down. You can make more goods and services with the similar number of inputs that you had in the past. So it is true that we have cross-cutting supply shocks, cross-cutting productivity shocks with cross-cutting effects on inflation. The question is which is temporary and which is persistent. Does oil boost prices just for the short term, or does it boost prices a year, 2, 3 years out? Does AI cut prices in the short term, or does it cut prices 1, 2, 3 years out? Monetary policy needs to be made with an eye to the future. It needs to be forward-looking, not based on the last 12 months of data, but based on what your expectations are for the next 12 months of data.
I mean, there is a growing debate at the Fed, right, on whether you guys should be focusing and factoring in the productivity boom that is happening as a result of AI. Where do you stand on that?
Well, as I said a moment ago, I have a hard time quantifying AI. There's another productivity boom that I have an easier time quantifying because there is a large and well-established economic literature on it, which is the regulatory side of things. Regulations similarly prevent people from organizing economic activity as they want to, and when you cut those regulations, they can produce more with less. I've quantified that as dragging on inflation by about 0.5 percentage point per year over the next few years. There was a piece of Federal Reserve staff research that came out a few weeks ago that if you apply their model to the current regulatory shock that they measure using an entirely different literature, entirely different estimation methods, they get to a 0.3% drag per year for the next few years. So recurring persistent drags every year. That's a positive supply shock that pushes down price pressures by pushing out the supply curve, right? So it is true that there's lots going on the supply side. There's lots going on with productivity, and I've tried to pay attention to a lot of it, and I think we can all do a better job of that.
Do you think if the midterms go a certain way that the deregulatory narrative flips?
Well, I think a lot of that stuff is implemented by the administrative branch, by the executive branch. So I don't know that the midterms really play into the regulatory agenda that much. But I don't know. That's a question probably better directed to somebody who's working on the. We work on regulations on the banking side at the Fed, right? And that's not going to be affected by the way the midterms go.
You just gave a big speech on the Fed balance sheet a few days ago, and that is a hot topic because a lot of people are eyeing Kevin Warsh. If he does get confirmed, he has talked about lowering interest rates and shrinking the balance sheet. So what is your thesis here? I know you want to do that too.
Yeah, look, I mean, I agree with Chairman Designate Warsh. I think he's completely correct. I think the Fed's balance sheet is too big. I would like to shrink it. With the current institutional framework, the current regulatory environment, with Dodd-Frank, with Basel, with the current regs as written, implementation methods as enforced, we can't shrink the balance sheet further from here. That's why I voted in December with everyone else in the committee to resume the reserve management purchases, actually expanding the balance sheet because the system needs more reserves. So the approach that I laid forth in that paper with three colleagues from the Federal Reserve staff is ways to reduce the demand for reserves so that the Federal Reserve can go back to shrinking its balance sheet. Because a big balance sheet has lots of unfortunate consequences for the economy that we sort of went through in that paper. It interferes with market intermediation. The Fed funds market has all but disappeared. It blurs the line between monetary and fiscal policy because the Fed is getting involved in decisions over the distribution of maturity of government debt.
Yeah.
It interferes with credit allocation because we own all these mortgages. We're preferentially injecting credit into one specific sector of the economy.
Some people think, though, that ship has sailed, like it's too late. And when you talk about balance sheet shrinkage, you're talking about tightening policy, which is something you very much do not want to do. You think the Fed is too tight already.
Yeah, so if you do reduce the balance sheet, it is a policy tightening. However, it can be offset with lower short-term interest rates. So if balance sheet policy ends up moving in a tighter direction, you can offset that by lowering the short interest rate to offset that. So the combined effect on the economy is neutral. Now, the time that you can't do that is if you're ever at the zero lower bound. Then you can't lower interest rates any further. But we're far from that situation.
You do point out it's important to go slow, like paint drying?
I wouldn't use that expression, but I do.
But that chair did.
Because even paint drying can end up being interesting. I do think it's important to go slowly. I do think if you're going to reduce your balance sheet, you want to do so in a way that's not going to overload the market with more securities than it can absorb at a single time. So you do want to go slowly to let the market absorb what you're doing.
Speaking of the bond market, have you been following these? We've had a few bad auctions in the last week. I mean, bad, weaker than expected demand, raising
That's
some
a good
concerns
question.
and
Jesse
higher
said,
yields
who's
pretty
in
much across the
trouble?
board. Is this
Well,
cause
I'm
for
finally
concern?
getting ready to
before,
see
we're
that
in the middle of a
retest that I have wanted to see back to this area to see if we hold up at the 637.5 area, if we can hold that into resistance and not just blow right through it. If this does hold as resistance, then I'm definitely interested in the short on the way back down as we get closer to Jerome Powell speaking. So you know how he does. So we'll just have to wait and see what happens, team.
Wrong?
Well, I think one thing that we've seen is, in my view, an unwanted tightening of financial conditions. Financial conditions have tightened across the board, whether you're thinking about stocks, interest rates, credit. dollar. Oil, is construed by some as a financial condition. And what's happening in private credit too is something that's bothered me for a while. And one thing that I've been saying for months is that I think that the private credit not being introduced in financial conditions indices, because we don't necessarily get useful marks on a high frequency basis, has masked weakness in financial conditions that therefore that had real economy consequences. Private credit was responsible for a lot of credit growth, economically significant credit growth in the last half decade. And now with those conditions tightening, that source of credit growth has slowed down. And so financial conditions up until the Iran war, I think, were giving a bit of a misleading portrayal of how easy things were.
Do you think what's happening in private credit presents an economic risk right now?
Well, thus far, no. If it gets to be more significant than it has been thus far, yes. And if it intersects with the other financial conditions tightening that we just described, yeah. I mean, financial conditions tightening, can have a negative knock-on effect on growth, and that's the type of thing that you would expect to see drag on the economy in the future.
When you say get worse, you're talking about default rates or something else?
Either one, either default rates picking up or just credit becoming less easily available, so that people who want to undertake economic activities, who want to start a business, invest in expanding their existing business, they have a harder time accessing the credit to do so.
Did you guys talk about this issue at the last Fed meeting, the private credit issue?
It's something that a number of people have talked about for a while. My sense is that it's not right now at a level where that is something that would make me change my views about how the overall system is working. But it is a risk that I'm aware of, and that I think merits to use the parlance of our times, monitoring.
Yeah. I mean, I guess bottom line for you, it sounds like you're still advocating very strongly for easier policy, lower interest rates. On unemployment, so does that mean that you do think that there is weakness, cyclical weakness here, and it's not just full employment and lower supply because of the immigration policies? I mean, a lot of people chalk it up to that stuff because the jobless claims numbers are still very low, for instance, and there's still job openings.
So I don't think it's a negative labor supply shock, which is the immigration story. Labor supply pulled in because of lower population growth, because of the change in border policy. I don't think it's that, because the people who are the closest substitutes with immigrants in this country, young folks and folks without college degrees, aren't having the strongest labor markets in the economy, right? If it were all just a lack of immigrants, you would expect younger people and people without college degrees to be experiencing very, very strong labor markets with dramatic wage growth. In fact, wage growth overall is not consistent with being an immigration story. If it's just labor supply that gets pulled in, wages should be moving higher, right? It's basic supply and demand. If you push supply to the left and demand stays where it is, prices go higher. We've been experiencing cooling wage growth in a period of high productivity growth. With high productivity growth, wages should be moving higher. The fact that that's not happening, and combined with the weaker labor segments that I just mentioned, tells you it's a negative labor demand story, which tells you that it's the Fed still keeping the brakes on the economy in a way that is moving further and further away from full employment. Now, the economy has been on the labor market has been on a cooling trend for 3 years. Right? This has been in motion for several years now. There has been nothing to tell us that a trend this powerful, this set in, has suddenly changed direction. And one thing that worries me is that the higher oil prices, in the way that we were describing before, could accelerate that.
So you think essentially the Fed is stuck fighting its last war, which was inflation?
I think so. I think we're there's an element of us fighting the last war. I think a lot of people are nervous about sort of what happened last time in the discussion about persistent versus transitory. I think the macroeconomic backdrop right now is night and day different. Last time what happened was you had monetary policy at historically record accommodative. Interest rates were zero. We were doing $120 billion of QE a month, which was mortgages and treasuries. Fiscal policy was record accommodative. We were injecting trillions of dollars of fiscal credit and fiscal money into the economy. And so it was very easy. So those were demand shocks that on their own would have been very inflationary, given the economy was recovering from the pandemic because of the vaccine and antivirals, right? So the economy was recovering on its own, and then on top of that, you had all-time record injections of government support into the economy. Then on top of that, you threw in supply shocks of oil and supply chains, and those supply shocks were able to reverberate through the economy because policy was all-time loose. That's not the case right now, right? Monetary policy is still restrictive, as evidenced by the conversation we were just having about labor market cooling. And fiscal policy is not at all-time accommodative levels. If anything, the deficit, I think, has come in a little bit, right? So, there's not the policy backdrop that would create the environment for this type of supply shock to just reverberate through the economy and get stronger and stronger and stronger as it did in 2021, 22.
So what's next for you? Will you just stay until Warsh gets confirmed?
Yeah, I'll stay until Chairman Designate Warsh is confirmed, which I still expect to happen, and I'm excited for because
There's some uncertainty about that, though, with Senator Tillis holding out until this investigation into Powell goes away.
There is, but I expect it's going to happen, and I'm really excited for it to happen because as I've been saying, I want a vacation. It's been a busy 14, 15 months for me, and I'd really like a vacation.
But you'll get another meeting. It sounds like. At least one.
We'll see. Probably I'll get another meeting. If I would love not to. I would love for Chairman Designate Warsh to be confirmed and to start my vacation by the end of the month. But we'll see.
We're about to hear from Fed Chair Powell. What if anything, do you want to hear from him?
I'd love to hear a reaffirmation of the Fed's traditional views on oil, as I just described. But
which is that they look through it traditionally.
Yeah. I don't think anything has changed in the economy that would mean that decades of Fed policy.
It's harder to do that the longer it lasts here, with uncertainty as to when the war ends.
Oh, but like we were saying before, if you told me that inflation was going to be higher 12 to 18 months from now, I think everybody, including myself, would take that would take that on board and change the way that we respond to it. But thus far, there's no evidence of that. There's only an immediate price level change, and the Fed can't affect that.
Fed Governor Stephen Miron, thank you for coming on and sharing your views.
Thanks for having me.
For the extended conversation ahead of Fed Chair Powell. Always good to have you. So here's our roadmap for you for the rest of the hour. When we come back, Richard Haas from the Council on Foreign Relations is with us. Why he says it's more likely regime change comes in Congress than in Iran as a result of the war.
Plus, cybersecurity names, at least the stocks rebounding. This after a brutal week of trading as new AI disruption fears have been weighing on that particular industry. We're going to look at just how big of a threat Anthropic's latest model could be to names such as Palo Alto and CrowdStrike.
And as we said, the Fed chair expected to speak this hour at a Harvard event. We'll take you there live for those remarks as Squawk on the Street continues after this. Welcome back. Oil prices on the rise again this morning. The president wrote in a Truth Social post this morning that, quote, great progress has been made in negotiations to end military operations in Iran and reopen the Strait of Hormuz, but that the U.S. will obliterate Iran's oil wells and maybe Karg Island if the two countries don't reach a deal shortly. Let's bring in Richard Haas, President Emeritus of the Council of Foreign Relations and Senior Counselor at Centerview Partners. Richard, good to have you back. Thanks for the help today.
Thanks, Carl. Good to be with you.
So once again, we have the president's view, no sort of ratification on that news from the Iranians themselves. What is the market supposed to do with this dynamic?
Look, I hope he's right, but at the moment I've seen no evidence of progress in negotiations. I think also if the United States were to start attacking, a wide range of Iranian energy infrastructure and the like, I think Iran would retaliate against the region. That's been the pattern so far. So I actually think up to now, the markets have actually underreacted to this war because I can see how it continues and I can see how it gets worse.
Right. Yeah, there's a wide view that right now the market is pricing in a reopening of the strait more than, say, an economic recession as a result of all this.
Look, I hope the market knows something that I don't. Love to see that. But at the moment, there's no signs. Iran is essentially running the Strait of Hormuz as though it's a private waterway. It's only letting through those ships it wants. Most of the 20% of the world's energy supply that travels through there is not getting through. And then the real effects haven't hit in yet. There's always a lag here. And tankers that got through the strait just before the war started, they're due to arrive, say, in Europe in a week or two. Well, that's when there's no new tankers coming behind them. I think then is when we're going to see energy prices skyrocket again, unless there's some type of a breakthrough here.
We had John a few weeks ago. We talked about what if the Houthis began to speak up. We did hear from them on Friday. Does that sound material to you as a new development?
It could for two reasons. One is it shows that Iran, which has obviously a lot of influence over the Houthis, is pacing themselves and how they're using munitions and what they're doing. There's quite a lot of discipline on their side. Second of all, that potentially threatens the Red Sea, which is one of the alternative routes to in part substitute for the loss of access through the Strait of Hormuz. That would affect, for example, Saudi exports to the rest of the world. So yeah, I take that as another worrisome development.
Richard, do you have a view on the risk-reward of sending in a mission to try to seize the enriched uranium that is in Iran?
I do. It's one of the two military operations being contemplated. I find it hard to imagine a more difficult operation than going into the middle of Iran and dealing with this significant amount of radioactive material. I just think the troops that would have to do that puts them at enormous risk. And I'd also add that even if they were successful, and I think it would be hard to be successful, they would come under incredible fire, would be that we don't know what percentage of Iran's nuclear program that entails. The idea that we would get rid of it all, I think, is simply inaccurate. And seizing Karg Island, something the president keeps talking about, again, quite difficult. And there are, I think, better ways. If you want to deal with Iran's control of the strait, I would say set up a blockade outside the strait in the Gulf of Oman. It'd be far easier, less demanding, less dangerous militarily, but it would have the same effect, which it would deny the right of Iran to stop others using the strait unless they opened it up to all, which I think ought to be our policy.
And what about the prospect for regime change? Obviously would be seen as a true positive. I think you would even agree if that were to actually happen. It wasn't ever fully articulated by the administration. It certainly seems to have been a goal initially, at least of the Israelis. What are the chances for that? Are we misunderstanding perhaps what may be going on the ground when it comes to that?
Look, it would be great if regime change were defined as a real change in the system and you had a Iranian leadership wanting to be integrated economically, politically, wanted to live at peace with its neighbors. That would be fantastic. But the odds are, I think, of that are remote, and you certainly can't base policy on it. There's no way of saying if we do X and Y, that's likely to happen. In the meantime, the straits are closed. Who knows what they might do in their nuclear program? I also think the attacks on Iran have probably set that back. The regime killed tens of thousands of people who the opposition isn't united or armed. I think this is not an environment in which the opposition can come to the fore. Also, the biggest weakness of the regime was their economic policy, and this has changed their narrative. People are talking about the war. So if our goal was regime change, we went about it the wrong way. And I would simply say, as much as I'd love to see it, I don't think it's in the cards anytime soon.
But Richard, if we don't go in, if he doesn't go in, and 100% with all of your risks that certainly have to factor into that decision, isn't the bigger risk that we're just going to have to in a few years anyway?
Well, again, what you're talking about, we don't have a few years to wait on the energy. And for there, I think we've got to be willing to blockade the straits from outside the straits. And I think we can set up a new arrangement for how the straits would be operated. In terms of the nuclear program, if we can't get a deal, Sarah, I would basically tell the Iranians, if you do the following things, we will attack those particular sites. Essentially, give them red lines, and if you cross those red lines, we'll attack. But that would be the reason we would break a ceasefire. We'd much prefer a negotiated agreement. I really don't want to see U.S. troops sent in there because I fear what it would mean for them.
Richard, is there a sense that Pakistan or Islamabad can be a credible go-between in setting up talks maybe this week?
Look, quite possibly. I think it's hard for the United States and Iran to have direct talks, because twice we had direct talks, and then we launched military operations, first in June, then a month ago. So look, if Pakistan, Oman, Turkey, whoever wants to offer their good offices, and if they're basically acceptable to both sides, I would say great. What we ought to focus on is where we want to get the content of the negotiations, not with whom or where they take place. So Pakistan can deliver here, fantastic. Bring it on.
Why are you so skeptical, Richard, that the diplomacy that President Trump talks about, the fact that he says they're begging for a deal, the fact that he says they've agreed to a lot of the items on the 15-point plan, and we've heard from Secretary of State Marco Rubio as well that there's a new attitude. Why are you so skeptical about all this?
Look, I'd love it to be true, Sarah. I haven't seen any indication from the Iranian side, though, that that's their view. I don't see any letting up of the military activities. Meanwhile, my own sense is Iran sees time playing to their favor. It gives them a bit more leverage. But again, I'd be happy to come back on the show and say, fantastic. I'm glad I underestimated the diplomatic prospects. And if we get a good deal, I'll be the first to toast the people involved.
Yeah, and we didn't even get to what help, if any, they might be receiving from Russia or China, and how they're able to see some of those AWACS with such precision in the past few days. Richard, we'll talk soon. Appreciate it as always.
Thank you, Carl.
Richard Haas.
Well, moments away, Fed Chair Powell is speaking live at Harvard University. We're going to take you there when his comments begin. First, though, cybersecurity stocks getting the AI disruption treatment, at least last week. We're going to take a look at whether or not those fears are misplaced when we come back. Welcome back to Squawk on the Street. A new AI security model out of Anthropic was hitting cybersecurity stocks last week. Seema Modi, has a closer look at the risks for names such as Palo Alto and CrowdStrike. Seema.
Well, David, Anthropic's rumored mythos models is prompting a larger debate amongst investors. I was told by one large buy-side firm that their TMT team was called in over the weekend to conduct due diligence on a sector that till now has been seen as less vulnerable to AI disruption. CEOs of the biggest cyber names weighing in. Palo Alto Network CEO Nikesh Arora, in a blog post this morning, says OpenAI and Anthropic are releasing impressive AI models, but that the market is overlooking the cyber risks. Arora said employees are testing agents without fully understanding the exposure they are creating. Vibe coding, he says, has made software creation accessible to people who were never trained to think about what it opens up. He adds that while powerful, these models need scaffolding that the cybersecurity industry and Palo Alto have been spending years building. Those comments follow a filing that shows Arora buying $10 million of Palo Alto stock on Friday following the Anthropic-induced sell-off that we saw really across the cybersecurity sector last week. Analysts from Wolf weighing in on the disruption risk, writing that spending on security, they say, is only going to increase at a time when AI is presenting new risks and the ongoing Middle East war could lead to more cyber warfare. They're upgrading CrowdStrike on this bet that annual recurring revenue will continue to trend higher. We already saw Iran claiming responsibility for a cyber attack on medical equipment company Stryker, and experts we spoke to in the geopolitical landscape, guys, say that that is likely not the last. Guys?
Yeah, Seema, the Wolf upgrade of Crowd is interesting because they do say that this new product that we think we might get from Claude, Mythos, will have some security elements in it, and it might actually trade down when that's eventually announced. But over the long term, they think it's going to drive spending.
Yeah, it's interesting that we now have Fortune and Axios reporting on this rumored new model from Anthropic that they say, if it gets in the wrong hands, could lead to a more sophisticated cybersecurity attack, which is raising concerns not just around disruption, but also around whether the current incumbents in the cybersecurity space have the tools to defend against an attack like that. I think, as Arora said in his post, that AI crucial for the industry to be able to work with these partners to ensure something like that doesn't happen.
Okay, thank you, Seema. Those stocks catching a bid. Little comeback this morning. Seema Modi. Time now for a CNBC News update. Pippa Stevens has it. Morning, Pippa.
Good morning, Sarah. Russia says a tanker carrying more than 700,000 barrels of crude oil has arrived in Cuba, despite an effective U.S. blockade of the island. President Trump told reporters last night he had no problem with a Russian tanker delivering relief to the island as it faces daily blackouts, severe gas shortages, and soaring prices. The president said earlier this month he would have the honor of taking Cuba and floated potential military force. Spain's defense minister confirmed the country has closed its airspace to U.S. planes involved in attacks on Iran since the first days of the conflict. The move forces military planes to bypass the NATO member en route to targets, but does not include emergency situations. President Trump previously threatened to end trade with Spain after denied use of its military bases in the initial strikes on Iran. And Bank of America agreed to pay victims of late sex offender Jeffrey Epstein more than $70 million to settle a class action lawsuit alleging the bank facilitated his sex trafficking operation. Bank of America did not admit wrongdoing as part of the deal. Carl?
Thank you very much, Pippa. Let's get you to Harvard. Listen to the Fed chair, who at the moment is discussing how they handle dissent at the Fed.
Bad deal. Tell me now before we do it. And I just think you don't really know how much you believe in something until you've had somebody literally try to take it apart. So I welcome that at the FOMC and at the Fed generally. And I think it helps us make better decisions. The Fed has had a tradition of governors not dissenting, but that's really not typical of other major central banks where there's more dissenting, or I mean, they're different, depends on the central bank. And to me, what matters is a dissent thoughtful? Is it helpful? Does it help? Does it express a point of view? Can you stand behind it and say, yeah, that's very thoughtful? And that kind of a thing is not bad. And it doesn't hurt with communications. You know, I think a situation like the present situation where, you know, there's sort of downside risk to the labor market, which suggests keep rates low, but there's upside risk to inflation, which suggests maybe don't keep rates low. You've got tension between the two objectives. And I think to try to expect unanimity at a time like that where it's really quite historically challenging, it would almost be misleading to be really confident in which way that should go. In fact, it's been said that confidence is what you feel before you really understand the problem.
Okay. Let's turn to the Fed's balance sheet. In 2008, 2009, that great financial crisis, there was a massive expansion in the Fed's balance sheet. And then again in 2020, under your leadership, there was a second vast expansion in the Fed's balance sheet to address these two economic and financial crises. The balance sheet has since come down a bit, but it still sits at over $6 trillion. So I'd like to hear your views on how efficacious this vast bond buying program has been, both in the 2008 and then again in the 2020 episode, and also hear your reaction to the critics who say that the Fed has become too big a player in the bond market. The Fed has become too influential. There's been a muddying of, as according to the critics, of monetary policy and fiscal policy. Do they have a point, or are they wrong?
So I think the place to start with that is to the problem that people were struggling with from about 2008 to 2022, let's say, in central banking everywhere in the world with is, once you've cut interest rates to zero, do you have anything else you can do? Let's say you cut interest rates to zero and the economy is still clearly not flourishing and it wants more support. So do you just say, well, we're done, we're out of ideas here? And there were two ideas that were followed in the global financial crisis, one of which was to buy assets, longer-term assets, and what you're doing there is you're buying longer-term government-guaranteed securities, which would hold down longer-term rates, and that should stimulate the economy. Or also forward guidance, which would tend to hold down forward rates as well, or just rates generally. So we did those two things rather than do nothing. And I think in the first instance, they were both efforts were successful at restoring market function and at restoring financial stability. At the beginning of the global financial crisis and the pandemic, we had massive problems of market function. They were solved. I think the question, getting to your question, David, of the macroeconomic effects is a much less certain question. I don't think there is an accepted answer, but I would just say there's an oceanic quantity of research on this, and overall it tends to find that buying long-term assets does lower interest rates and does provide some support for economic activity. And I guess I'd be in the camp of thinking that there's something in that, but it's hard to quantify it. And I think, you know, different people have different views on how much those effects could be. The other side of it is, you know, QE is thought by the critics to risk all kinds of other things. So, for example, you could buy too much of the Treasury market and it would stop functioning well. We have not seen that here. At the very beginning, there was the thought that it would be inflationary. We have not seen that, or that it would threaten financial stability or even create inequality. So we haven't really seen the downside risks. At the same time, the last thing I'll say is, I remember before I took over as chair thinking, I'll almost certainly never have to do quantitative easing. So what's that expression? Man plans and God laughs, something like that. So it just, you know, the pandemic came around and we needed to do a lot of asset purchases in a big hurry, and we did. So far, no Treasury Department has ever said, stop doing that, you're supporting the economy too much. Maybe that'll happen someday, but it hasn't happened yet.
So let's talk about the dynamics of inflation since the spike in 2022. Inflation has been coming down since then, but it still hasn't reached its 2% target. Some have argued that that last mile is extremely difficult, and to obtain that, we will need a recession. Others have argued that you've gotten us very close and you'll get us the rest of the way. Are you concerned about the time duration of the path from the high inflation of 2022 back to target? It's taken time. We're not there yet. Is that a destination we'll reach, or are you concerned that the last mile will prove very difficult?
So we will reach the FOMC is and will continue to be committed to getting inflation back to 2% on a sustained basis. That's the place to start. So I feel like we had pretty much gotten there at the end of 2024 against the predictions of almost the entire economics profession. When we raised rates a lot and very quickly in 2022, 100% essentially of economists were forecasting a recession. We didn't have one. Actually, we had 23 and 24 were both very strong years as the supply side healed and as our higher rates had some effect on inflation. So by 2024, you had the economy growing at 2.5%. You had inflation in the 2 plus a few tenths on a 12-month basis by the end of the year. And you had the employment market, you still had the labor market at essentially full employment. So I would call that a soft landing. We had it there. Then since then, we've had to face a much smaller source of inflation, which is the tariff inflation is visible, and we think it's really just a one-time price increase. That's been our thinking since the beginning. Right now, we think it's adding somewhere between 0.5 and a full percentage point to inflation, but that's a much smaller thing than we saw during the pandemic inflation. And and of course now we're facing events in the Middle East which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out.
Great. So let me turn to the current crisis in the Middle East and the effect on energy prices. Indeed, this classroom is familiar with that question from the last problem set, where we asked, how would you advise the Fed to respond to the rising price of oil? And we teach that when there's a demand shock, it's a pretty natural set of recommendations that emerge for the Fed. But when there's a supply shock, like this energy price shock, there's trade-offs that the Fed has to juggle. How do you make those trade-offs in general, and how do you make those trade-offs in this particular instance? And can you help everyone with their piece?
Well, maybe they should tell me. Sure. So you start with what you said. Our tools work on demand. Higher rates will tend to moderate demand, lower rates will tend to stimulate demand. And when you have a supply shock, our tool doesn't have meaningful shorter-term effects on supply. So when you have a supply shock, the first question is, do you respond to it? And the classic question has been around energy, just in general, not really speaking about the current situation, although I'll get to that, I guess. But energy shocks have tended to come and go pretty quickly. Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate. So the tendency is to look through any kind of a supply shock, but a critical, essential aspect of that is you have to carefully monitor inflation expectations, because you can have a series of these supply shocks, and that can lead the public generally, businesses, price setters, households, lead them to start expecting higher inflation over time. Why wouldn't they? At the end of a certain number of years, the inflation is now just higher, and that can happen. So you monitor that very, very carefully. Also, in the current situation, you have to be mindful of the whole broader context, and the broader context is we're still, we've been coming down close to 2% post-pandemic, but we've never actually, gotten right and stayed at 2%. So it's been a while. And we're very mindful of that fact. Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be, but we'll certainly be mindful of that broader context when we make that decision.
Great. So you've been a powerful and vigorous defender of the independence of the Fed with respect to monetary policy. You've also been collaborative with administrations with respect to financial regulation. So under President Biden, you collaborated in a program of increasing regulation. Under President Trump, you've worked together to reduce regulation. So on the one hand, we've got an independent Fed with respect to monetary policy, and on the other hand, we have a collaborative Fed with respect to financial regulation. I don't think there's a tension there, but can you explain to us the two different approaches and how you understand them?
Yes, so start with monetary policy. You know, I think there's pretty broad consensus in both political parties on both sides of Capitol Hill. And our oversight, by the way, is Congress, not the administration. But pretty broad agreement that on monetary policy, the Fed needs to be fully politically independent, not reactive to political things at all. We just need to do our job and stick to our knitting. Regulation is a little bit different, especially since Dodd-Frank, where the Dodd-Frank Act created something called the Vice Chair for Supervision, who has a specific statutory assignment, which is to oversee all of supervision and also set the agenda for regulation. So the Vice Chair for Supervision, if she wants to propose a change in, for example, the Basel III Accords as implemented in the United States, she has to bring that to the Board of Governors, which is the 7 governors, and vote for it. But she has full control over supervision. So as chair, you know, the whole idea is to be non-political and not, you know, never working for or against any political party or individual, or never even considering things like that. So I think the way the law works is the chair should allow the vice chair for supervision to carry out the role that Congress has assigned to that person by statute. And that's what that is. So you'll see, and you know, the two parties really have a big difference on regulation now. So I like to think that the chair should always be someone who is working without regard to political, and should be therefore a person who can be reappointed by either side. That's always been the case. It's been, you know, Ben Bernanke was reappointed, I was reappointed. And I think it's a good test of the Fed's nonpartisanship that your appeal is really bipartisan. I think that's a critical thing. So if I were to try to impose my personal views on regulation, that really wouldn't work. So I think there's I don't want to say deference, but any chair needs to let the vice chair for supervision take the lead on those issues, and then I'm another voter, is what I am.
Great. So let's talk about Dodd-Frank and the reforms to the financial system. 2008 was a terrible crisis, and there were many efforts made in the years afterwards to tighten the bolts and create a safer financial system, less prone to these kinds of cataclysmic events. But today we look out at the world and we see lots of threats, both inside the formal banking system that you regulate and in the non-bank financial system, which is lightly or not at all regulated. So I wanted to have your thoughts on whether we're in a position of relative safety after all the Dodd-Frank and other reforms following the 2008 financial crisis, or whether the new threats actually have brought us to another period of concern. And just to illustrate with a couple examples, inside the banking system, there's commercial real estate that has fallen in value. That affects both the banking system and non-banking financial institutions. We have the private credit market and a very active debate about its health. We have concerns about cybersecurity in the age of AI. Do you worry that another financial crisis looms out there? Of course, there's always a possibility, but is it something that's an issue of high alert, or do you feel that we're putting all the pieces in the right places?
You know, after the global financial crisis, we actually started a new division called the Division of Financial Stability, and their job is to be, you know, sort of the watchers of all financial stability issues all the time. So we're not, the old system was a crisis arrives, we get the team together and we battle the crisis. This is much more of an ongoing monitoring thing with a framework that can be checked. So I would say after the global financial crisis, which happened when you all were extremely young, between Dodd-Frank and the Basel agreements, we pretty dramatically raised the amount of capital and liquidity that the largest firms and other banks have. And I think that's been a good thing. I think they're also much sort of more transparent and more aware of their risks and that kind of thing. So I think we've significantly hardened the system against the kinds of things that happened in the global financial crisis, where you had a lot of credit losses really around mortgages. And so that kind of a situation, we've got well-capitalized large banks. But that's just one part of the financial system. The capital markets, the U.S. has by far the largest capital markets sector relative to the banking sector. The other countries still have a much bigger banking sector relative to their capital markets. And, you know, that's going to be less well regulated, and that's a good thing. You want it to be the place where, where biotech companies can do IPOs, and they may or may not succeed, but they can get capital out of that market. And you know you're taking a lot of risk, but great things happen because people put money into biotech. So we've done some hardening of that, but we shouldn't be trying to regulate risk out of existence. So I think, and we did fix some of the things that broke in the global financial crisis and the pandemic. We did address. The real thing, though, is the economy. The financial sector is just always evolving rapidly, and I think the vigilance is what you need. You just need to always know that there's another thing coming, and I think in particular we've had all kinds of financial crises, but we've never really had a successful cyber attack on a large financial utility, let's say, or financial institution, and that would be quite a different thing. You know, if people are going to lose money in a certain part of the economy, we have a hugely resilient financial system now. It's more, let me say this, it's more about resilience than it is about avoiding crises. One of our former people used to say that we're in the levee building business, not the hurricane prevention business, right? So there are going to be hurricanes, and they're going to come, and you just have to assume you won't know what direction or what the nature of it will be. So you want a highly resilient financial system, and we do have that. But again, nobody who's in that business will ever give you a green light. They'll always say, here, these are the risks, and we got to monitor. You mentioned private credit. So private credit is something, as you guys are probably following, it's a relatively small part of a very large asset pool. We're watching it super carefully, as everyone is. We're talking to the people in the industry and investors and everything. I think we understand it. We're monitoring it. For looking for things that might lead to greater contagion or greater losses or connections to the banking system. And we're going to do that. You're not going to hear people say, oh, there's no problem here, because that's a jinx. But nonetheless, it's something that we're following very carefully.
What is one of your biggest regrets in your time as Fed chair? And on the other hand, what is something that you're very proud of?
On regrets, I don't allow myself the luxury of that. I think it's really important that in my job, I'm focused on the windshield and not the rear view mirror. And so I don't. I'm tempted to say regrets, I've had a few, but then again, not so many, or whatever the line is from that Frank Sinatra song. So I just think I'll have plenty of time for that after I'm out of this role. But honestly, you just have to keep looking at the next thing. You can't be berating yourself for the mistakes that you've made. You're going to make mistakes, and you're going to learn from them. Take it from an expert. I've made plenty, but I don't focus on regrets and things like that. Overall, in terms of what I'm proud of, I'm more than happy to talk about that.
Let's go for it.
Yeah, let's go deep there. Basically, I'll just say it's an incredible honor to do public service, as many of you will find out at some point in your life. I always wanted to do some of it. I saw these people around Washington who were well-known public servants like George Shultz. I would think that looks like a really interesting thing to do. It's different, in the private sector. I love my years in the private sector, but there really is a feeling of what you're doing is ideally helping all Americans and that kind of thing. It's a great honor to serve the public, and particularly in a job like this. So that is the main thing I'm proud of is 14 years at the Fed and 8.5 of them as chair. I'll always be proud of that.
And I'm very grateful to you for your service to our country.
Thank you.
So if you were willing to share publicly some advice that you would give to the next Fed chair, we'd love to hear it.
So one thing you will learn when your children are grown up and they have their own children is never volunteer advice. Only give advice when asked. So, and I would only give advice if asked, and I would do it privately. But I'll just say in general a couple things about the Fed. It is very, very important to stick to your knitting and to stick to the things that were actually assigned. And there's always a temptation to want to move into other areas. And I think we have very powerful tools. They're supposed to be for maximum employment and price stability and financial stability. There's always a time when an administration looks and says, it would be good to use that tool for something else. What if we were just to and call that that's part of the mandate? Happens all the time, and we just have to be in a situation where we're not trying to we're not trying to work against any politician or any administration, but we have to be careful to stick to what we're doing. The other thing is, I'll just note that the Fed's not a perfect institution. Don't look for perfection. What we do is very challenging and highly uncertain, but it's a great American institution, and I'm very proud to work with the people I work with. They're extraordinary right across the board, an incredible group of people, and I'll just close by saying it's very hard to build great democratic institutions and much easier to bring them down.
So, though you were uncomfortable giving unsolicited advice to your successor, I know that the students in this room would love to hear your advice. They've asked me for my advice and asked me what you would advise them. So they're entering into an uncertain time, an economy where new job formation is lower for many reasons. In particular, jobs that were plentiful a couple of years ago for students coming out of college are no longer so. And AI sits as this remarkable technological transformation that is both promising and existentially threatening. So if you're advising the 600 students that sit here today, what would you suggest they think about as they embark on both academic and then ultimately professional careers?
Let me start by saying that I'm well aware, and my colleagues too are well aware of the current situation for students coming out. It's a time of very low job creation. And also you have AI going on. You've got the effects on job creation of significant changes in immigration policy, which have brought down both demand and supply of workers. The unemployment rate is really low, but that doesn't help you if you're coming into that kind of market. So it's a time when the business, there's a business cycle, right? And you're coming out in the business cycle at a time when getting hired is a little bit challenging. There's also probably something more longer term, more secular that's happening and around technology and AI. So yes, it is a challenging time, but I'll say a couple things. One just is that the US economy compared to other major open economies and big market-based economies around the world is just incredibly dynamic and productive. Since World War II, U.S., compared to other, again, large, mature economies, our productivity has grown at like twice the speed, for example, in Europe, and higher productivity is the way, compensation and earnings can grow over time. So it's an incredibly flexible and dynamic economy. It reinvents itself. Technology, it always comes from the United States. So just be optimistic about the medium and longer term. I'm very optimistic about the medium and longer term. The other thing is, my observation is that these large language models make people much more productive. I feel like it's making me more productive because I can learn things really quickly. And I talk to, my son and others who are out there in the world, and I think if you use it well, it's making you more productive. So I think you're in a situation where you need to invest the time to really master the use of these new technologies, and that should stand you in good stead. But there's no denying it's a challenging time to enter the labor market, but it may take some patience and all that. But in the longer term, this economy is going to give you great opportunities, and just be a little optimistic about that.
So when you talk about the longer term, are you talking about 10 years, 20 years, 40 years? Are you worried that there'll be wind at our back as we use these tools over the next decade, but at some horizon, let's say 40 years, there'll be substitution rather than complementarity?
It's so hard to say. A lot of people, you talk to business people, are talking about, you know, the sort of the next few years being big years for AI to come in, but they're mostly talking about existing, you know, middle management, back office jobs and things like that. I don't think it shouldn't have those kinds of effects on people who can use AI well and that kind of thing. I don't know, but so certainly the next few years look like whatever the effects are, we'll start to feel them, because major U.S. companies, and we talk to a lot of those people who run those companies, and you know, they're all looking at what they can do, and the truth is they can take out a lot of jobs that can be automated by a very smart large language model. They just can, and they will, because their competitors are doing it, and they can't afford to have higher costs than their competitors. What's that going to mean for you? It may not mean that much. It depends on what you're going to wind up doing. You know, you may stay in school a little bit, and you may do something that is, yeah, it's going to create new jobs too over time. And again, it makes people more productive. I did talk to a CEO in tech world who said the marginal benefit of a new employee in this world is actually very high. Now, that's not what you hear all the time. So I don't know. I mean, when, you know, if you look back through history to generalize, this has been going on for a couple hundred years. This, you know, since the loom was invented, right, and to put all the people who were doing weaving out of business. But so in all cases, it has wound up raising productivity and raising living standards as long as the society keeps producing people who have the skills and aptitudes to benefit from that technology. So that will be the case here. But you're right, there can be a period during which it's challenging, and this may be one of those, but nonetheless, I would just say it's out there, and it's out there to be done, and I would be medium and longer term very optimistic about this economy compared to any other economy.
Perfect, thank you so much. We're now going to open it up to your questions. So I think I've got Jason and David in the well, and I've got two microphones in the balcony. Why don't we start with Jason? Do you have a question?
I think I have a question.
Okay, great, fantastic. We're going to let Jason ask the first question.
So, Chair Powell, when you're making decisions at the Fed, I'm curious, how much are you relying on very specific economic models? The Fed has its own big fancy model, Furbis. How much are you relying on information you get from talking to people out in the real world, to businesses, your own intuition and experience? What do you bring together as a way of thinking about these decisions, with a role of economics, but everything else that feeds into it?
So it's really all of the above. We have to start with the perimeter. You know, the reserve banks are in touch. They're in all 50 states, right? 12 reserve banks, and they bring summaries of these extensive conversations they have with the public sector, the private sector, universities, healthcare, everything in their district. And we see all of that in the beige book and in the meetings. We get all of that. We also look at several models. It's never just the Furbis model. It's many, many different models, and we look at different alternative simulations. You look at all of that, and then we look at where our policy stance is, and we look out the window and we say, does it look like our policy stance is affecting the economy in a way that moves us closer to our goal variables or keeps us at our goal variables? You do all of that. We also talk to each other. You know, I talk to the other 18 participants on the FOMC a couple of times each cycle, and people have different thoughts and ways of thinking about things. Talk to the senior staff. You know, they've been doing this longer than any of us. So all of those things go into it. I wouldn't say, you know, I mean, so a good analogy is when I was in the private equity business, we had really good models of companies, and my big boss said, we want to have the best model in the industry, but if you think that model is going to make the decision for you, you're in the wrong business. So the models are just illustrative. We cannot model the U.S. economy with the kind of precision that we will never be able to. It's like modeling the weather. You can't predict it 2 months away. So it's all of those things, Jason.
Thank you.
Okay, so David, why don't you pick the first hand, and then Jason, you'll get the second hand. And then we'll go to the balcony, so for someone upstairs.
Hi, my name is Fabio. I'm a first year studying economics and government. I'm really interested in kind of the decision making in the Fed. How do you work with situations where like the decision might be very tight and like sometimes there's like expectations of like the interest rates increasing, or it might be very tight, and those very tight decisions, like how do you end up making the decision?
So remember, I'm one of 12 voters. So there's an FOMC cycle is about 7 weeks between meetings. We have 8 of them a year. So, and I would say sort of 3 weeks before the meeting, by then I have to have a pretty good sense of what I think we need to do. And staff will already have been working on, if we're doing anything in particular, we always have like a special topic. So a lot of work is going on. So I almost need to make a decision about the probable thing we're going to do. And then I have to talk to everybody a couple of times because I got to get people to vote for this. And I've got to, a lot of it is finding out where the sentiment of the committee is. I've been working with these people for many years, so most of the time I kind of know how they'll approach a problem. And that's how it works. So it's a lot of talking and listening and understanding. I think an underrated skill is in listening to people. Listening is, if you listen to people and you hear them and you can make their argument and they understand that you're actually listening to them and not just, communicating at them, for most of the people, most of the time, that's going to be enough. And by the way, that's true on Capitol Hill. That's true. It was true when I was a governor. If I felt, I always felt like Ben Bernanke or Janet were listening to me, and if they could engage with the points I was making, then I felt like I could support what they wanted me to support. So it's a lot of that, though. It's a lot of committee management. That's the big part of it is to have active dialogues going with all of the FOMC participants, and by the way, also with all the senior staff who've been doing this a very long time, and they bring, in many cases, they bring history going back many years. For example, in the public communications that we make, somebody who's been doing that for 30 years will tell you don't use that word, even though that word might make sense in another context.
Okay, over here.
Good morning, Mr. Powell. I wanted to ask you a bit more about private credit markets and particularly rising defaults among non-bank lenders like Blue Owl Capital. So I wanted to ask, to what extent could stress in these private credit markets spill over into the traditional banking system?
So that's the question we ask ourselves quite a bit, and as I mentioned, we're watching very carefully. Of course, what you can read in public, we're also getting the backstory from the people who run these organizations and from all the banks. The supervisors are well aware of what the bank's exposure is and what is not. And I'm reluctant to say anything that suggests that we're dismissive of the risk, but we're looking for connections to the banking system and things that might result in contagion. We don't see those right now. What we see is a correction going on, and certainly there'll be people losing money and things like that, but it doesn't seem to have the makings of a broader systemic event. But again, we never give a clean bill of health. We just keep watching for that. We don't see those characteristics though right now.
Let's go to the balcony, and remember to share your name when you begin your question. Great.
Hi, my name is Cody. Thank you so much for being here, Mr. Powell. My question is about whether international relations has impact on your decision making. I know you mentioned that the Fed's job is to do exactly what's best objectively for the American economy, but I'm wondering, if you're competing with, let's say China or other powerful countries, whether or not you would kind of, cut interest rates or do something like that to stimulate the economy to kind of get ahead of other countries.
No, it doesn't. We're always asking the question, as you suggest, what we serve the American public always in all of our decisions, and what is best for them. How do we achieve maximum employment and price stability on a sustainable basis? That's what we're always asking. We do, meet with, in Basel, the central banks all meet without the finance ministries. And we can talk privately about what's going on in global financial markets. It is a global economy. We all know each other, and frankly, many of us have regular communications going on just privately, or by telephone, email, and text, and things like that. But we're never looking to get on the turf of the national security people or the State Department or things like that. We're not looking at things that way. We're looking at our goals. That would be, I think, a classic case of mission creep if we were to say, hey, let's deviate from just chasing these two goals and let's do something for a third purpose. That would almost by definition make us less effective at the things we're supposed to be doing, so we try to stick to that.
David, you're next.
Good morning. My name is Jenny, and thank you so much for coming. We're all very honored that you took the time to come. So last lecture, we learned about soft landings and about how it's definitely much more ideal than hard landings, but in the US history, we've had far more hard landings than soft landings. And we were just talking about how it's really important that you are monitoring expected inflation. And I think a lot of that just comes down to the trust between the public and the central bank. And the central bank is known to be much more technocratic, but I think especially with like the rise of populism and previous events, there seems to be a lot of impact of like political tensions between, or cooperation between the Fed chair position and the administration. And I wanted to ask you, how do you still keep the public's trust this way?
By sticking to our jobs and doing them well, ultimately. If we deliver the maximum employment and price stability, or at least are seen to be doing everything we possibly can as we meet various shocks and multiple supply shocks in recent years, the public keeps its faith in us. And if you look, we look at things like longer-term inflation expectations, and you'll see that they've remained pretty well anchored right through all of this. So if you really think inflation is going to be higher, you can make some money betting against that. But people don't do that. The people who are putting their money to work in the financial markets, not to give too much credit to that, but that's it. If we stick to our knitting and we do our jobs, we stay out of politics, stay out of the hot political issues of the day, and just do your job and keep your head down. I think I see this through my dealings with elected people. If they get the sense that you're not there to deliver talking points, you're there to listen to them, and you're really somebody who is committed to doing your job and sticking just to that job, and that's all you want, and you're not going to get into politics, that's what we need to do. And I think generally, I think we are accepted in that spirit in Washington, and I think generally around the country as well.
Jason. Remember to tell us your name.
Thank you, Chair Powell, for being here. My name is Jake. As you know, your term ends in May, and a potential successor, Kevin Warsh, has indicated a desire to cut rates if he fills the role of chair. What is your take on the effect that a cut would have on the flexibility of the Fed to remain well positioned to maintain both sides of its dual mandate, particularly given the fact that inflation has remained elevated above the Fed's 2% target for several years now, and progress is further halted by the oil shock and tariffs especially?
Jake, that's not something I'm gonna swing at, that pitch. Is that a Red Sox jersey, by the way?
I called on him.
Yeah, okay. I know this must be Red Sox country.
So we're going to go to the balcony next.
Hi, my name is Eamon Candido. So earlier you said that you don't know how much you believe in something until someone tries to take it apart. So my question was, what's the thing you currently believe about the economy that you're least confident in?
Interesting question. I'm not going to give you a particular individual thing at the moment, but I will say that I would say this, and of course this is self-serving to an extent, but having worked in the private economy for most of my career, I don't have any predisposition to believe that models can really capture it, because so much of it is animal spirits, as Keynes called it, and also it's again, I go back to the weather. Will we ever be able to predict the weather with any precision three months ahead, other than that seasons? So the economy, no one has been able to really successfully predict the economy. So I think the temptation is always to place too much sort of stock in in models or in one particular outlook. The other thing is, another thing which is a big takeaway is, about fat tails, right? So famously there's a normal distribution and the tails are what they are. It's not a normal distribution. The tails are fat, and however fat you think they are, they're fatter than that. The possibility for the economies at any given time is so much broader. For example, the pandemic inflation. We'd spent 15 years with the inflation below target, and that was at a time of QE and lots of fiscal stimulus and that kind of thing. We had inflation below target, and people, pretty much the profession had, the big problem the whole profession was trying to solve was how do we get inflation up to 2%? That was really the problem. And then along comes the pandemic inflation, and bang, suddenly you have a 40-year high inflation. So it's hard to keep your mind open to just how broad the possibilities are.
Take down here, yes.
Hi, my name is Robert. Thank you so much for being here. I'm a first year studying econ, math, and philosophy. So many economists that I've listened to, at least retroactively, say that what we really needed during the COVID pandemic was around $3 trillion, and the government printed something along $6 trillion more than that. And so inflation rose, but that money is still out there. So if rates come down, obviously you took initiative and you raised them very significantly. If rates get lowered again to, let's say, 2% or so, do you think that the price spikes have already played out, or do you think that all that extra money being out there will, on top of, instability geopolitically, do you think that's going to push us back into an inflationary spiral? And then also I was wondering, for your next press conference.
Fed Chair Powell at Harvard today, taking some questions there from the economics students with some first-year students. Joking back and forth, a lot of questions around how the Fed works, what the decision-making is like. I will say that we are seeing a bit of a Treasury rally to the highs of the day where yields are lower. Not sure that Fed Chair Powell tipped his hand really in terms of monetary policy, but maybe he was less hawkish than the market was positioned. We're going to continue to monitor these remarks for you, bring you any headlines as they relate to the market. We're also streaming it right now on CNBC.com. Let's bring in CNBC senior economics reporter Steve Leisman. Steve, he did talk a little bit about the rise in oil prices and the war in Iran, and said that the Fed doesn't have any meaningful tools when it comes to supply shocks. The Fed usually looks through these kind of supply shocks, but again, didn't necessarily say, so we're not gonna do anything as a result. What was your take?
Well, I think you're underscoring the importance of what Powell said, which is the market had gotten itself a bit into a tizzy, a bit of a froth about the idea of the Fed potentially raising rates. I thought Powell very specifically decided to use this opportunity to bring the conversation back to the center, Sarah. And the idea when he first started out said we have tensions on both sides of our mandate, on the job side and on the inflation side. And then he went on to say, well, our inclination in this case is to just look through it. And he made a very important point about the differential between, he talked about energy shocks, they work through the system quickly, but policy takes a long time. So again, suggested the Fed was not going to do anything knee-jerk here in response to high oil prices. Now, some of us like you and I who watch the Fed every day probably didn't expect that, but certainly the market was out there guarding against it. So what I see and I'll just double check while I'm talking to you, Sarah, when I look at the probabilities, a bit of a shift. It's still in the center, 70%, 80% chance the Fed doesn't do anything, but the tail is a little bit more towards, well, maybe a cut and away from the hike where the market had gotten itself into a froth in the last week about.
Yeah, he emphasized the both sides thing, agreed, and did say, as we talked to Stephen Myron, I don't know if you saw Fed governor right before this, and Myron said, I'm looking forward to hearing Powell talk about what the Fed usually does with a supply shock like oil. And, right on cue, Fed Chair Powell did talk about that and said we do usually look through that, which is, I think, more in the Myron view of what they should be doing.
It's an important point. So if you think about it, well, what's going on? We've had Goolsbee and some other folks say, you know what? We can't take a hike off the table. But what we're looking for is where's the center of the board here, okay? And I think what Powell brought it back to is, and then layering in Myron on top of that, it's keep the rates the same with maybe a cut if we get an opportunity to do that. But the hike looks a little bit more remote listening to Powell this morning, and certainly Myron's not on board with that, and we'll have to hear what others have to say. But right now, I think that this idea of 80% probability the Fed does nothing, probably the more likely and right solution here.
Okay, Steve, thank you very much. We'll come back to you if he says anything else. Let's turn now to the broader market following those comments by Fed Chair Jay Powell. Joining us now with some reaction is DoubleLine Deputy Chief Investment Officer Jeff Sherman. And we are seeing the bond market rally, especially the 2-year. So the market just got a little too worked up about a hike coming, Jeff?
Yeah, well, I think the thing that we have to remember, too, is that the Fed always looks at core inflation, right? And so that strips out commodity prices, even though they affect every consumer and every input in our economy. And so I think what's happened with this oil inflationary shock is that people have been expecting the central banks to respond in some manner. We've seen this as recent as a week ago. You know, the BOE was pricing in, or the English market, UK market was pricing in 4 hikes for the year. You've seen the ECB price in hikes as well. But remember that oil price shocks are actually a version of hawkish policy itself, right? If the price of oil goes up, right, that is inflationary, but that causes a strain on the overall economy. And so I think the right response here is for no reaction based on the energy prices, and ultimately go back to what the market's been focused on is actually where we are in the cycle of the labor market.
You know, we did speak this morning, just in the last hour and a half, with Stephen Myron, the Fed governor who's dissented at every meeting. He wants lower interest rates. Listen to where he says policy should be headed.
At the moment, I think that we could be about a point easier, gradually done over the course of a year.
So you'd like to see now 25 basis point cuts?
That's what I voted for
meetings.
the last 2 meetings, 25 basis point cuts.
I mean, that's clearly not where the center of the Fed is, but his point is that the Fed is holding back job growth at a time where we are seeing the job market show some signs of weakness. Payrolls has gone negative, and that if the Fed were easier, you'd see better results on jobs.
Yeah, I'm not convinced. I mean, Myron's been very aggressive in his cuts, and he seems to be one of the lone wolves out there. But that being said, let me posit the question to you, Sarah. If we ease 25 basis points, does that get corporate America excited about hiring? Probably not. Now, you could say that if we got that path of potentially 1% lower rates, it would bring some of the stresses out in parts of the market. And, you know, some of this would be the floating rate loan market, right? Which we know has had some challenges with private credit, with bank loans, et cetera. So maybe there is some truth to that statement when it comes to some of the stresses, but I'm not convinced this changes the overall outlook for overall hiring based on, you know, 25 to 50 or even 100 basis points lower at the current cycle.
Well, I think it does if it's able to move the market. I mean, if the 10-year, if the Fed went into cutting mode still, and you saw, you know, long-term interest rates come down, that would certainly make things easier for housing, for corporates, for all sorts of parts of the economy that need lower rates.
You are correct, but thus far, since the Fed's been cutting, you know, if you look at the last 3 rate cuts, bond yields have not come down on the middle to the back end of the curve. And so, from that perspective, I'm empathetic to what you're saying here, but actually the bond market
has to react.
That is
Why
correct.
do you think that is? Why do you think that yields have risen even as the Fed has cut?
Well, I think that ultimately it's digesting many things out there. One is, you know, the overall fiscal overhang of not just the U.S., but the overall developed market. And when you look at kind of back-end yields, let's call it like 30-year bonds, we've seen this dynamic of a rising yield, or at least being near all the cycle highs across the developed world. You have the UK near all-time highs. The U.S. market, we're really close to that as well. You go to Europe and even Japan now as well. So there seems to be a market rejection for kind of the back end of the curve. And to me, that's really signaling that potentially there's a longer-term inflation problem, not the 9% we experienced 3 years ago, but maybe we're not at that 2% inflation rate. plus the overall ills of fiscal policy in the entire developed world. So I don't think it's as simple as cutting the front end of the yield curve brings the whole yield curve down. In fact, it may just indeed steepen it. It may not make back-end yields rise, but it also may not make them come down and getting the desired effects that the Treasury Secretary, the administration essentially want in this country.
Yeah. Morgan Stanley has a tidbit today, Jeffrey. Recent data, quote, confirm a regime shift. Foreign ownership of treasuries has fallen to the 1997 lows, making speculation about outright sales seem plausible. You think that explains some of the weak auctions lately?
It could be, and essentially you got to think about it as that the world is voting not just on the outright payment of U.S. treasuries or the fiscal stability there, but it's also potentially talking about our policies, right? Here we are again mired in another conflict that's once again we helped begin. And so I think potentially there's some of that rejection of our policy. And if you really want to wake up the administration, one way you can do that is through financial markets. And so that can be through, abstaining from purchases. It could be from outright sales. You could sell, corporate bonds. You could actually sell stocks. I mean, there's a lot of ownership of our assets. So you never want to mess with what ultimately can be the economic impact of your ultimate policy as well. So sometimes that gets lost in markets in the day-to-day, but potentially there's something about the rest of the world voting against that.
So what are you guys doing at DoubleLine? How are you positioning right now?
Yeah, I mean, we've been talking about potentially adding to a little bit of duration and buying some of the kind of rate risk, not on the back end of the curve, but kind of that 5 to 10 year part of the curve. Because as I mentioned on the onset, we're talking about a slowdown because of this conflict and what it's done to oil prices. And I'm very concerned about what we've seen in the oil market thus far, because it's not just the spike we've seen and potential reaction back downward if the conflict stops, but it's the amount of disruption that has happened of destroying supply chains. So it's not just the strait itself, but also the production facilities. And so if that continues to be an ongoing problem and there's more destruction, which we've seen now the aluminum plants get hit over the weekend, you're seeing more of the LNG plants get hit as well. Ultimately, that leads to just not opening the spigots back up and being able to deliver that supply. So if you want the oil markets to calm down, we need demand destruction at this point. And if they see in the commodity prices, the cure for high prices is high prices.
Okay, Jeff, thank you for joining us with some first reaction there to Powell and what we're seeing in the bond market. Jeff Sherman.
Thanks for having me, Sarah. Thank you. Thank you.
Speaking of high prices, WTI is higher today. Brent about flat as the Iran war goes into its 5th week. President writes on Truth Social this morning that if a deal is not reached and the Strait of Hormuz is not immediately open, the U.S. will destroy Iran's electric generating plants, oil wells, Karg Island, some desalination plants. Joining us this morning is Barclays energy analyst Amar Singh. Amar, it's great to have you back. Thanks for the help today. I am curious to get your take this morning on this sort of narrowing spread between West Texas and Brent. It's more like $10 today and not 15 or 20.
Thanks, Carl, for having me. So we break down the Brent WTI spread in two components. The onshore component is the cost of getting oil from Cushing, Oklahoma to Houston on the coast. And then the offshore leg is basically getting it from Houston to UK, where it competes with Brent. And what we've seen is because shipping costs have gone up, we've seen the offshore leg widen. But more recently, what we've also seen is market participants probably betting that there's going to be some export restrictions in the US, which has led to the widening of the onshore spread as well.
Do you expect that premium to last?
It depends on how things play out. I mean, at this point, shipping rates are very high, obviously, but we've not seen any formal announcements from the administration about a potential restricting of exports out of the US. So if that remains the case, you could argue that it's just limited to the offshore leg and the onshore leg goes back to normal. It was about $1 on average last year. But if we see like sort of the era going back to 2015 and before, where exports were out of the US were restricted, then the onshore leg could widen a lot more, and the overall spread as well.
So when we read exactly what the president is threatening here, obliterating their electric generating plants, oil wells, and Karg Island, and possibly all desalination plants, what is priced in exactly in terms of that risk right now in the oil market?
So we've laid out 3 scenarios, and where market pricing stands right now is in the middle of the first 2. So the first scenario is the most optimistic one right now, that we get a normalization of the Strait of Hormuz situation by early April, and that would get you to a full year average Brent of 85. As of Friday close, the forwards implied 2026 average Brent was at 91. The second scenario is the Strait normalizes by end April, and that is consistent with Brent averaging $100 this year. And the third scenario is the Strait normalizing by May end, and that would be consistent with Brent averaging 110. So as I mentioned, we're basically in between the most optimistic and a little bit more worrisome scenario right now.
What about the Karg Island option, where the U.S. takes control of Iranian oil? Is that a risk for higher oil or lower?
We'll have to see how that plays out. Rhetoric on that specifically has been extremely elevated, with Iran threatening attacks on regional oil infrastructure in response. And so far, we've seen very limited effect, at least on the oil side. I mean, Jeff mentioned earlier attacks on aluminum sites and LNG sites. But on the oil side, it has been limited to oil depots and refining complex, but we've not seen upstream infrastructure or even midstream or shipping terminals attacked to that extent yet. But if that were to happen, then that could compound the duration effect that I was talking about as it pertains to the Strait of Hormuz itself.
When you think about LNG and the vulnerability of some of these, say, Southeast Asian countries, do you think they're going to start to turn toward coal over the long term, or even some renewables as a replacement for the unreliability, at least for now, of this LNG episode?
Yes, I mean, this is exactly what happened in 2022, and we're just seeing an extension of that. I mean, the 2022 crisis was, finally something that markets were beginning to start put behind with the expansion in Qatar coming online later this year. But now, obviously, with the facility in Qatar hit, even the existing capacity in the country is now under question. Even if the Strait were to normalize because of that damage, the facility will not be able to ramp up fully, and obviously expansion plans are also in question. So the LNG market might have a lot more sustained damage coming out of this conflict, and yes, that would mean the power sector in Asia will have to adjust to that reality.
Yeah, because that's a big debate on oil prices too now, is just how long this will last. Even if the war does end and find some sort of resolution, how long does it take to get back online, and what will that mean for prices? Or do you think prices just react really quickly to any kind of end?
I think there's going to be frictions, but markets are generally very good at pricing that. When we laid out those scenarios we just discussed, there's obviously an assumption there that things will not come back online as quickly as the ships start moving, right? So they don't need to necessarily coincide with each other. But those scenarios have some friction baked in, and it would depend from country to country. Countries where the production shut-ins have been more widespread, and that's in the countries that do not have much capacity to reroute supplies, like Iraq and Kuwait, you will see a greater lag in terms of resuming production. But there are countries like Saudi Arabia and UAE where they've been able to reroute supplies, and so production can ramp up relatively quickly.
Right. Speaking of the Saudis, I wonder, Amar, have you been impressed at the ability of their East-West pipeline to benefit global supply? And did the Houthis' news on Friday put some of that at risk?
Yes, so it's been inspiring to see that, and it's obviously great comfort that they've been able to reroute some of the supplies from the east to the west terminal. And Houthis, who have remained silent so far, joining Iran's response is a concern. Although so far, infrastructure in the Red Sea area or shipping through the Red Sea has not been attacked. But that is something that markets are very eagerly looking at.
Amar, appreciate it. Obviously, extraordinarily complex to read. We benefit from your help. Thanks so much, Amar Singh over at Barclays.
Thank you for having me.
When we come back this morning, the leading driver behind the steep declines in shares of Meta, Microsoft, and Alphabet to begin the year. We'll take a look at that in a minute.
Plus, why new attacks in the Middle East have aluminum stocks spiking. Aluminum now on pace for its biggest monthly gain since April 2024. We'll be right back. Aluminum, the latest commodity to see a sharp move here as a result of the Iran war. Pippa Stevens tracking those moves for us this morning. And Pippa, I've heard some of the beer companies already start to mention this, like a Coors, but it's really moving.
Yeah, that's right, Sarah. So aluminum prices are rising after Iran targeted the two largest single-site smelters in the Middle East. Emirates Global Aluminum saying that its site in Abu Dhabi sustained, quote, significant damage, with Aluminum Bahrain also hit. No word yet on potential production losses, but together the facilities produce about 4% of global supply, or roughly 10% of ex-China supply, according to JP Morgan. And this comes after some smelters in the region had already announced curtailments, given the Gulf relies on alumina imports that pass through the Strait of Hormuz. And more cuts could be coming as smelters work through their dwindling stockpiles. In total, the region accounts for roughly 23% of ex-China global production. And last year, about 21% of U.S. primary aluminum imports came from the region. That's according to S&P Global. Aluminum stocks, including Alcoa and Century Aluminum, seeing big gains today. The JP Morgan saying the metal could quickly run towards $4,000 per metric ton or even higher before a demand-driven unwind. Guys?
Pippa, aluminum is a really interesting collision of the Iran war and tariffs. Cato did a piece last week where, because of the tariffs on Canadian aluminum, a lot of U.S. buyers sort of migrated to Middle East supply chains, which of course have now come back to bite them. I think in the words of one piece, it was the dumbest tariff ever created.
That's right. And so the whole point of that is to try to boost production in the U.S. And there is a new aluminum smelter that was announced last year. But the issue comes down to power. And these are incredibly power-intensive factories, even more so than a data center. And so in places like the United States, you just cannot compete with tech companies that might be willing to pay far above wholesale prices for power. And actually, we've seen that a smelter in Mozambique that was a key supplier for Europe just earlier this month announced that they are shutting down because they couldn't secure a long-term power deal. And so while those tariffs were meant in theory to try to increase U.S. Production, it's really difficult given that in the Middle East, for example, the reason why so much production had migrated there was because of access to cheaper energy. And so there is unlikely to be an aluminum smelter boom in the U.S. anytime soon.
But where does the U.S. get most of our aluminum? Is it's Canada, Mexico?
Yeah. So Canada especially, they also have access to that cheap hydropower, so they can have a lower cost access to energy, and then also from the Middle East. But again, like the Middle East doesn't have the bauxite, so they are having to import that from places like Guinea and Australia, and then it's cheaper to refine it into the end product, the aluminum, in the Middle East. So it's hit on both sides, both coming into the strait and then also trying to exit the strait. And so those supply chains have all developed based on where you can get access to cheap energy, and then you add on the tariffs in the U.S., and then, manufacturers do typically have some supply and some, some finished product in inventory, but the longer this stretches on, the more that's going to start to drive up prices.
Pippa, thanks. Appreciate it. Very important story, almost as important as energy itself. Our Pippa Stevens. When we come back, why a social media post has shares of Fannie and Freddie jumping better than 30%, plus the reasons the street might be punishing some of the biggest public players in AI. When we're back in a moment.
Welcome back. Let's get to some movers we're watching this hour. Fannie Mae and Freddie Mac are surging after Bill Ackman wrote in a post on X that they are, quote, stupidly cheap. Michael Burry also saying he, quote, cannot emphasize enough how rare this is in this market. Shares of car rental company Avis plummeting after jumping more than 48% last week, following investor bets that the car travel company could surge amid long airport lines. And then there's Cisco, the biggest U.S. food distributor to restaurants, hospitals, and schools. It's under pressure on news today that it is acquiring Jetro Restaurant Depot for more than $29 billion. Pretty big deal, including debt. Stock down 13%.
When we return, why the market is punishing names like Meta, Microsoft, and Alphabet to start this year. Microsoft losing about a quarter of its value so far. Stay with us.
Picking up a little bit of steam here in the major averages. As you can see, it's opened higher, kind of lost a little, and now we're back on the ascent for stocks overall. S&P 500, the Dow's up a nice 430 points. One potential reason that we're climbing here is that we are seeing bonds rally and yields a little bit lower, which has broken the don't usually see that when oil prices are firmer. We usually see the inflation trade on, but it's going the other way. And perhaps because we did hear from Fed Chair Powell in the last hour or so, speaking to kids at Harvard, and, not breaking any crazy new ground, but he said inflation expectations are anchored. That's perhaps good for the bond market that was working itself a little bit into maybe hikes. He did say that we usually look through these kind of supply shocks and we can't do anything about the supply shocks at the Fed. So definitely not as hawkish as maybe the market was positioned for, and that's helping lead bonds rally and the sentiment in stocks higher as well.
Right. Didn't hurt that he said no systemic clues of stress coming out of private credit, and with that, we're trying to hold 6,400 this morning. Meantime, some of the biggest public players in AI are seeing some historic declines to begin the year. Our Mackenzie Sagalos has more on that in today's Tech Check. Morning, Mac.
Hey, good morning, Carl. So Alphabet, Meta, and Microsoft deep in the red year to date. Microsoft down as much as 24% in 2026, despite clawing back some ground this morning. And it comes as investors absorb 3 new mammoth data center deals tied to yet another wave of CapEx-heavy AI expansion, which together show big tech taking on parts of the build-out that private companies, namely OpenAI and Anthropic, couldn't fund on their own. So first, you have Microsoft taking over a data center campus in Abilene, Texas, that had been reserved for Oracle and OpenAI's Stargate project before financing talks fell apart. It's one of the clearest signs yet of how far Microsoft and OpenAI have drifted. They now have rival data centers right next door to each other. Next, Alphabet reportedly nearing a deal to provide construction loans for a multi-billion-dollar data center also in Texas that Anthropic can't fund on its own. Here, Anthropic signed the lease but needed Google's credit rating to get the financing done at a reasonable cost, which is pretty much the dynamic for every frontier AI company right now. They need hyperscaler balance sheets to build at scale. And then there's Meta. The company cut a deal with Entergy Louisiana to fund 7 new natural gas plants for its Hyperion campus, tripling its power footprint, though Meta is covering the full cost so that ratepayers don't absorb it. And what connects all 3 sites is natural gas. Each of these projects run on it, and the war in Iran has driven prices sharply higher since the conflict began. That's where investors start thinking about margin compression, adding to broader concerns about the CapEx ramp. These 3 companies are well off their 52-week highs. For Microsoft, down 34% from its peak. Guys?
Yeah, I mean, Microsoft has that added sort of software headwind that it's dealing with, Mackenzie. I guess, there are a lot of the analysts love these stocks, who follow these stocks, and they say they're a safe haven, and you're not going to see growth like this in the rest of the S&P 500, especially with these supply chain inputs.
Precisely. And to that point about supply chain inputs, there's a big concern that this could show up as a headwind as soon as Q2, because not only are you looking at greater energy costs, you're also looking at the price of helium going up, and that ripples into chip prices. So already, as of the last quarterly prints, we had a collective CapEx spend of $600 billion across big tech. And the question is if they maintain those same build-out ambitions, will the costs go up just because it's going to simply be more for the inputs at this point?
Meantime, we began the morning with Jim and David talking about OpenAI and Sora, which felt, Mac, like they had to make some tough choices because compute there's such a premium on it. And I wonder if you think any of those dynamics from the private markets could migrate into public.
Well, certainly. We already saw OpenAI revise down its CapEx spending ambitions from $1.4 trillion down to $600 billion. Sora ate a lot of compute costs, so we saw them shutter that despite having a Disney investment tied to it. But, I mean, you're looking at big tech. They don't show any signs of slowing down. In fact, that Microsoft campus, Meta put in a competitive bid against it. And Meta, despite the legal overhang, also doesn't have a cloud business to justify this kind of build out. They just had their worst week since October last week. And so there are standing questions about whether or not that CapEx spend for Mark Zuckerberg will bear out. Because at this point, it's really going into feeding their models and their algorithms, a change that might be forced if courts say that they need to change the addictive nature of their platforms.
Okay, Mackenzie, thank you. Watch all of these risks. Mackenzie Sagalos. Meantime, stocks, as we mentioned, are holding steady. They're higher again. Bonds are higher. So a little bit of different correlations than we've seen over the last few weeks because oil prices are higher as well today. We'll get a lot of economic data, and the data has taken a back seat to some of these headlines around the war. So let's see if that changes with some of the more heavyweight reports like a retail sales and jobs report coming Friday on a market close day.
Right. Job openings tomorrow. It will be interesting to see if retail sales are responding to obviously developments that were pretty fresh when that data started getting collection during the course of the month.
Higher gas prices.
Yeah. Let's get to the judge.
Carl, thank you. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks on a 5-week losing streak. No signs of an end to the war. We are trading the markets with the investment committee, as always. And joining me for the hour today, Joe Terranova, Kerry Firestone, Sarat Sethi, and Stephen Weiss. Let's check the markets. We are now green with everything but the Russell 2000. The Dow is trying to get to a 1% move today, about 400 points or so. Let's give you a little state of the pullback, if we call it that, since the war began. S&P's down about 7%, a little bit shy of that. The issue, as all of you know, is there just hasn't been really anywhere to hide. Bonds have been rough. Yields have been backing up. Yields are down a little bit today, which is helpful. In fact, the 10-year, Steve, is down about 15 basis points from last week or so. The Fed chair was speaking at Harvard this morning and said inflation expectations remain, quote, well anchored. That was important.
Yep.
And you actually saw the market tick up a little bit on that, and yields tick down a little bit. So that's sort of the state of play. How do you see it?
You know, without that statement, Scott, I'm not so sure we'd be in the green except for the Russell today, because we've had other statements, conflicting statements from the Fed, that from other Fed governors, that maybe they're not so well anchored. So I think it's positive, but the question is, will we be saying the same thing if the war endures for a little while yet, as it filters through? So the way I look at the market is in the following: that we just don't know what the risks still are. I can see some headwinds. I think the fact that we're going to have a good earnings season is well telegraphed and absorbed into the numbers, as it was with prior quarters. But we've got a Fed that, for better or worse, only means that it's holding tight and not going to raise. Cuts, I believe, are out of anybody's expectations. So if the oil crisis ends, which means the war ends, then you could see inflation resetting and the possibility for some cuts to come back on. That would be positive. And then don't forget that we'll get midterms. And to me, midterms will be a referendum on Trump. And let's face it, regardless of Trump's approval rating, midterms always go to the other party from the incumbent. So except for twice over the last how many years. So that'll put an end to his pro-business agenda if, in fact, that's what it was, and that's another headwind. So on balance, I think that the market intermediate and longer term looks fine. Short term, I'm still not ready to put capital back in.
Yeah. Joe, I mean, people are smarting over, everything that's happened in the market because, as I said, it's really been hard to find a place to hide. The 60-40 portfolio suffering its worst month since 2022. That sort of underscores the pain that has existed almost everywhere you look outside of under the mattress.
Yeah, and to Steve's point, we're green today, slightly green, because yields are 15 basis points lower relative to where they were on Friday. Financials are actually the leading sector so far intraday today. And then you have that relationship between semis and software. Software is actually outperforming semis. But Scott, you can't take your eyes off of oil. I'm sitting here as you're talking to Stephen. I'm watching oil at 103.35. I'm seeing that the S&P bleeds a little bit lower because of that. Today will be the first time that WTI crude oil has closed above $100 since 2022. So I don't know. You just can't break that attention that you have to give oil. Yep. And as it moves higher, the response concurrent in the equity market.
Sure. I mean, the market seems to be, able to get its arms around $100 for assuming that it doesn't go from 103 to 113 to 123 to 33 to 43 to 50, if not higher, Kerry, even as some on the street and even within the U.S. government are sort of gaming out the idea, well, what if it goes to 200? But that seems, a ways off. There's no point really debating that because it depends what happens in where the war goes. But for now, we know what the stakes are currently. We are trying to figure out how to play it in an environment where yields have been backing up, bonds have been going down, and stocks have been going down. What do you do?
Well, we know that it's unlikely that the stock market, and I would say all aspects of the stock market, can rally sustainably unless we have a resolution to this, because oil prices at 120 plus will lead to a recession, and that means earnings are coming down. So the question is, how fast do we have a resolution? Okay, we don't know. If there's a quasi-resolution, meaning there's oil at 100, does that mean earnings go down 10% over the next year? I mean, right now, we've got 17% growth expectations for 2016 and 2017, and we're talking about an 18 multiple right now. If earnings go down 10% from there and the market goes down another 5%, then you're again, let's say, 18 times earnings. 17 times earnings, we think, is a place that you can buy the market, because there will be an end to this at some point. If you think about last year.
That's exactly what the people who are trying to remain positive are really hanging on. The idea that the multiple has already compressed to 18, 19 times, around 17% or so, but yet earnings are still projected to grow 14% year over year.
Pretty high.
You better have the earnings expectations, Surat, remain intact, or then you have to reassume where your assumptions are going to go.
Yeah, and I think, the key is the sustainability of this oil increase, right? Because if it does come in the next few weeks, we will then discount that earnings hit, at least for the next couple quarters, and say, okay, the long-term trajectory of oil is at 70 or 80 bucks, and that's really a one-off thing. But if this is kind of a sustainable, not only are you going to have earnings come down, you're going to have the future earnings come down. The consumer is going to, on the bottom of the K-shape, is going to get hurt. And then the fear is the top of the K-shape, if the wealth effect starts coming down, that could have a drastic effect on all the other parts.
But there's a lot of coulds, right, built into that.
Absolutely.
If this happens, this could happen. Maybe it's too early to get there. Now, I know for the sake of conversation, we need to have that discussion. Well, if this remains this way, then what if that happens? And then stocks would ultimately be lower. Mike Wilson of Morgan Stanley out with an interesting note today, which suggests he thinks the correction could be closer to the ending stages, Surat, than the beginning. The market is saying the cumulative probability of the paths to resuming tanker flow in the Strait are much higher than the recession probability, and we agree. We continue to see 7,800 on the S&P as achievable, assuming a recession is avoided, which remains our baseline, right? That plays exactly into the conversation we're having. As long as that doesn't happen, we still think stocks can perform pretty well. Is that the fair way to think about it?
I think it is a fair way to look at it, because we have more unknowns right now. But if there are some more knowns, then we look at kind of the internals of the markets and the stuff, the sectors that have done well. And Joe mentioned financials have done well, but they were down 12% before that. So you look at kind of the areas of the markets that have really been hurt, whether it's basic materials or some of the others, and you can kind of pull from the energy side. So I do think there's some potential there, and it's just, like you said, would wait and see right now.
You have had a fair amount of selling from the hedge fund community, to which, Goldman's desk is taking a look at that, and they say there's some signs of capitulation are starting to emerge, which if you consider it a contrarian view, it's like maybe the selling is getting a little exhausted. From that standpoint, last week, hedge funds net sold equities for a 6th straight week, and the fastest pace since April of 25, liberation period, obviously. On a trailing 6-week basis, the recent U.S. net selling by hedge funds, the 3rd largest over the past decade, and starting to approach the levels in April, May of 2020 during COVID, and to a lesser extent into Liberation Day. So people are trying to look at those signs as saying, okay, maybe we're really close to the end, rather than at the start of something even bigger and more dramatic.
Yeah, I don't disagree with that, but you also have to look at where the hedge funds came from. I believe going into that, they had very high leverage, like top leverage they typically take. So they're reversing that bet or taking that bet down. But look, I think the only thing that really gets it down meaningfully is if we do go after Iran's energy assets and put them out of commission, because they are a large part of OPEC. Or if we put boots on the ground. That'll be a major leg down. I do expect continued volatility, and I do believe that it continues to go down, but I still see overvalued. Now, take a look today at the GEVs, which I own, FTAI, Vertiv. all these stocks are going down pretty significantly today. So they're still looking for profit taking in those names. So where the selling is subsiding, like a Microsoft, I guess we'll talk about it later, where there has been a lot of selling. So the reason I bought Dick's, we go back to that, is because I think I went through the wars already. Stock's down significantly. Look, everybody knows consumers hurt now, so I see upside from there. So I still think it's a very tough time to put money to work in the market for the short term. For the intermediate term, depending upon where you are, you can do that, but not in battleground stocks like a Microsoft or in a GEV, which I still think is overvalued, even though I own, or a Caterpillar.
You need to have tech stabilize.
Absolutely.
Or this market's not going anywhere.
Absolutely.
Not with all the questions hanging over now the broader economy and the global economy with the spike in oil. Tech's just coming off its worst week in a year, right? NASDAQ's down 10 of the last 11 weeks. It's never done 11 in a row.
No.
Never. No. It's never done 11 in a row. Mag 7 over that period of the losing streak, actually last week, 800 billion plus thereabouts in market cap wiped from what these stocks have done, led by Meta, which was down 11.5% last week, Alphabet 9, Microsoft 5. Let's just get to Weiss's thing real quick, since you sort of teased it, and then we'll move from there. But you trimmed Microsoft. I mean, I asked you the other day. The stock's been horrible. Whether you were thinking about, if anybody who owned it that day that was on the show, anybody thinking about selling it, and you said,
Yeah, I've been thinking about selling it for a while, knowing full well that I could be making a short-term bottom in it, so I kept some of it. I didn't sell it all. But look, I just don't see the fundamental catalyst to get it higher. It could continue to bounce if the market bounces, but frankly, I'm exhausted by it. The software debate's going to continue for quite some time. I don't like the missteps they've had in AI so far. I don't parallel it to Google, Alphabet, where they were working on it, and something came to fruition. So I think at this point, that I'd rather have a very small position in it than have as big a position as I did.
Guys, what do you think? I mean, Sarat, some would look at this and say, well, maybe this is emblematic that these names have been washed too much, right? Even as Jonathan Krinsky puts a note out as we come on the air today and says, now the market's shooting the generals, right? A necessary but painful development. Well, maybe it was necessary, and maybe it has been painful, but maybe enough is enough. You own Microsoft,
I do,
for
and
example.
I own Google, and I own most of these, and I think, it is a clearing price for some people taking their profits. But I also think that these are really great cash flow companies with great margins. They have levers to pull. So if they see certain things in the market where it's demand, if it's data centers, it's et cetera, they have the ability. It's not like they have to go to capital markets all of a sudden to get cash flow, which could then in a credit crunch cause issues. They can pull back and they still have demand. So I do think that I wouldn't sell it at these levels because I think they've gotten down too much.
Hey, can I just add one thing?
Yeah.
I still have similar plays. I haven't shaved my Meta. I haven't shaved Alphabet. So I'm well versed in this area in my portfolio. So that's just one. It was just too much exposure.
The way that the multiples, Joe, have compressed here leads me to ask the question that I did. Have they been washed enough? For example, at the high, Meta's PE forward was 24 times. Now it's 18. Okay, that's a significant come down in terms of the valuation. Microsoft was 27.5. Now it's 20.5. Alphabet was 30. Now it's 24. We'll get to another one. Like NVIDIA was 25.5. Now it's 20. NVIDIA now trades, by the way, at a slight discount to the S&P on a forward PE, or right around par, for the first time in 10 plus years. It's the cheapest it's been relative to the S&P in some 10 years.
So I appreciate Steve's remark that he was still maintaining exposure in the Mag 7, because I think that's the right thing to do. First of all, I think you have to look at leverage at all times and look at positioning and understand As Steve said, we came into 26 with everyone extensively long. We've worked that off. Right now, the systematic bias is sitting at neutral. But I think it's a classic example of what's going to lead us out is going to be first in, first out. I think it's going to be technology. I think it is going to be the port in a storm, the safety that's provided by these Mag 7
first in,
names.
first out would imply that software is going to lead you out, not just technology.
I think it's universally going to be technology. I think it's going to be some elements of software itself, whether it's Adobe or Salesforce or Microsoft or Oracle. I do think some elements of software, yes, to your point,
Well,
they
you don't
have to
think
participate.
Why did you mention Adobe? Just a slip? You just pulled that out because you think that's going to lead you out?
Adobe's not a name that I own, but it is a classic example of one of the names that went first in. The valuation has gotten incredibly cheap. It doesn't mean fundamentally you resolve all the headwinds that are in front of it, but if the market is going to stabilize and we're going to see recovery, I think it can participate there. I think you're always looking at what are the indicators internally in the market that can suggest the turn. And I don't think it's going to come from continued buying of energy or buying materials. I think it has to come from some of the areas of the market that have been decimated, stabilizing and modestly recovering.
Carrie, Morgan Stanley says it's time to buy Meta. That's the quote on their note. They did cut their target to 775, 537 now. So whatever with that.
Yeah.
But like we're just talking about with Microsoft and some of these others, is it time to buy Meta? The stock's just coming off a dismal week.
If you bought Meta in the past when it's had this kind of drop, the same is true of Microsoft. Meta has had several severe declines. That would be a smart move. There have been two major declines in the stock, both of which were incredibly good buying opportunities. And with Microsoft, let's remember that it owns half, roughly, of OpenAI. I don't know what the dilution has been lately. That company at some point will come public. We're going to see the value. That was a smart move for them to make when they originally
Yeah, although
made
they're
an
now
investment.
warning of the risks as a result of that.
Well, I get it. I'm just saying.
OpenAI.
Yeah, but that's what today people are talking about. That will change. That narrative will change, and it will be seen as a positive for Microsoft when we're looking at OpenAI in a different way. So, I think people are scared right now, but it's an opportunity. If you don't own these stocks, I think both are attractive.
What about NVIDIA? Can we discuss this? Unless you have something to say.
I want to talk about Apple. I want to talk about Apple.
I'm going to get there. Just give me a moment, because I don't want to move off of NVIDIA after I read the stat that I did, that it now trades at a slight discount or at par to the S&P for the first time in 10 plus years.
Yeah.
A lot of people have said 170 is the line in the sand on this name, and that's where it can't seem to get to. What about this stock?
Yeah, so that's the big debate. And despite a great quarter, despite great guidance, investors aren't believing it. And not all investors, obviously, there are lots of shareholders there. But that's the debate. Is competition finally coming? We're actually seeing it coming in some areas. Are their chips too expensive? So that debate is going to take a while to get it resolved, because you do have these well-capitalized companies like Meta, like Apple, like Alphabet, and others, AMD, that are working on chips. And some of them come into commercialization. So that's why NVIDIA is not able to move off this level, like 175. It got to 180 briefly last week at a bounce, because their chips are so expensive that you can come in and price underneath, and you may not need all the power their chips have, assuming the new chips don't have that power, which the companies are saying they do.
That's a pretty big, dare I say, bear case to lay out.
Well, but that's the debate. That's the active debate and why the stock's where it is.
Don't you think of all the Mag 7 year to date, NVIDIA was the one name where everyone said there's resiliency there, and you're going to be hesitant to move away from that position last of all the Mag 7. I think that's what's in front of us right now. It is the last of the so-called generals that we're seeing a recalibration in terms of the valuation and the price performance.
I don't know. Look at the chart. It's been
The other debate
choppy at best.
The other debate on it is
better than the others.
That with their vendor financing, that they're financing all their customers.
Oh well, please. I mean, we could have an hour-long conversation
that's
about
part of the
risks
conversation as well,
and the alleged rewards of not just them, but all of those circular relationships that do exist. So Apple, I'll give you that now. By the way, Melius says it can reestablish itself as an AI toll, and $350 is the price target. They reiterate that and the buy. What do you think?
Boy, I sure hope so. Let's hope it could first defend what's going on in the moment. I said last week I bought it at 250, buying it against the point of reference of the 200-day moving average. Well, guess what? You're now below that 200-day moving average. If you could pull back that chart maybe over the last year and show the 200-day moving average. A critical price point here is January 20th. That's the 243 low. What do you not have in front of you? You really have to get to earnings very quickly. We're a good month away from hearing that to see if the continued recovery in China is underway or not. But I think NVIDIA and Apple, again, I'll reiterate this, I think these were the two names that people were most hesitant to move away from their positions because they believed in the long-term story. They believed in the put underneath the market for both of these stocks. And I think what we're just witnessing today is that last vestige of that bullish sentiment maybe neutralizing somewhat.
Apple was only down 2%, Sarad, over the last week. So much, haterade around this name and the AI lack of story. And then you started to have the stories emerge that, well, you know what? They're actually the only ones who aren't spending ridiculous amounts of money, according to some, on AI. So maybe that's a reward. Now maybe they're slowly starting to get their, mojo on part of what their AI story is going to be. And the stock has been, dare I say, rewarded for it.
And, the defensible position of Apple, for what you just mentioned, and also the cash flow and the recurring revenue and the services piece, that's one that the others of the Mag 7 don't have. So I think investors look at this as the safer of the big consumer. It's like a consumer staple in there that you just keep on having upgrades and you distribute and you get bigger and bigger. And the moat gets bigger as more people stay in there. So I think that's why you don't see that multiple kind of, the opposite, right? It doesn't get depressed. It's still growing, but it's growing 4-6%. But we know that it's a defensible position.
You still have issues in tech today. NASDAQ's just gone negative. AMD down almost 2%. Micron 7%, another 7%. Is that right?
That's incredible.
Broadcom down 2%. Yep, there's some of these losses. There's your Micron again. Now pull that back, pull Micron back like like a month, just for the sake of pulling it down.
It's down 26% since March 18th.
CoreWeave's down 7.5%. Intel's down more than 4%. There is the mountaintop. They saw the mountaintop at Micron, and now they've been steadily coming down ever since. That's a key question too within this market, whether the memory trade is, impaired for the foreseeable future. SanDisk was down 9.5% last week. Western Dig down almost 5%, and Seagate down almost 4%. $100 billion in market cap wiped last week.
Yeah, but this is the life of semiconductors. I mean, we know over time semis have been cyclical stocks, particularly these semis. So, they bypassed it for the last year or two, and now we're seeing the cyclicality has returned, and they benefited enormously, and investors are saying, oh, wait a minute, I don't want to be on the downside.
Cyber names, are they going to stabilize over the last week? Double-digit declines for many of the names there. Zscaler's getting a nice move today. Last week it was down 12%. I saw Palo Alto's Nikesh Arora buys $10 million in stock in the open market. That's an interesting move. Obviously a sign that he thinks his stock's declined too much. The stock's getting a nice move there as well. You sold most of your exposure here. I still feel like this is such a favored and hyped up group. You feel like that's changing?
No, I don't think so. I think the sentiment surrounding cyber is consistently bullish.
Is it?
Yeah,
I don't feel like it has been lately. It's been almost consistently bearish because of Anthropic and these new tools that Anthropic unveils seemingly every week. One of which has had a negative impact here. It's almost changed the endlessly bullish story.
Are the majority of your panelists and guests on the 3 o'clock show short cyber, or are they continuing to defend cyber?
Well, you have to be short it. Maybe
But
you're just not in it. You're not in it anymore.
I'm not. No, I'm not, because I'm reacting to price. That's what I do have. It's sell discipline that reacts to price. But the story and the narrative that I continue to hear as cyber keeps moving lower is about the fundamental tailwinds that rightfully exist. But that doesn't mean you can't see a recalibration on valuation, and that's ultimately what's been going on.
Why did you use the word rightfully? That's like you making the statement that the bullish narrative is still intact, whereas some question it as a result of AI and these new developments. If it's rightfully intact, why aren't you buying any of these more on the decline? Why aren't you buying them back on the decline, even personally?
Because there is a dislocation between price and fundamentals. Markets throughout its history will prove that evidence to you, and that dislocation can happen over a 3-week time period, a 3-month time period, or over a 6-month time period. And I think we're in the midst of a multi-month dislocation period where, for my strategy, I want to sit on the sidelines. I acknowledge and will return when price proves correct that the fundamentals are strong, but now's not the moment.
Has price and fundamentals disconnected from one another in private credit? Because those stocks have gotten punished. The Fed chair, by the way, was speaking this morning at Harvard, in which he was asked a great question by a student, I believe, in the audience, and gave an interesting answer. He said, we're watching it very carefully, looking for connections to the banking system that could lead to contagion. We don't see that. Doesn't seem to have the makings of a broader systemic event. Now, that mirrors, certainly matches up with what many have suggested, that yes, it could get worse. We're watching it very closely, but Surratt doesn't have to be systemic. How do you see this?
I agree. I mean, I think you've got the sell-off that came first. All of them got hit hard. They are contained in their own different funds, and yes, there will be some write-downs that we don't see because they're private markets, right? They don't do day-to-day. And I think it took down a lot of the banks, it took down a lot of the KKRs, Blackstones, et cetera. And really, until we see something other than some one-offs, I think even the Fed's watching it and saying, hey, yes, there is something to watch, but it doesn't mean you necessarily have to sell all these stocks.
Right, you think the financials, broadly have been hit. You bought more Goldman Sachs. Do you think it's been unnecessarily punished by some of these issues, just the broader worried about the economy or whatever else? Lack of capital market activity because of all this?
So it's best in breed. It's had relative outperformance to its financial banking peers. I think it thrives in this type of environment of hyper volatility. I think they're best in class in what they do. I'm sitting on a position since April of 24 at 398. I wanted to add some financial sector exposure. I don't feel, to your question previously, comfortable enough. And there's a strong degree of clarity surrounding the fundamentals of private credit to step in that direction. I have no exposure there. I would at some point. I'd probably look at Blackstone. But to me, Goldman Sachs is the clear winner in this environment, and it's proving itself with the price resiliency that it exhibits on a daily basis.
All right, let's take a quick break. We'll come back. We'll get into our calls of the day. I got a negative call that's really hitting the stock that Kerry owns. It's a new 52-week low we will discuss coming up. Welcome back. We do have some very interesting news regarding the upcoming SpaceX IPO. Let's get to Mackenzie Sigalos with those details. We don't even have a date of the IPO yet, obviously, but retail was said to potentially get a huge slice of this. What do you have here?
So Reuters is now reporting that SpaceX could cut Robinhood and SoFi out of its IPO as brokerages negotiate for a piece of the offering. E-Trade now apparently in the lead to handle share sales for those smaller retail investors you were just talking about, Scott. Hood shares initially plunging on that news, though they've pared losses. And of course, that move is getting extra attention because SpaceX is considering giving individual investors an unusually large piece of the deal, reportedly potentially as much as 30% versus the more typical 5 to 10%. The timing and size of this IPO is still fluid, but reports have said that SpaceX could file that paperwork as early as this week for a $75 billion raise at a $1.75 trillion valuation.
We have any indication as to why a decision like that would be made?
That's what we're looking into right now, and I'll come back to you with that.
Okay. Mac, thank you. That's Mackenzie Sigalos. What do you guys make of this? Anybody have a thought? Weiss?
Those are crazy numbers, first of all, on the raise. I mean, just unbelievable. And they'll probably get it done. Look, he's being very peculiar or particular about how he wants to run this. And he wants a lot of it to go to retail. He doesn't want to deal with institutional investors. So that's informing a lot of what he's doing. In cutting out Robinhood or SoFi, I have no idea why he would do that, except that he wants pure retail. He doesn't want to associate it with other businesses, possibly. So, don't know. It'd be interesting to understand why, but a lot of his reasoning we don't understand. So,
there is a call on Robinhood, Joe, so you must have some level of thoughts. You own the stock. Target goes to 130 from 160 today. Still outperform at Bernstein. Yes, it's obviously been weak of late. They take down their target multiple by, from 40 times to 35 times. Crypto's been an issue clearly, but what are your thoughts here?
So the diversification of the business model, which was one of the tenets for the fundamental support that many expressed surrounding this company, it just has not been visible so far in 2026. And as a shareholder, that's really frustrating to you because it seems back to that isolated story about where cryptocurrency ultimately might or might not go. Cryptocurrency is what broke the momentum fever in this stock. The stock's still up 58% over the last 52 weeks, which is remarkably strong momentum, but it was a triple-digit gainer, and it was crypto that broke it. You have to be able to see the visibility of the diversification story that this company keeps speaking about. You have to see it come into play and defend against the moments where you see that cyclical bear market present itself in crypto. That's when you get the all clear. You don't have that yet.
The SpaceX story that is moving here that Mackenzie had mean anything to you?
I don't like Steve. I don't understand the reasoning behind it, but again, it's clearly not providing a tailwind that's much needed in this environment. I don't understand the reasoning surrounding it.
Let's move to the stock that I teased before we went to break. It's Boston Scientific. It got downgraded today. Now, it was its strong buy, and it's only downgraded to outperform. So we're not talking about a tremendous move down by any stretch. The target goes to 88 from 97, so significant upside still from here. It's a 52-week low, and it's down 17.5% over the last month. You own the name.
Yeah, we just bought the name because we thought it had come down so much, and at 16 times earnings, we thought this is an attractive entry point. I mean, the device business is solid. They might have some timing issues with electrophysiology and the Watchman device, but we believe it's going to happen because they're best in class. So BSX, yeah, tough time to buy it. We wish we had waited, but it's more attractive at this price here.
Bristol Myers reiterated by Surratt, $70 UBS. That's you.
Yeah, I mean, it's a tale of two cities, right? When tech goes on fire, other sectors like the growth sectors go, nobody cares about pharma. Now we've got stable cash flows, we've got a good pipeline, we got a growing dividend. Stock's up 12% a year. We like this one. We've owned it for a while, but it's been a patient story. And, you could see money come out of this if you get the rotation we talked about earlier as well. But we think it's a long-term hold.
You've had money coming out of, speaking of, American Express. Wells Fargo reiterates outperform today, 425. They say buy. buy it on the weakness. What do you think?
I like it. I mean, look, they're in the right space with their consumers. They really have this attachment rate of a lot of people buying not just, the platinum card. And I think it's a sell-off just as the cyclical economy. It's the first one to go because if people aren't traveling, they're not spending, you sell now, ask questions later.
All right, Pippa Stevens has the news update for us today. Hi, Pippa.
Hi, Scott. An oil refinery in northern Israel was struck during an Iranian missile attack this morning. According to Israel's Fire and Rescue Service, debris from an intercepted attack directly hit a tanker at the facility. Large flames and thick black smoke were seen at the refinery that has been targeted in previous Iranian attacks. No casualties were reported. Air Canada announced today that President and CEO Michael Rousseau will retire this year. Rousseau faced criticism for his English-only condolence message after the deadly crash between an Air Canada jet and a fire truck at LaGuardia last week. Canada's largest airline is based in French-speaking Quebec. The board of directors said the ability to speak French will be a criteria they look for in the company's next leader. And more than 400,000 Kit Kat candy bars have gone missing in Europe. Nestle says the vehicle carrying about 12 tons of the candy bars is nowhere to be found. The shipment disappeared last week while on its way to Poland for distribution. I guess someone has a big sweet tooth, Scott.
Yeah, to say the least. Pippa, thanks. Pippa Stevens. Coming up, searching for stability. One firm out today with an interesting new list of names they think could outperform in the coming month. We'll tell you what they are, and we'll give you the trades next. All right, welcome back. Evercore came out with a list today, an actionable one for stability, they suggest, of names best positioned to outperform should a more stable, macro environment emerge in April. Ulta, Pulte Group, Coca-Cola, Delta Airlines, Baker Hughes, We'll start there. Surat, Delta.
Listen, Delta hit a high of 70 at 64. Given what's happened to all the cyclicalities of all the other stocks, it's held up the most. Planes are still flying. Ed Bastian came out just a week ago saying you're still seeing strong demand. And I think, again, to the point we talked about before, if oil does come back down, this airline trading at 6 times earnings has a much better trajectory than all its other competitors, and the demand is there.
It's a gutsy call. You have to have something happen for this theoretically to work out. Pulte Group, another one, right? Rates have backed up. Mortgage rates have gone up.
Yeah.
These stocks have come down.
You know, it's. I guess that's all we have right now in this environment where we have such hyper volatility and lack of clarity. We're relying on relative outperformance. We're relying on the fact that Delta has held up. We're relying on the fact that Pulte, relative to a lot of the home builders, has held up as well. But again, there's binary obstacles in front of all of these companies. And for Pulte, they need the rate cuts. The rate cuts have to ultimately be coming. We have to have an improvement in the housing environment. Here we are, spring selling season. I'm not so sure how active it ultimately is going to be with the elevated private sector borrowing costs for mortgages.
Weiss, Caterpillar on the list.
I wish. I mean, you know, to me, as Vert, I was playing momentum in data centers here. The stock is not attractively valued at this level, so
It's very expensive.
Yeah, so I wouldn't be surprised to see more downside. You know, I'd say those names, all those names on that list, pretty much are ones that have bit the dust. So they're saying they can't go down more is the reason to buy it. Not that they're typically stable names. I don't believe they are, with the exception maybe Coca-Cola.
What about Danaher, Surat?
Look, a Danaher, Thermo Fisher, high quality businesses, really the effect of, you know, what's going to happen to the administration with the RFK, but then also internationally and government spending. I think these are ones you own for 3 to 5 years at least. They're terrific compounders and high quality businesses.
What about Uber, Joe? Uber is on this list?
No.
No?
Nope. Unfortunately, I don't see it. Look, in the names we're reading,
Not on Joe's list.
to me, it's energy. Uber's broken down. It's energy. It's maintaining your energy exposure, even if there's some form of resolution. There's oil prices are not going to implode down to $60 that quickly and return to where they were. There's still
I don't
going
think
to be.
they have to, though.
There's still going to be
that's
challenges.
A huge relief.
Yes. There's still going to be challenges in front of us as it relates to energy, the consumer staple names, the Coca-Cola, the Monster beverages,
Coca-Cola's
those Pepsi.
on the list.
Those are that's where you find the stability in the market. And there's one sector that I don't find on this list that I think you should be looking at, and that's healthcare. Because healthcare provides you that degree of stability in this type of hyper volatility environment. It proved itself in 2022.
The bet here was, let me find stocks that have been crushed, and I don't think will go down anymore, rather traditionally stable names aside from Coke.
All right, we'll take a break. We'll come back with Santoli on the other side in his midday word. All right, welcome back. Senior markets commentator and overtime co-anchor Michael Santoli joins us now for his midday word. Is this more to do about yields just getting off the boil than certainly anything related to the war, because there really haven't been any significant developments and oil's up?
Yeah, I think that's the most immediate relationship is, yields coming in a little bit. I do think you can be mindful of this pattern that has been in place for a little bit, where you have heavy selling Thursday, Friday, just a little bit of relief on Monday if you don't get, incremental escalation. I think people should keep in mind the S&P was down like 220 points Thursday and Friday, and so you're up 20, whatever today. So I do think that you have to keep it in perspective. But yeah, you can better handle $102 WTI if yields are going to come in a little bit and you're no longer feeling as if you have to fight that front as well, and the Fed's going to become hawkish. Everyone recognizes we've had a pretty good reset in terms of prices and valuations and sentiment and all the rest of it. Yeah, I agree. You haven't seen super extremes where it doesn't matter what tomorrow's news brings. But time is kind of a tyrant here. Everybody gets that too. If you don't get a little bit more oil flowing and more shipping loosened up, then you're going to have something else to deal with. So I think we're kind of holding pattern. There's going to be rallies. They're going to be violent. They're going to be tempting. I think there's a high burden of proof for whether they're real.
That's true. I mean, super extremes on that note. There's almost, I could say, well, there's no reason to have super extremes because until the earnings picture changes, and it hasn't, why would you?
I agree with that generally, and I've been very, very kind of clear in saying I think the market's been rational in not kind of moving off this idea that this could be somewhat contained and the fundamentals could hang in there. I do think that the earnings forecast in semis going up a huge amount in the last few weeks, and also energy, are flattering the fundamentals. And so we haven't had any other companies update us or anybody work through the cost increases that are going to happen. And so maybe you have earnings that are a little bit overstated, therefore PE's a little bit compressed beyond reality. I'd also point out when it comes to the NASDAQ, people saying tech is cheap. Everyone was justifying 30 PEs 6 months ago because these are such wonderful asset-light businesses, and now they're not. The free cash flow story's gone, so it's a little tougher, I think, to make the call that they're dirt cheap.
All right, I'll see you this afternoon, Michael. Thank you. That's Mike Santoli once again. Coming up next, we will talk about some stocks that are on streaks. It's not all losing streaks, by the way. I'll tell you about it next. Let's talk about some streaks. Lido Swice, 9-day losing streak it's pacing for.
Yeah, look, I spoke to the company last week because I'm bothered by it.
What did you say? What the heck's going on here?
It's a core position, yeah. And, you know, not a lot now. They slightly missed last quarter, even though I thought it was a non-event. But it's software debate that's hitting them as well. So while a lot of them just know them for the scanners you go through at the airport, it's really that debate. Can what they do be done through AI? I do not believe so, but that's what's going on. And unfortunately, you're going to need a really good quarter to come out of this.
Surratt, Disney trying to snap a 5-day streak.
Yeah, new CEO. I mean, it's 15 times earnings. I like it, but the negatives right now are overwhelming. So I think long-term investor, you want to own this and buy.
Costco's going for a 5-day win streak, Joe.
It is. Costco really strong, Walmart really strong, TJX, only consumer staple name that's better, Hershey Corp. Own that as well.
What about CF, which is trying for 5 days too?
I'm using a 119 stop on my position that I established at 104 on March 2nd. We continue to have challenges as it relates to fertilizer and urea exports. Right now, corn prices are down 10% year to date. You're seeing a shift in planting go from soybean to corn to plant corn. You need the urea. CF is a producer there. Should continue to move higher.
All right, we'll take a break. We'll come back with final trades on the other side. We've got Rick Reeder from BlackRock with us today, 3 o'clock on the closing bell. Big interview. Get his up-to-the-moment take on future rate hikes, cuts, something.
He's going to say cuts.
Well, he sort of tipped his hand. We'll talk to him more about that, too. We look forward to that. Steve Weiss.
An unstable healthcare name, United Health. I think it's discounted a lot of bad news.
Okay. Oh, wow. Green across the board. When was the last time we had final trades where it was all green? Feels like it's been forever.
When was the last time we had green across anywhere?
Right.
Morgan Stanley, I think it's been beaten down too much with the credit and the capital markets activity.
All right, Care.
Same vein. Blackstone stocks 14 times earnings, down 45%. Nice growth ahead.
Okay, Joey.
Hiding out in the safety of insurance in the financial sector, Allstate. No technology names up there, huh?
No. We'll watch all of it. I'll see you at 3 on Closing Bell.
Scott, thank you, and welcome to The Exchange. I'm Leslie Picker, in for Kelly Evans today. Stocks higher, but off session highs this hour as the president says the U.S. is in serious talks to end military operations in Iran. The Dow up more than 200 points, still on track for the worst month in 3.5 years, along with the S&P. Tech lagging once again, with the Nasdaq dipping in and out of the red today. Yields have turned lower as well, with the 10-year back down to 4.3%. Oil prices, though, still elevated. WTI hitting a 3-week high earlier, trading at $103 a barrel, Brent at $112. And while the U.S. and Iran may be getting closer to a deal, aluminum shares are spiking on new attacks that damaged major Middle East facilities over the weekend. Alcoa on pace for its best day in 5 months. And Iran is where we begin, of course. Megan Casella is in Washington with the latest. Megan.
Hey, Leslie, so that's right. The president kicking things off earlier today, suggesting there are real diplomatic negotiations taking place with Iran. But he is also threatening to destroy Iranian energy sites if a deal is not reached soon. He posted on Truth Social, the U.S., quote, is in serious discussions with a new and more reasonable regime to end our military operations in Iran. Great progress has been made, but if for any reason a deal is not reached shortly, which it probably will be, and if the Hormuz Strait is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island, and possibly all desalination plants. Now, Leslie, at the same time, Iran is continuing to refute the idea that serious talks are happening. An Iranian Foreign Ministry spokesperson telling MS Now earlier today, U.S. officials say whatever they want. We have not had any negotiations with the U.S. And all of this comes after U.S. Special Envoy Steve Witkoff said late on Friday that the administration thinks there will be meetings this week and that they are certainly hopeful for it. So still some major questions as to when and where those meetings will happen, as well as who exactly would be involved. I will flag White House Press Secretary Caroline Leavitt is set to brief reporters sometime this hour. You can see a preview there, so we may learn more then. Leslie?
Yeah, of course, it's hard to make sense of everything with the U.S. saying one thing, Iran saying another thing. What do you think the appetite is for actual boots on the ground in the region?
That's one of the biggest questions that's out there. We know that the Pentagon is preparing for this possibility. The reports are that there are some 50,000 troops, U.S. troops now in the region. That's up from 40,000 that are there all of the time anyway. We also saw reports over the weekend that the Pentagon is preparing for possibly weeks of some sort of deployment, probably not a full-scale invasion, something less than that. We don't know, though, what exactly that will look like or if we'll get to that. I will flag Secretary of State Marco Rubio earlier this morning on ABC did say that they are still looking for diplomacy, for negotiations. That's how they would prefer to move forward here, but that they have to preserve all of their options.
All right, Megan, thank you so much. Megan Casella from Washington. My next guest says the Houthis getting involved increases Iran's leverage on several fronts. Joining me now is Jonathan Panikoff, director of the Snowcroft Middle East Security Initiative at the Atlantic Council. Jonathan, why does the Houthi involvement change the game here?
Look, I think there's a couple of concerns. First of all, obviously, there's direct strike issues. If the Houthis are going to target Saudi Arabia, Saudi energy infrastructure in retaliation, should the United States actually take a ground invasion approach? I think there's a second part of this, which is, look, the markets have built in for a while from a historical precedent of the Houthis, frankly, using the Bab al-Mandeb as leverage in the same way that the Iranians are now using the Strait of Hormuz as leverage. But the problem is, given oil where it's been, given the restrictions, there's going to be a serious challenge if you also see a constriction through the Bab el-Mandeb for oil markets, through out-processing. It's going to be a challenge all the way around. And so it just creates a new dynamic that potentially could really complicate the situation and make it even more challenging.
Yeah, could you explain that to us? Because, you know, obviously over the last few weeks, few years, we've come much more acclimated to the importance of the Strait of Hormuz, but you know, the other one is less well known in terms of its impact on global energy, global trade, and so forth.
Yeah, so you have had traditionally about 10 to 12% of oil running through the Bab el-Mandeb. And now that you're seeing the Saudis, frankly, increase through the east-west pipeline over to Yanu, the capacity out into the Strait of, into the Red Sea, through Suez, you've got this question going both directions on what the challenge is. So the Saudis come out through the Red Sea, go south through the Bab, but Asian goods, for instance, any manufactured goods, electronics, things going to Europe are going the other way, through the Bab el-Mandeb north through the Suez. Either way, you have significant challenges if the Houthis are involved because they're going to constrict it and use it for the same sort of leverage. That now means that you're taking, maybe instead of having an issue of 25% of oil off the market, 33% of oil at the top end, that makes it much, much harder all the way around.
As we think about the next steps here, it's clear the administration prefers diplomacy, at least that's what they've said, Marco Rubio has said. What do you think the red line would be for further attacks in the region, Karg Island and other assets that would impact oil assets?
Yeah, there's a little bit of a challenge here because the Trump administration looks like it's planning for two different types of operations. One is more immediate, which is you're talking about Karg Island, or you're talking about Greater or Less of Tunab, which are smaller islands in the strait, or actually trying to have some sort of force deal with Iranian assets, military assets along the coastline of the strait itself. Look, it's pretty clear the U.S. could certainly do it. It would be a challenge. It would not be an easy operation, but it's clear what it would be. The issue is long-term in terms of, well, then who holds it? What is the long-term structure of that like so that you can have, frankly, the ships passing through safely? The juxtaposition is the U.S. is also talking about the highly enriched uranium and going in, and that becomes a much more concrete idea of what needs to happen. But the operation would be so massive in scale as a special operation, either one would be a huge challenge to the Iranians. They would not be happy about it, and you'd almost certainly see retaliation.
Do you think the Gulf states have broad consensus over what should be the next steps in this war?
I think it's starting to fray. I think you had consensus earlier, but look, I think folks like the Emiratis, probably the Saudis, really do want the U.S. to keep pushing ahead. They want to get to a point where Iran cannot be a meaningful threat to them. They do not want to go through this again. Others, then I think we've seen this in reporting, certainly the Omanis, probably the Qataris, are much less inclined to keep going forward. They want an off-ramp. The longer this goes, the more likely you're going to start to see those frictions come to the surface even more. But right now, I think you're already starting to see some of the divisions.
What do those divisions, what do those frictions mean for the leverage that the U.S. has? We talked about the leverage that that Iran gains from the Houthis' involvement. What about the fraying of the consensus between the other Middle East partners?
Look, it certainly makes it harder. If the Iranians know that they can try to pick off one or two or three of the Gulf states to try to go towards negotiations, then it's obviously significantly more challenging if the GCC is a unified bloc. The reality is that at this point, we're just not going to probably be able to keep seeing it going forward in the way that we had. It's not impossible to get them to hang on, maybe in a more unified public manner, but even behind the scenes, you're starting to hear rumors of different countries going to the Iranians, going to each other, with frankly different perspectives on how to go forward and what should come next. So if you don't have a negotiated settlement, the Iranians just see this as another means to increase their leverage, frankly, and that means, frankly, in a zero-sum game right now, it's going to be negative for the U.S.
All right, thank you for breaking it down for for us Jonathan Panikoff, the Atlantic Council. It's a super complicated, quickly moving situation. Oil prices moving higher on the Houthis' involvement and on the president's threat to obliterate Iran's oil wells if a deal isn't reached soon. That's sending WTI to a 3-week high, Brent trading at an 11-day high. And my next guest doesn't see any light at the end of the tunnel and says consumers in the U.S. could start to feel an even bigger impact. Joining me now to discuss is Denton Cinquingrana, Chief Oil Analyst at Opus. Denton, no light at the end of the tunnel. Why is that, and where do you see prices settling from here?
Yeah, so no light at the end of the tunnel. Originally, we were being told about 4 weeks for this to take place. Now it's another 4 weeks, so you're looking at probably like 8 to 10 weeks. Obviously, lost production, lost barrels of oil moving. You have diesel prices in the United States well over the $5 a gallon level. Pushing towards almost $2 above where they were at this time last year. That's going to have an economic impact where shippers are going to be charging diesel fuel surcharges to customers, and at the end of the day, that's going to be passed on to the end user, which is you and I, when we're buying stuff at the stores.
Yeah, and reading your notes in preparation for this segment, I see that you believe that the gas prices could accelerate within the next 24 hours. You made me want to go fill up my car because they have been plateaued at below $4 a gallon, but you think that will change just within the next day?
Yeah, and again, we're at $3.98, $3.99. You don't have to be Nostradamus to predict that we're going to get another penny or so move up over the next 24 hours. You look at the futures market, that's moving higher. Spot markets are moving along with that. So it's pretty much almost a layup or a UConn buzzer beater to beat Duke, which makes everyone happy. Getting over $4 a gallon.
I'm in a line eye myself, but so it's a good weekend.
Yeah.
One thing I want you to help us put into perspective is just how levered the U.S. economy is to oil prices today versus a decade ago or 2 decades ago. Obviously, we feel it when we fill up our tank at the pump. There's no denying that. But in terms of just how much it matters what the spot price is, given, the U.S. is energy independent. I know it's a global market, and therefore that, doesn't necessarily help things with the price. But, in terms of just the overall leverage to the broader macro picture here.
Yeah, and again, the global economy runs on oil. Economies run on diesel. You get diesel from crude oil. We've really been kind of insulated from this in the United States, even though WTI is over $103 a barrel. You have several other grades of U.S. crude that are over $100 as well. But really, the shale revolution that really kind of started about 10, 15 years ago has really insulated us from this. We've really weaned ourselves off of Middle Eastern oil to the point where we're only bringing in, about 600,000 barrels a day from Middle Eastern countries from the Persian Gulf. A lot of it's domestic, and our largest exporter to the United States, as we all know, is Canada. So we've really kind of pulled back on the amount of Middle Eastern crude oil, and that's insulated us. But again, you mentioned it, it's a global market. It's what's going on right now, and I've used this phrase and I'm kind of getting sick of using it, but it's the tide that lifts all boats.
What about the boats and the countries that do tend to use more Iranian oil, say China? What does this all mean for them?
Yeah, and especially with President Trump's threats to Iranian oil infrastructure, about 90% of Iranian crude goes to China. Obviously, if that's destroyed, China's going to have to come to the more, kind of open markets or non-sanctioned markets. Iranian oil has been sanctioned for a long time now, and China was one that did not recognize Western sanctions, so said, hey, it's cheaper, we're going to buy it, and that we're going to do what we want to do on that front. So again, China would have to come to the more open market, but you're seeing the real impacts in Asian countries. They're already taking steps to kind of reduce demand, and COVID back in 2020 kind of gave regulators the playbook of how to really reduce demand, keeping people home, 4-day work weeks in some countries in South Asia, working from home, etc. Trying not to use gasoline where possible. I think I believe it's Vietnam, trying not to use air conditioning. That's going to be a tough one, but you know, in government offices, you don't have to wear a suit. You could wear, I guess, t-shirts and flip-flops to try and stay cool.
Yeah, it does feel like deja vu in so many ways. Denton, thank you so much for breaking it down for us at Opus. Really
My
appreciate
pleasure.
your
Thank
time.
you.
Thank you.
Absolutely.
Coming up, the S&P trying to stay out of correction territory, and our next guest says the street's strong earnings forecast should help it avoid that. The names he likes and where he sees stocks going from here next. Plus, KKR's co-head of global private equity will join us on the heels of one of the firm's most successful bets on record. We'll get the details behind the deal and his take on the state of the private markets. With KKR shares on track to close out their worst quarter in 15 years. The Exchange is back after this.
This is The Exchange on CNBC.
There's sort of downside risk to the labor market, which suggests keep rates low, but there's upside risk to inflation, which suggests maybe don't keep rates low. You've got tension between the two objectives. And I think to try to expect unanimity at a time like that, where it's really quite historically challenging, it would almost be misleading to be really confident in which way that should go.
That was Fed Chair Jay Powell speaking at Harvard today on why the next Fed move could be either a cut or a hike. But despite the uncertainty about monetary policy and the Iran war, my next guest says he remains optimistic about market fundamentals. Joining me now is Sam Stovall, Chief Investment Strategist at CFRA. You remain optimistic. See, yes, there's uncertainty. It explains why there isn't necessarily consensus. I also hear the risk of stagflation there. So how do you kind of square all of those various risks with how to play the equity markets right now?
Hey, Leslie. Well, I think what you really have to do is look underneath the surface to see what is working or certainly not working very well. As we head into April, which is among the strongest months of the year, we are certainly seeing stocks, sectors, and sub-industries that are trading at very low relative strength index levels, so levels below 30. Also, when you basically just see how many people are talking about that we are expected to see stagflation, a global recession, et cetera, it sort of indicates to me that maybe we could end up with a bit of a favorable move, counter-trend move, at least for the near term in April. And what could end up driving that is the expected 12% gain in S&P 500 earnings.
Yeah, it's hard to believe that we're already about 2 weeks away from earnings season to start once again. You know, how do you think the market will sit with both, you know, what they see from the fundamental side with the earnings as that season starts to begin against the backdrop of war, the risk of, you know, of inflation from here with oil prices, the risk of a potential hike? I mean, how do you think the market will suss out all of those various factors?
Well, I think it'll discount a lot of the earnings that have been reported to say that's backward looking. Now, the real question is what's going to happen going forward? Is Wall Street too optimistic about 2026 estimates, which are now about 16%, versus 2027, which is about 17% earnings growth? So the worry is that maybe all of that has to be trimmed. But the one thing that continues to surprise me is the resilience of the overall market. It took us 50 days to move from the all-time high on January 27th down to the 5% decline threshold on March 18th. Going back to World War II, anytime that we took 40 days or longer, we never fell into a bear market. Also, we have yet to eclipse the 10% threshold, and going back to 1980, anytime that we went beyond 50 days, and right now we're at 62 days, beyond 50 days to cross that 10% threshold, we also did not fall into a bear market. Obviously, that's not a guarantee, but it certainly is an encouraging statistic.
Yeah, it speaks to your point about the ephemeral nature, or at least the ephemeral response from the market as it pertains to the geopolitical condition. In terms of specifics here, you like Broadridge and Deckers, they've each sold off pretty significantly over the last year. What do you think the market is missing about those names, and what do you think propels them higher?
Well, I'm not necessarily sure that they are missing something, but rather maybe they've overdone it. You know how technicians like to look for indications that the market has thrown the baby out with the bathwater. So what I did was I looked at those sub-industries within the S&P 1500 to say which ones are trading at RSI of 30 or lower. And many of these, like footwear, is at 26. In terms of data processing and outsourced services at 23. So a company like Deckers Outdoor, we have a strong buy recommendation on because it's got two great brands, Hoka and Uggs, above peers in terms of margin growth and a strong balance sheet. And when it comes to Broadridge, shares remain attractive in our opinion because of its large cut of multi-year reoccurring contracts. So basically some longer-term opportunities and maybe even take advantage of some short-term weakness.
And you also like Alphabet, which is up 75%. What do you think catalyzes that one higher from here? How much more room does it have to run?
Well, we're encouraged by the company's valuation, its free cash flow potential, and we also believe that Google can sustain its 13 to 15% revenue growth through 2027.
All right, Sam Stovall with CFRA. Thank you for coming on today.
My pleasure. Thanks.
Coming up, Palo Alto Networks CEO is buying $10 million worth of shares amid the sell-off tied to fears of AI disruption. But it's not the only cyber name getting a vote of confidence from Wall Street today. We'll reveal the name ahead. Welcome back. The S&P and NASDAQ hovering near session lows while the Dow is pairing its earlier 460-point gain. The Russell 2000 small caps underperforming the major averages today, but coming off its first positive week in 5. Here are some movers this hour. Fannie Mae and Freddie Mac shares soaring after billionaire investor Bill Ackman singled them out as, quote, stupidly cheap late last night on X. They're up nearly 40% on his bullish comments, but still about 60% off their recent highs. Memory stocks are getting crushed again today. Seagate, Micron, and Western Digital are the worst performers in the NASDAQ 100 today. This despite JP Morgan initiating Seagate as overweight, seeing 40% upside, citing a margin expansion story. And oil prices, yes, they are climbing once again. WTI crude back above $100 a barrel, while Brent is topping $113. That has gasoline prices on the verge of topping $4 a gallon, up more than $1 since the start of the Iran war. That's on average there. While drivers are already feeling the pain at the pump, shoppers are about to feel the pinch from another part of the world, Chinese manufacturers. Eunice Yoon has that story for us.
Pickleball paddle producer Devi Wei has a message for American shoppers. Americans will have to pay more, he says. Because of the swings in oil prices, the Chinese businessman has had to hike prices on his paddles and pickleballs by as much as 20%. I might have to go even higher, he says, maybe double if the Iran war doesn't stop soon. Mr. Wei's goods are made from plastics that are derived from oil.
But the war in Iran has stalled shipments of oil and its products through the Strait of Hormuz. And that's raising concerns among manufacturers here about a further disruption to the global supply chain.
At this Beijing trade show, ballooning oil prices is the buzz. James Lee, who sells a third of his scarves to the U.S., has marked up these ones by 5%. This scarf is 30% polyester, he explains. We will definitely pass on the extra cost to our customers. Toy maker Wang Mingming is hoarding 2 months' worth of PVC, a plastic polymer, but isn't sure he can hold off charging more for his figurines. In our industry, these materials are almost irreplaceable, he says. If oil prices rise any further, we really won't be able to manage. But perhaps the biggest worry is how costlier oil takes cash out of consumer pockets worldwide. More money for gas means less for Wei's pickleballs. Ordinary people are getting squeezed the most from the high oil price, he says. Their spending power just isn't what it used to be.
And that poses a challenge for China's leadership since the economy, with its massive trade surpluses, is becoming more and more dependent, Leslie, on exports.
Absolutely. Great package there, Eunice. Can you also remind us just what the inflation picture looked like for China going into the war?
The inflation picture from a Chinese perspective is looking quite comfortable because they have more of a deflation problem. So it actually looks as though they might themselves start seeing some prices picking up over here.
So is that, obviously they've had the deflation problem, they've had the real estate issues and some other macro struggles as well. So in terms of inflation, how do you think policymakers there are viewing it?
Well, in terms of inflation, it's still something that the Chinese worry about. I mean, from a factory perspective, they're more concerned about deflation and a lot of the price competitiveness here. But I think people are very closely watching what's going on with oil. I mean, from a diplomatic standpoint, the government here, it appears as though they're feeling some pressure. I mean, they have sent an envoy to the region. But I think what's interesting is also what they're not really doing, which is they're not really pushing themselves to be a party that would be heavily involved. In fact, that envoy who did go to the Middle East did not visit Israel and Iran, even though the Chinese have been on the phone with many of the parties. And then another thing that's, of course, interesting here is that the Chinese have plenty of oil reserves. I mean, the estimates have been that they have like 3 or 4 months worth, but it's still unclear whether or not they're going to release that oil, and they haven't really done a whole lot for the manufacturing sector or for other companies, for that matter.
A lot of cross currents there. Eunice, thank you for breaking it down for us. Eunice Yoon. Time now to go to a CNBC News update with Angelica Peoples. Angelica.
Hey, Leslie, heavy rain that
heavy rain that triggered severe flooding and landslides in Afghanistan and Pakistan has killed 45 people over the past 5 days. 74 others were injured and 130 homes were completely destroyed in the storm. Authorities are warning that conditions remain unstable in the region, citing the continued risk of rain and flooding. Eli Lilly has reached a $2.75 billion deal to bring drugs developed using artificial intelligence to the global market. The company announced they will partner with Hong Kong-based Insilico Medicine. Insilico has already developed at least 28 drugs using generative AI tools, half of which are already in clinical stage trials. And preparations begin today for NASA's historic Artemis II mission. 4 NASA astronauts say they are, quote, ready to go on the 10-day journey around Earth and the Moon. The crew was originally set to launch in February, but work to fix a hydrogen fuel leak and the rocket's upper stage propulsion system has pushed it to Wednesday, April 1st. So we'll be watching to see how that goes. Leslie, back over to you.
Absolutely. I can expect some good pictures out of that one. Angelica, thank you. Coming up, KKR's co-head of global private equity will join us from one of the biggest deals in the firm's history, at least in terms of return on equity, turning $270 million into nearly $5 billion in just 3 years. The details and what it says about the state of the PE industry next. A rare bright spot in the private markets these days, KKR making 15 times its investment in a company called Cool IT, which recently sold to Ecolab. 3 years ago, when KKR took a majority ownership in the data center cooling business, it gave employees a stake as well. Shortly after announcing a sale to Ecolab, the firm's employees learned about their payouts. Here you can see their reactions. The average payout was $240,000, and the most tenured employees received up to 8 times times their annual salary, a minimum of $380. For more on this deal in the state of PE, let's bring in Pete Stavros, partner and global co-head of private equity at KKR. Pete, congrats on the deal. It's a top 3 deal for the firm ever. Also, for further validation of the employee ownership program, which you have been a long-time and early champion of. Of course, it also happens to be a service provider to an area that's skyrocketing, which is data centers. So I'm just curious kind of what you attribute the success of this deal to, and do you think it's repeatable?
Well, thanks for having me. We hit the right wave at the exact right time. So we bought the business in 2023. Obviously, data centers and AI have exploded since then. This is where everything's going. We worked with the management team to double the workforce, 10x the capacity. The earnings of the business went up tenfold. So this wasn't just a matter of multiples went up and we got lucky. Of course, we were fortunate. But it was great to see workers be fortunate as well. You know, when good things happen, the owners benefit, and here nearly 700 frontline folks got a chance to benefit as well.
In the PE industry right now, exits like these are rare all the time, any cycle, but exits in general are down. In terms of dollar value, they were up in 2025, but in terms of number, they were down about 9% last year. And I'm just curious how you found the exit environment when you were going through it with Cool IT. Do you feel like things are getting a little bit more unclogged, or is it still kind of the same bid-ask spread dynamic, the valuation, mismatch that we've been seeing over the past few years?
Well, this was unique. I mean, this was an absolute frenzy. We had 6 major companies dying to own it. Everyone was putting in phone calls to the firm, anyone that they knew, trying to get a leg up on the process. I would say more typically these days, the exit environment is not as robust. I mean, back in 21 and 22, when the market was really hot, if you had even a decent business, there'd be 6-10 people who wanted to own it. Today, a lot of exit processes, there's a couple. So it's more of a buyer's market. Private equity's gone through a cycle in these last 5-6 years. In 21 and 22, the private markets were on fire. And a lot of our peers overspent during that period of time. So there was at exactly when the 10-year was 1%, multiples were high, people overspent. That's created a bit of an overhang in the industry, and now it's the other side of the coin. There's not as much dry powder, not as much new money chasing deals. So it's an interesting time to deploy. Exits are a bit harder for the industry. Now, I do have to say, I expect this year to be an all-time record exit for a series of exits for KKR. Year to date we're only in March, we've already signed up 10 exits. We haven't announced the aggregate dollar value, but it's in the many billions. And I think this could be the greatest exit year we've ever had.
Exits in terms of dollar value or number or
dollar
both?
Value.
And is that just because of the vintage of the fund and because of the environment you think you can sell them into?
Yeah, so in that 21 and 22 period of time when our peers overspent, we had learned that lesson 4 fund cycles ago. So one of the great things about being KKR is you've been around 50 years, you've kind of seen everything. And the firm's good about learning from mistakes. So when we overspent prior to the Great Recession, we put in place a process where we would linearly deploy our funds. So if we raise $10 billion, we're going to deploy $2 billion a year for 5 years. That means when 21 and 22 happened and the market was on fire, our process required us to be constrained. And so we are not overweight the bad vintage years. We've more evenly deployed. We have that same bias on the exit. So once we've basically accomplished most of what we came to do with a company, we head for the exits. So right now, we're exiting businesses from that, let's say, 29 to 22 period. We're starting to exit those now. And as I said, we were already off to a great start. It's just March and we've got 10 deals out the door.
So constrained on deployment, but not on exits.
Not
obviously.
on exits, yeah.
I want to turn to the private markets industry. It's gotten a lot of attention, obviously, over the past few months. There's been some consternation about private credit and the health of the borrower class. And as the global co-head of PE, you oversee portfolio companies that service a lot of private credit originated debt. What do you make of the noise relative to what you see in your own portfolio in terms of just the health of these borrowers, the health of these sponsor-backed companies, especially since PE is subordinate to private credit?
Yeah, so we've seen, we've had a long stretch of double-digit earnings growth in the portfolio, including the last 4 quarters. I always hesitate to say that that is reflective of the broader economy or what's going on more broadly, because our strategy is, we are constructing pretty unique portfolios. We're not really reflecting the economy. There's whole parts of the economy we don't participate in. And then our earnings growth is largely driven by operational improvement. So it's not as though this is just, a rising tide lifting all boats. But in terms of on the new deal environment, private credit, we're still doing private credit deals. In every new transaction, we're looking at a syndicated offering and a private credit offering. And we're looking at what's more flexible, what gives us better pricing and better terms, and we pick the best option. But the private credit market is definitely not dead. It's maybe slower than it was in that hot 21-22 market, but it's still active.
And you think net-net private credit still outweighs for your needs the syndicated market?
Depends. Depends on the state of the market. So typically, the syndicated market has gone through more boom and bust periods where the banks just are out of the underwriting business for a period of time. Private credit has been more consistent. As it stands right now, we are still leaning private credit. It's still more user-friendly. The pricing's good enough, and the terms are often more flexible. So, as I say, that market is far from shut.
Interesting. The Department of Labor today issued some new draft rules surrounding private markets and 401ks, essentially making it easier for plan operators to, not get sued for things that have high fees, which are many alternative assets. I'm just curious your reaction to this notion, 401ks, what they mean for the alternative asset managers, and what they mean against this backdrop of all the noise surrounding retail investors and semi-liquid funds and all of that.
So the announcement from the Department of Labor, I think, was like 170 pages, and I haven't read it, so I can't comment on exactly what's in there.
You ChatGPT for that.
Exactly, but I do understand the sentiment of why the government wants individuals to have greater access. If you look at the United States, the number of public companies in the last 25 years is down by 50%. Today, 90% of any company, of all the companies, with 100 million of revenue or more are private. Probably much higher even than that for technology companies. The returns in the public markets, look at the S&P 500, 10 stocks in the last 5 years are driving 55% of the returns. So I get the desire to get more people access to it, and I think these rules are all with an eye towards how do we make sure it's done appropriately, safely, and there's always still going to be a fiduciary in the middle of all of this. So I understand the sense that, why this is happening.
Yeah, it'll be interesting to see kind of what comes from here. Pete Stavros, thank you so much for joining us today, the co-head of Global Private Equity for KKR.
Thanks for having me.
Appreciate it. And a quick programming note, don't miss an exclusive interview with BlackRock's Rick Reeder. That's coming up today at 3 p.m. Eastern on Closing Bell. Coming up, cybersecurity stocks sinking late last week on Anthropic's reported push into the industry, but recouping some of those losses. Wolf upgrading CrowdStrike to outperform, writing that Anthropic's new model could actually benefit the company. What those new tools can and can't do next. Welcome back. Anthropic reportedly testing a powerful new AI model with more advanced cybersecurity capabilities. That news hitting
This is Anthropic's latest model, rumored to debut in April. And the expectation is that it will be more powerful and robust in nature, and according to reports, will lower the barrier, possibly to bad actors. Now, the CEOs of the world's largest cyber companies are calling on AI labs to be more responsible. Palo Alto Network CEO Nikesh Arora writing in a blog post this morning that a single bad actor will now be able to run campaigns that once required entire teams. Every desktop, he says, now effectively behaves like a server and is likely to have unsupervised AI tools operating near sensitive systems. The attack surface keeps growing, mostly unnoticed. Arora, who bought $10 million in Palo Alto stock last Friday, is calling on OpenAI and Anthropic to release these capabilities in a responsible fashion while ensuring the defenders have been consulted. The key question, Leslie, now for investors is if the large language models continue to enhance their AI capabilities and build offerings that are competitive to the software and cybersecurity vendors, will they replace these companies or they actually increase the total addressable market? Analysts at Wolf weighing in on this whole conversation, they think this only leads to more spending on cybersecurity. They're actually upgrading shares of CrowdStrike to $450.
Yeah, how important is it to have essentially separation of church and state in terms of you've got the AI companies, you've got access to data, you've got the large language models on one side. Do you need a separate company operating cybersecurity in order to protect that and ensure that there's integrity in the various models? Or is it okay for it all to be just in one house?
That's a great point. I mean, right now the industry is set up in such that you have the Silicon Valley cybersecurity incumbents that are providing the software, the AI architecture to these Fortune 500 companies to ensure you can reduce the risk of cybersecurity attacks. But at the same time, as innovation continues to get faster and evolve, the AI labs and the large language models are pledging that they can become very good at these specific tools. The Silicon Valley incumbents will tell you they're not offering the full security solution. So that's where the debate lasts. But at the same time, you have the government here in a position where they need to figure out what type of guardrails they're going to be putting in place for the large language models if their new products could lead to more attacks.
Yeah, no, it's absolutely fascinating. Seema Modi, thank you so much. Coming up, with shares trading around 15 times, Morgan Stanley says now is the time to buy this Mag 7 name. We'll reveal it next. And we're watching Cisco. Shares of the food distributor down nearly 15% after announcing it will acquire Jetro Restaurant Depot for $29 billion. Cisco on pace for its worst day since March 2020. The Exchange will be right back. Welcome back to the exchange. Yep, Meta, that was our mystery chart, having a tough start to the year, but that's not discouraging Morgan Stanley, the firm naming it a top pick for 2026, but trimming its price target by $50 to $7.75 a share. That's still nearly 50% upside from here. So is Meta set to stage a turnaround? Let's see what the charts have to say. Joining us for more is Paul Ciana, BofA Securities Head of Technical Research. Paul, what's the Meta chart telling you about, its potential upside from here?
Hey, Leslie, good to see you. Thanks for having me. Look, Meta fits into the narrative of the NASDAQ 100 with the topping structure and the downside that the market has seen. I think it's interesting that Meta's, falling pretty quickly. I guess we say in technicals, falling like a knife towards those 2025 lows of about 475. So maybe the brave try to step in there and hope that level holds. But for now, it's in a downtrend.
It's a downtrend for Meta. What about Microsoft?
Yeah. Similar idea, except, leading Meta on that turn. Both, as well as NVIDIA and some of the other major tech names, part of the reason why the NDX for the NASDAQ 100 double top this year, and as a broad index still has further downside likely.
And so how does all of that contribute to what we're seeing with regard to the NASDAQ right now?
Yeah, the NASDAQ 100 and the S&P 500 both have these topping structures where price action is biased to the downside. Of course, markets have fallen below their 200-day moving averages, but more so, they're starting to fall closer towards their 200-week moving averages. Right, you have something like Meta with rising 200-day week moving averages now at about 450 and approaching that 475 level. The NASDAQ 100, however, that 200-week moving average is much lower at about 19,000. So, we're not saying that the NASDAQ 100 is going all the way down to that, longer term moving average, but that's the current trend. It's mean reversion.
Are there any bright spots that you see within the Mag 7 from a technical standpoint?
Well, it really comes back to oil, Leslie. Oil markets have double bottomed this year, and that macro story is what's driving, this risk-off appetite. So, if we go back to oil prices and we think about the double bottom that formed over the last year, it had, this big move up to 120 on Brent. Right? We're used to seeing consolidation periods after that, and then the risk of a fifth wave to a new high. So in a scenario where the upside is still biased higher oil, I think it's going to be hard for, risk assets like those equity markets you've mentioned to really catch a strong bid. They might catch a bounce, but to signal the start of a new, secular uptrend, let's say in these names, you really need to know if, one, oil prices have peaked, and two, if U.S. yields are going to stop going up.
Is that true for all sectors? Are there areas that you think are less correlated to the price movement we've seen in oil?
I think you want to be long oil proxies and long higher yield proxies, because those are the two fixed income markets that are really starting to trend right now. And, if they keep going that way, then that's likely a place to be overweight.
Is there anything in the tech world that you think is immune from both the pressures in crude as well as the pressures in kind of the AI disintermediation narrative?
At this point, I wouldn't want to try and cherry pick a tech name until there's more macro clarity and response from what's happening globally, so those names could perform.
What about financials?
Similar story with regards to the flattening yield curve. That's a tougher environment for financials to survive in. If you look at something like the 2s-10s curve, you had that break support over the last few weeks. I would say keep an eye on the 5s-30s because that has tested and still is holding some support. And if that can hold, then perhaps there is some opportunity within financials.
All right, Paul Ciana, thank you so much for your time today, talking tech, talking financials, talking
Leslie.
oil. There's so much at play. Meanwhile, the S&P 500 turning negative, NASDAQ firmly in the red as well. That is it for us. Thank you for watching The Exchange. Stocks, again, struggling to hold on to their earlier gains. The Dow, the only major average in the green, but well off its 460-point high. Power Lunch with Brian Sullivan is up next after this quick break.
Your money trying to start the week higher, but right now the sellers seem to be in charge. Welcome to Power Lunch, everybody. I am Brian. Kelly is off today. All the major averages kind of on the midst of being lower right now. Dow up a little bit. It's a 4-day work week. Reminder, there is no trading on Friday for the Good Friday holiday. The S&P 500, by the way, headed for its worst month in nearly 4 years. All this as oil here climbs back above $100 a barrel. And as one overseas leader says, the situation is, quote, unsustainable. All this, the Middle East hits a dangerous crossroads. Ian Bremmer, president of the Eurasia Group, is with us today on the decisions that might reshape the region and the world. And in the markets, tech, of course, the hottest trade now. It's the biggest drag. The question, when is the bounce back? Will it bounce back? Dan Ives, global head of technology research at Wedbush, is here. Welcome, everybody. Hope you had a great weekend. We have got a big hour. Let's kick off this hour with oil and energy, because there have been many new developments that are sending oil prices higher. First up, President Trump now actively threatening Iranian oil. He wrote in part, quote, "We will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island, and possibly all their desalination plants," end quote. That was just part of what has happened the last few days. Here are some of the other key headlines. The Houthis, the terror group, they've officially entered the fight. Ukraine, they continue to hit Russian oil ports and oil assets. And Kepler now says that over 11 million barrels per day, about 1/9 of global oil supply, may be offline. And while the entire world has been focused on the Strait of Hormuz, there is a new critical waterway for you to know. It is the Bab el-Mandeb Strait. We'll call it BEMS for short. That is the strait between Djibouti in Africa and Yemen that leads into the Red Sea and the Suez Canal. It has always been an important strait because of the Suez Canal. But with the risk in Hormuz, the BEMS has taken on even more importance. And ships now run the risks of attacks from Iran's proxy fighters, the Houthis, who have their base in Yemen. About 5% of the world's oil runs through there, or more than 10% of oil shipped by sea. So between the Bab el-Mandeb and Hormuz, the world is looking at 20 to 30% of all shipborne oil potentially being offline or at risk. So how does this play out? Let's tie it together with Halima Croft, global head of commodity strategy at RBC Capital Markets, also a CNBC contributor. I'm not trying to scare everybody or be negative. We saw the Houthis. It was kind of a little attack,
right?
Small,
limited engagement so
very
far.
limited engagement, able to be stopped. But if things ramp up in the Bab el-Mandeb and keep going in the Hormuz Strait, what then?
I mean, that's so serious. I mean, we've been saying from the beginning the Houthis are the big wild card because they could effectively block in all Red Sea shipments. And if you want to think about like what oil is getting out of the Middle East, the only oil really getting out of the Middle East are the Saudi barrels that they are running through the East-West pipeline. That has reached maximum capacity.
Into the Red Sea.
Into the Red Sea, Yanbu port. About 5 million barrels of exports are now coming out of Yanbu. If Bab el-Mandeb is viewed as unsafe because the Houthis once again fire missiles, drones at ships going through, and we basically close that choke point, those Saudi barrels aren't running, and we've effectively now shut in all Middle Eastern oil.
And I know this is Middle Eastern geography. I understand for a lot of our viewers and listeners, it's a little bit wonky, but I'll put it in a very basic way. There's more than three, but let's call it three major west-east highways in America: I-10, I-40, and I-70. Let's say I-40 has effectively been shut down. We're now talking about potentially risking one of, and the traffic flows to the other two. We're talking about shutting down the amount of traffic in one of the other two. What were to happen if the Houthis ramped things up?
Well, the problem is, again, Brian, there's no way out for those barrels if the Red Sea is shut. Again, the only relief valve we have had has been the Saudi East-West pipeline. I mean, thank God they invested billions of dollars in that pipeline.
They're very smart.
Very smart. That was energy security. But it is contingent on that waterway remaining open.
Yep.
Now, again, the Houthis have just entered the conflict chat. They have not done anything yet on tankers.
They kind of raised their hand. We're still here.
They've made some verbal threats. The question is, what is the tripwire for them to become?
They're going to do what Iran tells them, effectively.
Well, they're an interesting case because they are a axis of resistance member, but they don't always take their orders directly from Tehran, and they have to govern Yemen as well. And so the question is, how do they prioritize their relationship with Saudi Arabia? Do they want us pounding them again? So again, I think it's important they've entered this conflict. We have to wait and see what happens.
And I know, a lot of our viewers are going, well, what about the Suez Canal? Ships can just come and go. Yes, but there's a maximum size ship that can go through. It's called the Suez Max. A lot of the bigger oil tankers have to go in and out of the Bab el-Mandeb Strait. They can't go through the Suez, so there's limitations there. All right, over the weekend, we had one of the critical leaders of the Middle Eastern region, Sultan al-Jaber, basically come out and say, the situation is unsustainable, and here's what he's talking about. We show on our markets, we'll show the price of oil, Brent crude and WTI. That's what's called the paper market. That's the futures contract. If you want to actually get a barrel of oil in the UAE region right now, it's going to cost you a lot more than 110.
I mean, I think from the standpoint of the Emiratis, 60% of the missiles and drones in this conflict from Iran have been fired at them. So their concern is, how does this end in a way that Iran is not operating the Tehran toll booth in the Strait of Hormuz? So I think they are concerned that we could potentially leave Iran in charge of the world's most important choke point for energy.
Yeah, and again, everybody knows this by now. For the CNBC viewer, it's not just oil, it's LNG, it's plastics, it's helium, fertilizer, it's all these other things. So we've got Ian Bremmer coming up in a few minutes. I'll get more on this with him. But from a commodity perspective, Halima, what do you see as kind of the best and the worst possible outcomes?
I mean, the best outcome would be this ends now, and we have a free movement of ships to the Strait of Hormuz, but it's still going to take months then to fully restore production. I mean, you had the CEO of KPC, Kuwait Petroleum Corporation, from CERAWeek say, Kuwaiti production, it will take probably 3 to 4 months to fully restore that output. Then you think about a country like Iraq. How long would it take Iraq to be fully up online? There's been significant damage to energy infrastructure throughout the region. Think about Qatar and think about the damage to the Ras Laffan LNG facility. So again, the best case outcome would be a multi-month return of energy flows. The worst case scenario is extended duration conflict, that paper market and the physical market prices converge, and we end up in a much higher price environment.
That's what you just said is $130 to $150 Brent crude oil and $125 WTI.
Taking out the 08 highs in a multi-month blocking Strait of Hormuz situation. And again, that's why we have to watch the Red Sea exports, because if we close down that vital waterway as well, that gets us.
That's got to be.
Yeah. That's the 08 high taken out.
Because you're talking about potentially, to your point, 5 million barrels a day in the Saudi port, which they very smartly built a pipeline literally across their country.
They thought about de-risking infrastructure and made the investment in advance.
But that Bab el-Mandeb Strait, that's not entirely up to them. Houthis and maybe the Iranians are going to have a say about it. Take 2 to 3 million of those 5 offline. Again, now you're looking at a tight world that's gotten, to maybe Sultan Jaber's point, unsustainable.
Brian, think about it. We ran up to 128 after Russia invaded Ukraine because we were concerned we would lose 3 million barrels of Russian production because of sanctions. We are now talking about shutting in production of over 11 million barrels.
Yeah, that's 1/10 of oil. And the reason, is it fair to say the reason oil is not at 150 or 200, whatever the number is, insert number here, is because there is 1 billion plus barrels in storage, or there was.
There was.
We've got the largest global coordinated oil release of all time, 400 million barrels, 172 million coming from the United States. And China, for now, has plenty of oil.
I think also, Brian, people believe this is transitory. So at what point do market participants say we're
That's
not?
a bad word, because they were wrong about that nature with inflation a few years ago.
That's what I'm saying. People believe that the Strait will reopen soon. So the question is, tell me, when we start seeing ships moving instead of focusing on sound bites.
Yep. And right now we got WTI, as you talked, hitting exactly 103. We are back to triple digits, which of course is not 08 because inflation has the impact.
Right.
But let's just say these are high numbers. Lima Croft, always love having you on set.
Thank you so much.
Thank you very much. All right, folks, speaking of energy, a reminder to sign up for my forthcoming energy-related newsletter. It's called Power Insider, a weekly piece into key news, meeting power players, and more. Will launch in a couple of weeks. Use that QR code and sign up on your screen and go to cnbc.com/power newsletter. All right, coming up, more valuable insight, this time from Ian Bremmer, on whether the Iran war will really wind down soon, or will it just keep ramping up? And if so, what's the off-ramp? That's next. All right, the big question for global markets right now is when and how the Iran war ends. Will the two sides come to some kind of peace deal, or are they so far apart that no deal is possible, at least right now? President Trump, as you heard us just say a moment ago, further threatening Iran. And there is the growing talk that American soldiers may put boots on the ground in Iran, or at least the region, very soon. Eurasia Group founder Ian Bremmer laid it out very plainly on social media, writing, quote, Trump can't reopen Strait of Hormuz with an air campaign, and the Iranians, they're not going to accept any of that outcome willingly. Ground troops are coming. Let's talk about that and more. Ian Bremmer, founder of Eurasia Group, is with us now. Ian, always value your insight. What's the off-ramp here?
There isn't one soon. The off-ramp for the Americans requires the strait to be open. And for the Iranians, to the extent that they can, it requires them to continue to have influence over the strait. Those are incompatible goals. They're pretty baseline. And I don't think the 7,000 troops that are on their way to the Middle East, some of them arriving today, are there for shore leave. So I do expect that they're going to be deployed in combat. And that is meant, at a minimum, to up the pressure on the Iranians, as well as increase the military damage done, the capacity of the Iranians to disrupt the strait. But we are, as you know, that means that we're more than a week or two away from the conclusion here.
Yes, and we're a financial show, so focusing on the financial aspects of this, two distinct outcomes. Kharg Island, 90% of Iranian exports. Right now, we've avoided hitting the energy infrastructure, although over the weekend, President Trump kind of alluded to, or didn't just allude to, suggested potentially blowing up oil wells. What are the two differences, though, Ian, if we take Kharg Island? In other words, we just sort of have troops there and now it's ours, the oil theoretically would still flow, or leveling the oil infrastructure. I mean, those are critically different outcomes for global energy.
Yeah, well, I mean, first of all, you're right that Trump did say that, but he has said many things over the last days, and he contradicts himself continually on this war because he's angry, he's frustrated, and he doesn't have a successful off-ramp that he wants. I mean, he wants to be out of this war now, but he wants to say, I won, and he doesn't know how to get both of those things. So as a consequence, what you're getting is sort of letter salad, and every post, frequently the posts themselves contradicting themselves. So it's not super coherent, right? And this is driving American allies pretty crazy, but that's the reality. Now, they do not have 7,000 troops is not reliably enough to take and hold Kharg. The military folks that we've been talking to say 12,000 to 15,000 minimum for that operation comfortably. That's not where they are. So if that is a goal, and it may well be, it is not an immediate goal. A more immediate goal would be taking some of the contested islands in the strait to give them more influence over and balance of power over what happens in the strait. Also, raids on coastal areas, probably not trying to hold that territory, but rather going after missile launchers, going after capacity with drones, and further degrading the Iranian position. And then from there, if that then doesn't lead to now you're willing to cry uncle and accept more of our 15-point plan, then you're bringing more troops in and you're going to Kharg. The problem, as you know, is that on any given day, in the fog of war, the potential that you get significant unintended escalation is real.
Yeah, and if we, by the way, Kharg Island
can happen from the water salination plant. That can happen from
that's a war. I think
alien target can hit all that.
Yeah, if you hit the sal plants, I think that's a war crime. I'm not sure. Either way, Kharg Island is a scrub. I've never been there, but my colleague and friend Michelle Cruz-Cabrera has. Pretty small scrub island, basically a bunch of oil tanks and export ports, not much there. If U.S. troops were to be on it, then there's no reason why the Iranians just wouldn't lob missiles at their own island, because now it's not their island anymore, and there's not many places to hide. It's about the size of Catalina. But I want to ask you about somebody else we haven't heard from, and that's China. China they get the majority of the oil that goes through the Strait of Hormuz ends up in parts of Asia, China or South Korea, Japan, whatever. Same with natural gas. China's been almost bizarrely quiet this entire time. When do they enter this conflict verbally, trying to be the mediator of something, because they are reliant on what happens here, Ian?
Well, first of all, they're much less near-term reliant, less exposed than countries like the Philippines and Vietnam and Sri Lanka and others in Asia, because they, of course, have much greater stockpiles at China. Secondly, they're playing the long game. They're more than happy to allow the United States to undermine their own position and their own reliability with other countries around the world while promoting themselves as a face of stability and predictability. They are making no regret, risk-averse moves, thinking about 10 years down the road. They, of course, are the world's first electro-state, and they're in a much better position on post-carbon than the Americans or the Europeans are at scale, including the critical minerals and supply chain to help power that. So they're thinking long-term. They have been for a while, and that benefits them, even if they're taking an economic hit from the crisis. I don't think that we're going to hear from the Chinese any criticism of Trump directly. I do think that any future of the strait, the Chinese will not want the Europeans to be engaged in any transfers and escorting by themselves. They will want to participate in that. And it's interesting because Trump has on many occasions now said, we shouldn't be policing the strait. It should be the other countries, the Europeans, the Asians. They get all their energy from there. That seems to misunderstand basic tenets of globalization. But of course, if the Chinese then say, okay, look, we're willing to do that. By the way, we gave you TikTok, which is what really matters to you, sir. We want to have a role in policing the strait. I think Trump might well give it to him. I think it'll drive his own defense folks and intelligence folks absolutely batshit crazy. But I think Trump's inclination is to say, yeah.
That's a fair description. Let me wrap it up with this question. Does China have the ability to go to Tehran and tell them knock it off? I understand that we're doing stuff too, but from an Iranian perspective, would China have the ability to force Iran to back off?
I doubt it. But I also think they have no such inclination. I mean, there was a big question about whether they could have done that with the Russians on Ukraine. Of course, that hurt the Chinese with their relations with the front-line NATO/EU states that they were closest to, but now the Russians invaded Ukraine, and now they're really angry at China for providing support. They weren't willing to deploy real pressure. They want to be seen as engaging with absolutely everyone. And I think the same thing remains true with China on Iran. Let's keep in mind that the Iranians are getting a lot of oil out. They're the only ones that are at this point, other than a few marginal tankers from places like Pakistan, Malaysia. And most of that oil is going to China. So, you know, they are not, even in the near term, the Chinese are comparative winners here in the way this war has played out. This is by far the biggest foreign policy mistake that Trump has made in either of his presidencies. There's no question, not even close.
We'll leave it there. I will say this, you pointed this out, we've pointed out before, the unintended consequence of the energy markets, that, you know, what's soaring is coal, because a lot of these natural gas plants in Asia are now gonna have to reconvert back to coal because they're worried they're not gonna get the gas. So if you're worried about the climate, now we're burning more coal. Ian Bremmer, Eurasia Group founder. Really appreciate it, Ian. Thank you very much.
Good talking. Yep.
All right, folks, on deck, we are going to get a check on the markets and your money. Dow is up a little bit, S&P down about 0.2%, NASDAQ off about 0.5%. The world, of course, remaining on edge. And we have got a very surprising stat for you on your markets and your money. And you'll hear it right after this. Got a mixed market for you right now. The Dow is up about 0.3%. The Nasdaq and the S&P, of which you probably care more, are down a bit. The Nasdaq down about 0.6%. Now on Mondays, we've tended to have slight gains this year, only generally to see those gains sell off the rest of the week. And with stocks lower to begin the year, do you know exactly how bad it's been? Well, it may not be as bad as you might have thought. Look at this. And this is, yes, a very good RBI, random but interesting. As Creative Planning's Charlie Bolello notes, we are in the middle of just the 14th worst start to a year for the S&P 500. The worst start was back in 2020, of course, with COVID and the lockdowns. We lost 18.6% in the first 59 trading days of 2020. 1933, 1938, 1935 were the other top 3 worst starts to the year. But this year, we've lost 7% in the S&P, which Charlie notes we know feels worse than that. And by the way, it may get worse, but overall, we have had 13 worst starts to the year ever and 4 worst starts to the year since the year 2000. So that's what's happened. The big question, of course, is where does it go from here? Well, we know where we're going. We're going to go to the bond market because Federal Reserve Chair Jerome Powell speaking this morning at Harvard University, indicating the central bank is inclined to hold rates steady, and bonds, they are rallying with yields coming down. Let's bring in to talk more about it with Steve Leisman. Steve.
Hey, Brian, Fed Chair Powell taking some of the edge off of the concern the Fed could hike interest rates amid the surge in oil prices and the rise in inflation concerns. Here's what he said earlier today.
Now we're facing events in the Middle East, which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out.
A good place is the phrase Powell likes to use to signal little change in the way rates are currently set right now. Looking at the December Fed Fund futures, the market now banking on no change at all and just a modest chance of both hikes and cuts. The bond market, however, has given back some of its earlier gains. Powell made clear that the Fed is committed to bringing inflation down to 2% and that the Fed would watch longer-term inflation expectations for cues, Brian, that it might ultimately respond to higher oil prices. Brian?
Yeah, I mean, this seems to be the question of the market, Stephen. Of course, Fed Chair Powell is going to be leaving as of May. Do we have any idea what the possible, I guess, incoming Fed leadership may think?
Well, we know that Kevin Warsh, if he gets in May, of course, that's a question right now.
That's why I kind of hedged it.
Yeah, just to be clear, he wants to bring interest rates down. But what we're hearing from the committee is more of a let's wait, watch, and see what's going on. There's still the tariff inflation that it causes some concern, and Powell mentioned that again. They're looking through that, and then they're going to look through the oil price. So you get to a point where if you look through too many things for too long, Brian, then the credibility of the 2% target becomes called into question.
All right, Steve Leisman, never called into question. Steve, we appreciate it. Thank you. All right, coming up, the biggest IPO in American history. Will it be out of this world or something else? Dan Ives on that and more next. All right, welcome back. Stocks, they're trying to shake off last week's downturn. The Dow is up, S&P and NASDAQ down a bit. But for the biggest market drivers lately, the pain for you continues. The Mag 7 down more than 30 to 20% off their 52-week highs. Apple's down 14, Microsoft down the most, off 35%. But what about Meta? Well, Morgan Stanley out with a new note saying it's time to buy Meta, making it a new top pick and seeing an upside of 50%. With a price target of $900, your next guest, even more bullish on the stock. Let's talk about that and more with our friend Dan Ives, head of tech research at Wedbush Securities. Dan, welcome.
Great to be here.
All right, so before we get into specific stuff, again, we know you're optimistic, but as the market keeps trickling down, what's your message to your clients?
I mean, the message is that it's a white knuckle environment, but just like the COVID days, just like Liberation Day, it comes down to like, what does the spending look like in tech in terms of the AI revolution, in terms of the $4 trillion of CapEx that's going to be spent? That's not changing.
So I want to be clear, as of now, $4 trillion intact. Nothing's changed.
Nothing changed. And to some extent, accelerating in terms of a lot of these projects. So our whole point is, similar to what you're talking about with Meta, and I can say the same about Microsoft and Tesla and many of these other names, you have to be able to navigate these white knuckle periods, and that's what it is, to understand who are the winners. And especially a lot of these stocks right now, they're trading like numbers are getting cut, not that numbers are going higher.
I'm going to say something I shouldn't say, so don't tell anybody. It's just between you and I right here, which is that energy, which I love. Energy doesn't matter to the market. It's 4.5%. Energy soaring this year, and the market is still down. So not my opinion, right? Energy's booming, and the rest of the market is lower. Is there a point at which some of these things we're seeing with oil trickle over into your world at all, or not?
Look, I think if this lasts, going into the summer, into the next few months, then of course there's some ripple effect on the economy, on enterprise, on consumer, where eventually then CapEx could start to get cut. But our whole point is that if this is contained and it's something that is not prolonged, it's really a speed bump on the broader view of tech.
Even to Dan Ives, and we know that you've been bullish and are bullish. If this lasts into summer, you might have to start rethinking how you think about things.
Look, if this lasts into the summer, then you could start to have clearly a ripple effect in terms of what that means in terms of numbers, CapEx. And I think right now, when you're looking in terms of tech, a lot of these stocks are basically saying like, numbers are already coming. I mean, I would already say like bad news is starting to get baked significantly into a lot of these names. And that's really our whole point, how we navigate through these moments.
And we saw, the intro, we talked about Meta, and you're very bullish on Meta, the Facebook company, Instagram, WhatsApp. Microsoft is off 35%. It's lost a third of its value from its 52-week high. It's 65% or so below its Wall Street average price target. What's going on with Microsoft? To your point, it has nothing to do with what's happening in the Middle East. What's going on?
I think there's three reasons why the stock is just down, obviously in this fashion. One, I think the view that Google, in terms of what they've been able to do on the cloud, in terms of AI, that there's a share gain situation happening versus Microsoft. But our whole point is
Gemini is beating ChatGPT, which is partly owned sort of by Microsoft through its investment in OpenAI.
Exactly, as well as Copilot. And then when you go back to the OpenAI, it's the view like they're less reliant on OpenAI. That becomes more of a competitor. Is that something that ultimately cascades? And then I think the third thing is really about Azure growth. And we think that ultimately does accelerate. But right now, they're going through like a lot of software companies. You're going through one of these where the CapEx build-outs are there, but the monetization is not at the pace that investors want to see. And that's why it's not just Microsoft. You look at Oracle, you look at cybersecurity. I mean, software stocks are selling off in dramatic fashion.
Except today. I will say that, Mar, the tape is down a bit, right? We got the NASDAQ off about 0.5%, but some of the cybersecurity stocks, they're actually higher today.
Well, to that point, I think that continues to be, one of the most disconnected trades I've ever seen in tech in terms of the view that the AI goes trade and Anthropic is going to unseat a CrowdStrike, a Palo Alto. And that's really more of a fairy tale. The reality is that for cybersecurity, the budgets, and we were at RSA last week, they're just going to increase, we think, going from 5% IT budgets to 10%. So cybersecurity is a good example where that right now is way overdone relative to what I think is going to be the fundamental case on not just those names, but the sector.
Yeah, any one of those names you like more than others? We showed CrowdStrike, we showed Palo Alto, they're both up today. It seems like there's a couple companies that are turning into the real winners of cybersecurity.
Yeah, I think CrowdStrike and Palo Alto, I think
they're kind of in their own.
And then you could say Zscaler, I think, is another name that's going to clearly be very well positioned. Checkpoint is another name on a barbell approach, obviously a cheap stock, and I think well positioned from an install base perspective. But Brian, I think right now, you are just going through a glass half empty view. A lot of these stocks are getting thrown out in terms of just the nervousness, but you got to separate out between what's happening in terms of the real spending versus what the stocks are telling.
Yeah, and tech valuations about the same now as the S&P 500. We'll leave it there. Dan Ives of Wedbush, always value your time, Dan.
Thank you.
Thank you very much. All right, let's get now to Angelica Peebles for a CNBC News update.
Hey, Brian, more than 40 congressional Democrats have written to the CFTC asking the agency to curb alleged insider trading in prediction markets. Senators Elizabeth Warren and Amy Klobuchar are among the names on the letter, which asks the agency to issue guidance for federal employees surrounding the use of prediction market platforms. CNBC and Prediction Market Kalshi have a commercial relationship, including a minority investment. Mexican President Claudia Sheinbaum defended the country's right to sell oil to Cuba for humanitarian or commercial reasons earlier today. Her remarks come after President Trump said he had no problem with Russia sending an oil tanker to Cuba despite a U.S. blockade. JetBlue announced it is raising its baggage fees as jet fuel prices soar amid the Iran war. This is the latest sign of airlines passing rising costs onto their customers. The airline said it is constantly evaluating how to manage rising operating costs while keeping fares competitive. Brian, back over to you.
All right, Angelica, thank you very much. All right, folks, your mystery chart today has been flat for the past 15 months. But your next guest says it's cheaper than it's been in years, and it may be ready for a breakout. The name, next. All right, welcome back to Major Averages. They're mostly lower. The Dow is up a little bit, despite President Trump signaling an end to the war in Iran could be coming soon, or maybe not. The markets may not be out of the woods yet either. According to Carson Group's Ryan Dietrich, we are about to enter the worst historical quarter for the S&P 500. Here's how we laid it out. During a 4-year presidential cycle, this quarter has an average return of negative 2.8% since 1950. So every 4 years, presidential cycle, this quarter of this year is historically the worst. And remember, during a midterm election year, which is this year, markets also historically fall about 15%. But if you're a longer-term investor, don't you want to buy low and sell high? Let's find out and get more on that and more with Jim Tierney. He is AllianceBernstein CIO of U.S. Concentrated Growth. All these stats, Ryan's great. All these stats are great. Midterm year, worst cycle, we're at war, etc. The markets aren't down very much. What's holding them up, do you think?
I think if we rewind the clock by a year and we were in the teeth of the Liberation Day issue, all of a sudden we realized it's going to be over. And I think people are looking at Iran the same way, that at some point we'll declare victory and oil prices will go back down and the strong economy, and it is a strong economy, will shine through.
Us declaring victory doesn't mean it's over. There's two people in this fight, us and Iran. Really, there's Israel too, so 3 or 4, depending, the Houthis, whatever. Just because we declare it, I'm not getting into geopolitics, what I'm saying is, what if the market collectively, Jim, is wrong about how this plays out? What if July and August, September, we're still talking about this and dealing with this?
That's certainly the risk on. I think the current administration has a huge incentive to get this behind them and probably will be more willing than not to do what it takes, because we have midterm elections coming up really fast. And if we're in the same spot we're in today, it's not going to be a good result in November. So there is an incentive to solve this.
Okay. Individually, let's get some ideas, right? It's a holiday shortened week. We're off Friday for the Good Friday holiday. MasterCard. You're not worried about consumer spending?
No, the consumer's hanging in there. Higher gas prices are good from the perspective of you're spending more at the pump, but more
which they get a slice of that. So if the numbers go up, they actually make more money.
More importantly, the market is freaked out about agentic commerce. And agentic commerce is one thing. How you pay for it is completely different. And the thought that all of these payments are going to go away from MasterCard and Visa's rails, I just don't see it.
All right, let's talk about Schwab, because there was a day, God, could have been 100 years ago, but I think it was about 3 weeks ago, where Schwab and the other wealth managers all sold off because some firm had said they figured out AI and it's going to tell you how to do your taxes. There's nothing new about that. So Schwab is one of your picks?
Yes. That technology is a feature. It's not a product offering. It's not a company that's going to take over the world. Schwab continues to grow net new assets at 5% a year, and higher rates for longer are great for Schwab because their net interest margin keeps on drifting up, and they're adding lots and lots of new capabilities to their platform such that they are going to monetize their clients at a higher rate. You're looking at a company that's trading at 16 or 17 times earnings with no credit risk.
We've talked a lot about insurance. We've talked a lot about risk. And there's actually a company that you like that has the word risk in its name that services the insurance industry. Who is Verisk? Why do you like it?
Verisk has the insurance risk model. They have every policy written for decades. That is proprietary information. Unless you believe that AI is going to be able to access that information, they still have a moat around their business. This is a stock that's traded off significantly, yet they keep on growing earnings nicely and have that moat, and it's proprietary. Until that is pierced, and I don't think that's going to get pierced, this is a very interesting company.
Those companies that we just don't talk about a lot, but probably just have a lock on certain parts of their industry. Unless you're in that industry, you wouldn't know what they do, right?
Exactly. Unless your information is commoditized and available to the world, if you have proprietary information, you still have a moat, and there's a lot of value to companies like that, and they're being thrown out with everything else right now in the market.
MasterCard, Schwab, Verisk, 3 names and a macro market view. Jim Tierney of AllianceBernstein. Really appreciate your view, Jim. Thank you very much.
Thank you.
All right. Oil, by the way, just closed, and it closed above $100 a barrel here for the first time since the war began. Gasoline prices, meantime, nearing $4 a gallon. But is that enough for Americans to switch their car buying habits to electric cars? Or is it a complaining point that won't matter at all? We'll talk more about it with the car dealership guy next. Let's talk about cars. It's not been a great run for any company that makes non-Tesla electric cars. According to Kelley Blue Book, prices for EVs overall are actually down a bit year over year, while more traditional cars are higher. But with gasoline prices nearing $4 a gallon nationwide, and of course well over that in states like California, we wondered if that may change what kind of car you buy. So the only way to find out is to find out. So we asked that very question on X. How long would it take for you to change the kind of car you buy based on gas prices? Under 3 months, 3 to 6 months, over 6 months, or you won't change? Of the respondents, 70%, 70, said they're not going to change no matter what. Joining us now is Yossi Levy. You may know him better as the car dealership guy, which he is founder and CEO of. And Yossi, always love talking cars. Great to get you on. With all due respect to my lovely followers and everybody that watches the show, do you believe that? Do you think 70% of people aren't going to change the way they think about buying a car if gas prices keep going up?
I don't know how reflective X is of the general population.
It's also skewed by my people who follow me. I get it.
Yeah. Look, here's what I'll tell you and Brian, great to be back. Haven't seen you in a while. From my initial conversations with dealers, we speak on average in a week to hundreds of dealers between our communities, in person and on podcasts. And of course, our engagement, we're seeing that the bump in EV consideration has been very strong, but the actual conversion has been relatively muted. So why is that? Well, remember that, yes, people are seeing things in the news, they're seeing the gas prices at the pump, but prices are still pretty high on your average EV. And so where you're really seeing the big bump happening right now is in the used market. The used market is the beneficiary again, and specifically used EVs, where dealers have said things like, I'm selling them as fast as I can get them, and used EVs are being the real big beneficiary here.
And so I actually, yesterday, to watch whatever happened to Duke basketball, I don't even know, it's a different issue, had dinner with a friend of mine who owns car dealerships and EV dealerships, and talked about this, and I literally said to him, what would be the price of this type of a car, this EV brand? And it's getting to the point where it's getting so cheap that I almost feel like buying another one, because I bought one in the past, because I can just, it's almost like it's so much cheaper. Is that how people are starting to think? They may not even want one, but the price is getting to the point where it's hard to ignore them?
So this really depends on what part of the country you're in, because demand and just the desire for the electric vehicle is very different. But if you look at the coasts, and I like to look at the coasts because California, New York, the East Coast in general, you have pretty strong EV demand in those markets. So it's a pretty good bellwether for how demand is shifting. Dealers I've spoken with have literally doubled their sales in the past 30 days. Now, you're not talking about a massive baseline. You're talking about maybe from 10% to 20% is the rough number, but it's still very meaningful. When you go from 10 to 20% EV as a percentage of your revenue in 1 month, the question you begin asking is this a flash in the pan, or is this going to persist? It's definitely the most meaningful bump we've seen since the tax credit.
Yeah, certainly has been, and resale's a part of this, though. And so if I'm a buyer, and I want to buy a used car, Yossi, that's good for me, right? Because I'm getting a cheaper car than I would have. But if I'm the owner of that car who is selling it back to the dealer, or coming off lease, right? And they're like, here's your price, no thanks. This is a bad thing. Talk to us about the depreciation of certain types of cars, because EVs do depreciate, I think, non-Teslas faster than others.
I would say that's not fully true anymore.
Okay.
It used to be true, especially around, look, EV prices were the most volatile during the COVID years, and naturally, as they went up the highest, they also came down the sharpest. All of these prices have stabilized. If you look at just the annual units, the industry's projecting new unit sales, it's called SAR. It's around 15.8 million. So that's been pretty steady. Dealers aren't expecting too much growth, and they're really focused on efficiencies, but they're also not expecting crazy declines either. And the star of the show, putting aside the last 30 days, has been hybrids. Hybrids last year, the last 12 months, have been the hottest seller in the country, is a Hyundai Palisade hybrid. And so EV depreciation has stabilized. Yes, EVs depreciate differently than internal combustion vehicles. The battery is what determines the majority of an electric vehicle's depreciation, and it has a different type of, it's not fully linear. It does take a big drop when that warranty expires, but I wouldn't say that's the case anymore. I think at this point, it is more vehicle by vehicle and what you can find out there in the market. And again, the used market being the ultimate beneficiary right now.
Yossi, always great to have you on. And I promise it won't be that long again. We've had a little bit going on. Yossi, love you, the car dealership guy. Really appreciate it. Thank you. All right, folks, we're going to leave you at market lows here. Got an hour to go on Monday, and we are seeing declines, not in the Dow, but the rest of the market. I'll leave it there. Closing bell's going to pick it up. We'll see you tomorrow. Thanks for watching.
Brian, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with, of course, the market. Stocks attempting to bounce back after weeks of selling. That's what the scorecard looks like with 60 to go in regulation. Majors, well, they did open higher, as you know, even with oil prices still in the green today. And we're going to struggle here, it looks like, to hold that as the last hour progresses. Dow is still green. S&P is red now, almost by 0.5%. And the Nasdaq's been tough. We'll get to that in a moment. Yields, a move lower in bond yields has helped a bit, but investors are still trying to get a handle on when the war might see some real breakthroughs. So we're watching the interest rate complex too. As I was talking about the Nasdaq, techs remain very unsettled. Names like CoreWeave today and AMD, Broadcom, Micron, I could go on because there are many to cite. Not Anderson's, of course, but NVIDIA, Apple, Alphabet, mega caps aren't showing much either. NVIDIA just hasn't traded well. People are watching 170 as a line in the sand. The AI power names are really selling off too. If you want to take a look at some of those, there's some of the chips. You can look at many of those utility-like power stocks that play into the AI story, and they are all down a bunch today as well. It takes us to our talk of the tape, how best to proceed in this unsettled and still uncertain market. Well, let's ask our headliner. He is Rick Reeder. He is BlackRock's CIO of Global Fixed Income. He's head of the firm's global allocation team. Welcome back. It's nice to have you.
Thanks, Scott. Thanks for having me on.
So you posted on social media this morning, and I'd like to follow on that first, where you said, quote, major indices have been shockingly resilient in this volatile macro environment, but the contained headline moves are masking a historic level of dispersion underneath. So let's stay on the resiliency part of that first. It sounds to me like, are you surprised the market has remained as resilient as you think it has?
So, I mean, so you break it down into different areas. So if you take the actual market, given the war news, it's down, but it's not not that far down, given all the pressure you've seen overall. You'd expect to see from the war. The dispersion, and you talked about it today, that you're seeing in some of these markets is pretty incredible. Same thing, by the way, when you look at the credit markets. The credit markets, you know, when you think about pressure on private credit, spread levels in the credit markets are actually holding in pretty well for what's been obviously a stressed period.
I guess part of the point is that if I was to tell you, okay, we are in the midst of the biggest supply shock in the history of the global oil market, and in some cases energy more broadly, and the S&P is only, in quotes, down 7% from its high, you would say something feels off, but that speaks to at least some degree of resiliency.
Yeah, I mean, we've said it before, the amount of cash that's sitting out there is pretty extraordinary. What you see during periods like this is the cash pulls to the side, it sits and waits. You still have a benefit in terms of the equity buyback versus IPO calendar. So the technicals are pretty good. You know, one of the things I think you do in environments like this, you know, in terms of managing portfolios, you just got to stay conservative. We got to, we've raised a bunch of cash in our portfolio, stay conservative for a period of time. I quite frankly think the year will end up in pretty good shape. That is assuming you get to the other side of what is an incredibly uncertain period. The technicals are really good in equities. People want to, I will tell you, when I travel around the world, people want to buy the market. People are sitting and waiting to buy the market. But for the time being, it's ourselves and others. You sort of sit and wait, and you're just cautious in the interim.
Has the war changed? It sounds like it might have. The idea that you expressed first on this program several months ago of this incredible investing environment, one of the best you had ever seen. Is that now changed?
Scott, I'd like to go back to the last couple of years where we talked about that. I mean, right now you've got an uncertainty that is, we talk about, like you say, one of the greatest supply shocks we've ever seen. You've got uncertainty in terms of what does it mean for trade? What does it mean for durable levels of inflation? What does it mean for a consumer that is going to be on the, on the other side of what are tough pricing dynamics in the near term? So, listen, I still think the income levels, the yield levels, particularly in the front end of the yield curve, are attractive. But if you said, gosh, how much risk do I want to take in a very uncertain period? It's quite different than we were than things were over the last couple of years.
I mean, I think people are trying to keep their best outlook intact. And as you said, traveling around, people want to buy the market because while the S&P has only corrected, 7%, the multiples come in to around 18 times, but earnings expectations haven't. They're still elevated, so people are believing in the dream that earnings are going to still remain, well double digit, and that's why people maybe haven't gotten as negative as they otherwise would. Is that fair?
I think that's fair. You know what, Scott, I actually looked at today, particularly in the hyperscalers, I would say actually beyond that, you take the top 10 to 15 stocks, and you think of what's happened to the earnings, and then I looked at where forward multiples are off of some of these stocks. They're actually quite reasonable. And you think about, so a bunch of these companies are turning out 35, 40, 45 ROE. And then you think, oh gosh, I'm able to buy some of these stocks at less than a 20 multiple. That's pretty reasonable. Point being, if you step back and say, would I buy some of these equities? And I was looking at today, would you jump in and buy some of these? I think, I'd like to buy them. I will tell you one of the things, and we talked about last couple of years, one of the ways to manage money over the last couple of years was take risk and buy volatility or buy insurance because it was super cheap to do it. It's actually the flip today. We're actually selling insurance. You look at where the volatility markets are, selling some of the downside in some of these names, the amount you get paid is incredible. So the idea that today I'm going to run a lower risk threshold, but maybe I'll sell insurance, similar to the insurance market. People sell insurance when you're in the middle of a hurricane or right after the hurricane, and it's expensive. Insurance is expensive. Today, volatility is extremely high. By the way, not just equities, rates, currencies. Mm-hmm. So my view today is I'd like to buy some of these. In the interim, gosh, I think I'm going to stay cautious, but I'll take advantage of people buying a lot of insurance or paying for a huge amount of volatility.
Well, it's funny because one of the reasons, and I think it was a principal reason that you thought this was, and at the time, one of the greatest investing environments that you ever saw, because that insurance was so cheap, that you could play the markets and you could hedge and you could defend yourself, so to speak.
100%. I always think about when you're investing is what is your escape hatch? What is, how do you manage your risk? There are two things that have happened this year. One, volatility is extremely high, so it's hard to manage your risk when vol's that high, when volatility's that high. Second thing is when correlations break. So you think about what's happened this year on interest rate. When you shock inflation higher, interest rates become a more questionable hedge. Gold becomes a more questionable hedge. So that's one of those environments when you don't have a way to mitigate your downside, there's only one thing to do, raise cash and just run a lower corpus in terms of your position. So that's how we've been managing it.
When you say I'd like to buy some of these or I'd like to buy them, are you specifically talking about the mega caps, which have re-rated in their own right because they just haven't traded well? Their PEs have come in.
So the mega caps, I mean, those are the ones I went through over the weekend and I went through today, and I looked at some of the forward multiples. Boy, I think those are pretty attractive. I will say today, like some of the semis getting hit like they're getting hit, and by the way, one of the ways to enter that space is you sell volatility. You sell some of the downside because, boy, would you buy them if they're down another 20% and you get paid for that. So, yeah, I think some of these have gotten pretty reasonable. The financials are interesting as well, but I think for the time being, it's a place you gotta stay cautious and until a lot of this works its way through. So I don't know. I mean, we're setting up for what is a really good potential environment over the next, I don't know if it's a forward 3 weeks, 6 weeks, 8 weeks. But today, I just think I think valuations are reasonable. And but I think you just got to be a bit careful for the time being.
Well, I mean, valuations are reasonable unless you get a more significant backup in yields and a more significant backup in inflation. So you must not think that is going to occur.
So I will say, so listen, I mean, I still think, the Fed should cut rates, and I think they will cut rates. So they push it back a little bit, given the inflation shock, maybe. But gosh, when you go through one of these periods, and I heard Chair Powell talk about it today, when you've got a supply shock and you're pressuring consumers, and you think about the impact that's having on consumers from higher gas prices, higher food prices, the last thing you want to do is raise rates and raise their mortgage as well. So I think you'll see a lower rate threshold, particularly in the front end. The one thing about managing interest rate risk today, you have a very different, we operate in a global framework. You've got the Bank of Australia that's raising rates, the Bank of Japan's raising rates, ECB is going to raise rates, the Bank of England, the Bank of Canada. So you've got to operate within that. I like the front end of the yield curve because the carry is tremendous. I was looking at the break-evens on the front end of the yield curve, not just treasuries, but things like investment grade credit. You'd need rates to back up over 100 basis points to be down money in the front end. Listen, I don't think rates are going higher in the U.S. In fact, I think they will go lower. But in the interim, it's pretty attractive to be in the front end and just manage time along the way and just clip coupon for a bit of time.
I mean, you call what the Fed is currently dealing with, in your words, a textbook dilemma, that you have the supply shock and monetary policy can't really deal with that, while at the same time having good reason in your mind to actually cut rates, whether it's worries about the labor market, and maybe you can say, well, we can justify cutting rates even with these fears about inflation because productivity sort of closes the gap in all of that. Is that correct?
Well, you took the words out of my mouth. I would say, listen, I think productivity will do that. I mean, look at the last 10 months. We've had, if you strip out healthcare, you've had negative job growth, negative of 370,000 jobs. That's not maximum employment. And if you think that you're going to have a near-term pressure on the economy, and we're going to get a payroll report this month, or this week, I should say, gosh, I think payroll is still, I think hiring, and we're still so far from maximum employment. Are you running a bit more elevated core PCE and obviously headline inflation, of course? But gosh, if you said productivity is going to change the dynamic going forward, wage pressure is not going to be significant going forward, and you have what is real pressure on particularly lower middle income, real pressure on small businesses, real pressure on young people. Now, yes, I think you can get the rate down. Listen, if you're in the seat, do you want to fight inflation? And do you articulate you're fighting inflation 100%? But I still think you've got to get that rate down, and I think you'll see an opportunity to do that over the next few months.
But you can't fault them for, in the nearest term, to do what Powell suggested they're in a good position to do when he was speaking this morning, as you already referenced, where he said we're in a good position to wait and see what happens. You just don't know.
I think that is fair. I would err on the side of when you go through this sort of pressure on the system, being accommodative in terms of your direction of travel and willing to provide a foundation underneath the system, the economic system, the financial system. Listen, do I think you could be a bit more accommodative? Personally, I would be a bit more accommodative. Can you fault the Fed for sitting back and waiting for data? No, you can't. But like I say, this is one of those periods where, I think, setting out a series of metrics where you would be more accommodative. I don't think there's any reason not to do that.
So you would still be accommodative. Let's use that word. You'd still cut, even with oil prices where they are and threatening to go higher, and really having no sense as to where this war is truly going and when it will truly end. If you were in the chair today, let's say they had to make a call today, you would err on the side of cutting today.
So I will say I invest based on what they will do, not what I would do. So that is
you just said
one thing I've learned around position.
You said that they could afford to be more accommodative, given even with all the risks out there.
So I would be more accommodative, and if I think you have an opportunity to be more accommodative, and I think more prescriptive about if you saw pressure on the economy, how you would react to that. And quite frankly, I still think today that rate is restrictive, and I think you could at least get it to neutral. But like I say, my sense is that the way they are going to act from here going forward is sit back, evaluate the data, and I think positioning portfolios relative to that makes the most sense. But yes, if it were me, I think you could be a bit more accommodative, less restrictive in where rates are today.
All right. Let me ask you about private credit. I'm wondering how big of a problem, if we can use that word, you think it is. Everybody's opining on it, and the Fed chair was asked about it today, in which he addressed whether he thought it could lead to another financial crisis. This is sort of the context of the question that he was asked at Harvard by a student, in which he said, quote, watching it very carefully, looking for connections to the banking system that could lead to contagion. We don't see that. Doesn't seem to have the making of a broader systemic event. Now, others who have opined that they think it could still get worse seem to be in agreement that worse is not systemic. Where do you come down?
Listen, is there more idiosyncratic risk coming? Are there business models that are challenged that will lead to higher levels of default? Yes, I can see that. It is not. Whenever you go through the calculus and think about it, I remember going through all the crises in the past, and you think about the secondary and tertiary impacts they could have. Private credit today has something that's very distinct in that the amount of, if you break down software lending, and you think about the size, and we've haircutted defaults to 50%, which is probably egregious. And then you look at how much we talking about 150 billion of loss. It's actually not systemic when you've got, quite frankly, you think about what the money that's in money market funds is almost $8 trillion. It's not systemic. And you have a dynamic that is different than other crises I've seen in the past, where generally the funding, the liability stream against these assets tends to be term funded. That is, people underestimate. You go back to banking crisis when you're overnight funded. When you've got a term funding, usually doesn't create systemic pressure. So I don't think it's a systemic issue. But I think, as the chair said, do you have an eye on it in terms of the implications that have the knock-on impact across different sectors? For sure. But no, I don't think it's a systemic problem. I've seen series of issues over time, but this is not one that's systemic.
I'm gonna leave this interview today, Rick, feeling like you, even with everything happening, are reasonably sanguine about the environment that is still there and still will be there despite all of this. So in conclusion, is that a fair way for me to leave this?
Yeah, one of the things that you go through, and I've done this for a number of years, is what happens when you get a shock to the system. What happens is the short end, you spike higher volatility in the front. You see that in the oil curve, you see it in other curves. You spike volatility in the front, and then you look at where you are in the intermediate term, and generally things are well behaved. I think that's one of the dynamics today. What's very uncertain is, the durability of the stress that we're seeing today around, obviously, the war. So you've got to be cautious, because that near-term vol can extend for a few more weeks. But over the intermediate term, I think your characterization of being sanguine, I think is fair. You got an economy that's still, by the way, even if you haircut the economy, you're still talking about today what could be we think will be about 5% nominal GDP. You've shifted some down from real, a bit higher in terms of the inflation side of it. So when you step back and look at the world, it's still in pretty good shape. But in the near term, I think you gotta manage the risk to what's right in front of you today.
All right, we'll leave it there. Always appreciate the time and the conversation. Rick, thanks. We'll see you soon.
Thanks,
Rick
Scott.
Reeder of BlackRock. Let's bring in our panel now to react. Cameron Dawson of New Edge Wealth, Brian Levitt of Invesco. It's great to have you both. I know you were sitting here listening to all of that. What was your take?
Well, I think that Rick's point about the resilience that we're seeing in earnings is a really important one, because all of the weakness that we've seen really starting since November of last year has been driven by multiple compression. The S&P is down 15% in its PE multiple. And in the last month, we've actually seen earnings estimates go up, which is really surprising. And we've been raising the question, is this resilience or is this complacency? And I think you could actually answer it.
Lunacy.
It's probably a little bit of both, because a lot of the upside is coming from semiconductors, but you're seeing so much stability in everything else that just suggests that analysts don't want to be early to cut their forecasts. We do think that if oil prices remain high, though, earnings estimates are far too high, baking in 16% 5% growth, which could be a source of further volatility.
I feel like you've been in the sanguine camp, right? Like trying to hold the line, so to speak. Are you still there?
I am in a sanguine camp over, I think markets are going to be higher over the next year. In the short term, we've got some challenges here. If you look at some of the preferred market bottom indicators, the types of things I look at, have we seen a VIX at 40? No. Have we seen stocks, meaningfully deviate from their 200-day moving average? No. Have we seen credit spreads out a bit, but not significantly? So I think you still have room for volatility here. Anytime you have downside volatility, it's almost always the result of policy uncertainty. It's not like we're getting policy clarity any day. But when you look at, to Rick's point about the forward curve on oil, if you look at 5-year inflation expectations, relatively contained, I think you're still pointing to an environment where we can get back on track. The challenge here is how long does this exist in the short term?
Well,
and the longer you have policy uncertainty, the more pressure on markets.
Well, you talk about the lack of policy clarity,
yeah.
those words you used, and that we're not going to get it in the short term. How do we know that?
I guess we don't.
I'm saying if you could get, theoretically, let's just for the sake of the conversation, say, well, you get a ceasefire,
yeah.
Who knows at any time. We know how this president sort of operates and thinks about the markets.
Yeah.
Now, I think the market behavior over the last week would suggest it's done just listening to words. It wants some more concrete action to hold its arms around. But we could still get a development that could be viewed by this market as, you know what, okay.
That's what makes it so hard. I think the memory of April 9th, 2025 continues to hang over investors, where we backed off on the trade conflict. You were up 9.5% that day, and that was the third best day of the S&P 500 in the last 30 years. Everybody knows what happens if you miss those days. So there's been a challenge in that for investors. You can still get that. I'm not suggesting that you couldn't. A bit of a challenge, though, is it's not as easy right now as walking away from a trade conflict. I suspect the Iranians will have some say in that as well.
This is not a tariff. You can just, wake up in the morning and decide we're not going to do that.
No, we would have to have a reopening of the Strait of Hormuz or some type of plan to reopen the Strait of Hormuz.
Tech.
Yeah.
Can this market get its footing with tech wrecked?
Well,
Because that feels like what it is. I mean, NASDAQ's been down like 10 of 11 days. It's never done 11 in a row. And many of the mega caps, as I was talking with Rick, have corrected. Their multiples have compressed. Some of these other stocks today are just downright ugly. Whether it's some of the chip names, AMD, for example, Micron's down another 10%. So the memory trade has seemingly unwound. CoreWeave is down 10%. Intel, it doesn't move 6% just like that. It's down 6%.
Yeah. At least it's cheaper. That is the good news. This tech is just one multiple turn away from its 2022 low in valuations. The challenge with tech is that people are questioning the earnings stability. You think of a place like software, where people are worried about AI disruption, or you think about semiconductors, which we think this market is actually starting to price in the potential peak of this semiconductor cycle. Because if you look at the multiple compression, they've fallen by a third. PE multiples for semis have fallen by a third, even as you have seen overall earnings estimates absolutely skyrocket higher in an unprecedented way. So tech performing well is important for the market because it's such a big weight, and it's equally important when you're not seeing that kind of growth optimism, which is what we saw over the course of the first couple of months of this year, which is why the market was able to stay resilient even as tech was weaker.
Yes, that's the whole thing. The broadening trade worked because we're still believing in the economic dream. So it didn't matter necessarily that the large group of tech stocks and some software names, a bunch of software names, were down a lot because you had the broadening trade to fall back on. Now I've got growth concerns. I've got a supply shock in the energy market at the same time that tech's rolling.
Yeah, we believed in the economic dream and we believed in Fed rate cuts, and it was all lining up very nicely until this conflict began. I mean, look, the biggest issue everybody had last year, as you know, was valuations in tech and whether this was an AI bubble and what happens if this thing rolls over. And to your point, we've seen some pretty big moves in valuations without a repeat of 2000 through 2002. So, that's a calming effect so far, that we're back at more reasonable valuation. I think some of this is overstated. I mean, the reality is if we're going to, if software's business models are going to be broken, which I think is a big if, that pertains a pretty significant AI build, which pertains a pretty significant demand for semiconductors. So I'm not sure that those stories necessarily make sense together. I would still believe in a more structural story on tech. The challenge you have right now, of course, is a valuation adjustment in a richer part of the market, and you're just not getting the economic impulses for the other parts of the market to behave the way they were in January and February.
Yeah, rising rates haven't helped. That's quite obvious too. Guys, thank you so much for being here, Brian and Cameron. We'll see you soon. We're just getting started here on The Bell. Up next, how private credit just moved one step closer to landing in your 401k. The big money details are after this break. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC. The majors all red. We're back after this.
We're looking for connections to the banking system and things that might, result in contagion. We don't see those right now. What we see is, a correction going on, and certainly there'll be people losing money and things like that. But it doesn't seem to have the makings of a broader systemic event.
As I referenced with Rick Reeder, that was Fed Chair Powell earlier today at Harvard University on the recent wobble in the private credit space. Despite those concerns, today the Trump administration took another step towards opening 401k retirement plans to alternative investments like private credit and private equity. our Leslie Pickard following that for us today. Hi, Les.
Hey, Scott. Yeah, the Department of Labor issuing proposed regulation that aims to, in its words, alleviate certain regulatory burdens and litigation risk for putting private assets into 401ks. Previously, those who manage 401ks have been hesitant to put alternative assets in them because they were worried about getting sued, particularly over the high fees that these types of products command. Of course, the timing of this DOL proposal, as you mentioned, Scott, comes against a broader backdrop of consternation in the private markets. The potential default risk, soaring redemptions, and valuation opacity has rattled the private credit space in recent months. Other alternative asset areas, though, like real estate, infrastructure, have been more tame. Still, the recent noise is likely to make 401k adoption slow, even if the proposal ushers in higher appetite, assuming it is ultimately passed. Scott.
Yeah. You also are getting some insight into some performance in the private equity and or credit space, right?
Yeah, so we're getting performance numbers, and honestly, several funds have posted losses. Are they big losses? No, they're less than 1 percentage point, but it speaks to kind of what is going on in the broader environment where there's concerns about defaults, there's concerns about redemptions. Those all play kind of a role in what you're seeing with regard to performance, which in some cases is the worst in several years for these asset managers. Now, the thing with private credit is, the hallmark of this asset class is essentially not to lose money. So when you do see negative returns, that can sound some alarm bells. Nothing crazy. There's as Fed Chair Powell pointed out, this is not indicative of contagion or major stress in this market, but it is certainly a point that's worth watching.
Yeah, I don't think that the stocks that we were just looking at would be green like they are today
Right.
if the Fed chair himself had a more sort of negative, dour outlook on that space. So you make a good point. Les, thanks as always. Leslie Pickard. Still ahead, stocks. Well, they're negative across the board. NASDAQ is down by more than 1%. Fundstrat's Tom Lee is standing by. We'll get his playbook as we gear up for the second quarter. The bell's right back after this. Stocks are lower as we head towards the close today. Our next guest figured there would be a significant pullback for stocks at some point this year. Obviously didn't know it would be a war to initiate that. The question is, what now? Let's ask FundStrat's Tom Lee. He's also a CNBC contributor back here at Post 9. It's good to see you.
Great to see you,
Just
Scott.
to remind people, you're like, we're going to get off to a good start. I think we're going to have a bear market at some point this year, and then we're going to have a strong rally and finish well. As I mentioned, obviously, you didn't have this on your bingo card. You thought maybe it was going to be issues around a new Fed chair, et cetera.
Yeah.
So with that as the context, what do I do now?
Well, I think markets are in the process of discounting a lot of the bad news because the war isn't quick and there's risk to the oil supply disruption. And I heard a lot of our clients kind of worrying what it means for the economy and for GDP. But I think that means the market now can respond to less bad news. And I think one of the less bad things is it's possible earnings estimates should be going up right now, even with higher oil. It's because of the defense spending. If we're spending $200 billion a month on war, Department of War, that's $2 trillion a year incremental. Every $10 rise in gasoline or oil is $70 billion a year. So even if $30 oil rise is $200 billion, it's more than offset by defense spending. So I think markets should start to sort of front load this discounting and we could start rising.
I think that's the critical thing that people are trying to get their arms around of all this, that the reason why people haven't gotten, en masse negative and the market hasn't looked worse than it's traded, albeit down 5 straight weeks, is believing that the earnings story is going to stay intact and that it's going to remain resilient. But even those who think it's going to remain resilient are pointing to places that are not the defense area and convincing themselves that it's going to hold up. Do you believe that?
Yeah, I mean, we are in a fog of war, so I can't say things definitively, but we do know that after 5 weeks, we can see how markets are letting things outperform, and outperformance is energy, rate sensitive, which is utilities, treasuries, and financials, but it's also large cap tech and crypto. So I think in some ways, the market is betting that growth is going to hold up in the U.S.
Would you buy the market today?
Yeah, I think we're 90 to 95% through the sell-off.
What gives you that confidence?
Well, I think some of it's positioning, and Goldman had a really nice piece about hedge fund positioning.
That's right.
And
certain things that looked up, sorry to interrupt you, just so people have the full context. Their note was basically like, look, we've observed a lot of hedge funds selling, which looked like capitulation activity to us. So maybe that's run its course. So now you can perhaps build that base back up.
Yeah, so I think that's one component. The second is retail sentiment's very negative because the AAII bulls less bears is minus 20. That's a tactical sign. The VIX closed above 30. And now I think earnings season is going to show earnings probably going to hold up better. And then the last piece there is I think we're just going to have to realize that stocks tend to bottom early in a wartime situation. So we've looked at every war since 1900. Stocks will bottom within the first 10% of that war. So if this is a, 2-year war, we're going to bottom pretty early into that process.
So let's hit tech more broadly, because it hasn't traded well and it hasn't really shown any signs that it's finding its legs. Like you had memory names, for example, last week look horrific. And what does Micron do today? Let's show it. Ugly again. There's like it doesn't feel like there's an ability for a stock like that in a group that went straight up and to the right to find any stability there. Mega caps, they haven't looked great at all. And the only thing I can find people saying good about them is, well, look at their multiples now.
Yeah.
They've compressed a lot in the pullback.
Yeah, we're in the fire ready aim phase, right, where any little bad news is going to cause people to de-risk. But as you know, that's why the positioning is something to watch, because at some point people have gotten too neutral and then less bad things can happen and the market has a V-shaped recovery.
If you were inclined to buy, like you say you are, would that be the first place you would look, tech or somewhere else?
Yeah, I'd look at what's been strong already. And to me, because they've already had a rolling bear market, so I would say the Mag 7 should be leading, large cap tech, The semis I know are breaking down, but they've been leaders. I mean, even after this pullback, they're up over 70% year over year. And I think crypto is going to lead as well.
Why so?
Well, crypto is proving to be a good wartime store of value. So I think if people have been over allocated to gold, which is underperformed, and they're looking for stable value, especially high net worth families, I think they're going to allocate towards crypto.
What about financials, which have gotten hammered too? Like, this is another area that I hear people suggest it's going to be hard for the market to do a lot as long as financials remain a question mark.
Yeah, I listened to Fed Chair Powell speak today, and I think private credit has been maybe the thing that's been causing financials to weaken. And if Fed Chair Powell is correct, I mean, the private credit is isolated, and that means financials got too cheap.
Well, I mean, isolate is a relative word. I mean, I think people are worried that it could still get a lot worse than it is now, but there's a difference between that morphing into something systemic, which the chair said, along with many others who are much smarter in this space than me, don't think it is.
Yeah, that's right. Private credit, it's actually pretty big. It's about the same size as high yield, but it's not as widely held as mortgages were and for retail. So this is going to end up being an issue for high net worth families and allocators, but that's different than one causing widespread damage.
All right, Tom, thank you. We'll check in with you again soon, I'm sure of that. Tom Lee. Up next, we track the biggest movers into the close today. Christina Partsinevelos is standing by with that. Hi there.
Hi, Scott. A medical device maker sliding on mixed data for its heart implant, a food distributor tanking on a massive acquisition, and a biotech firm surging on positive trial results. We'll have those stock movers next.
Almost 10 to go before the closing bell. Back to Christina now for the stocks that she is watching. What's at the top of your list?
Well, let's start with shares of Boston Scientific because they're falling quite a bit, about 9% right now after Raymond James downgraded to outperform from strong buy, but they lowered the price target for the company too. The biotech firm also posted mixed data for its Watchman heart implant. The data showed the implant actually worked better than blood thinners, but more users suffered a certain type of stroke compared to those who use blood thinners, so that's definitely not good news. Switching gears, Cisco tumbling also 14% after it agreed to buy Jetro Restaurant Depot for a total enterprise value of about $29.1 billion. The deal is expected to close in Cisco's 2027 fiscal third quarter, but investors seem to be focused on the debt associated with the deal, and that's why shares are now even dropping to 15% lower. United Therapeutics moving in the opposite direction. One on a positive note, 12.5% after reporting positive phase 3 clinical trial results for its lung blood pressure medication, Tyvaso. The biotech company says it's seeking a priority review from the FDA to expand the drug's label to treat lung scarring disease, idiopathic pulmonary fibrosis. Say that 5 times. Got it.
All right, Christina, thank you. Christina Partsinevelos. Coming up next, cyber stocks on the rise today after a very ugly end to last week. We'll tell you what has led to that bounce today in the market zone, which is next. Closing Bell Market Zone, Mike Santoli and Empower's Marta Norton are here to break down these crucial moments of the trading day. Plus, Seema Modi is tracking the bounce in cyber stocks. Christina Partsinevelos has more on what's behind the ongoing drop, and big one at that in those memory chip names that we showed you a little bit earlier. We'll get to that in a second. Michael, you first. Your observations on this market day are what?
Yeah, I mean, part of the process of a correction is essentially having hope drain away and maybe punishing the early dip buyers. We got a lot of that today. Obviously, there was a rally attempt, or a couple of them, based on, the president's post, maybe some kind of dangled hope for some kind of a ceasefire or progress on negotiations. The oil market just did not give clearance for that, right? That seems to be the lesson. As we talked about it around noon, Scott, yields down is a good thing, except if it's a growth scare, and if oil is going to make new highs, kind of keeping markets in that trap. Very messy sell-off you've been talking about in some of the former leaders. Again, that's also part of the process, right? Trying to purge the areas that seem safe. But there's a lot of breakdowns in this market now, too, and the trends have taken on some damage. I do mention Friday, we have these uncomfortable similarities to how things went in 2025 into the end of March, and then you had the final spill lower in early April. Not saying it has to match up, but sometimes it's a gradually then suddenly type situation in these prolonged sell-offs.
You've got about 5 minutes or so before overtime begins. How are you going to tackle what's been taking place in this market?
Well, in part, we're going to, we got a couple of portfolio managers who are going to tell us if they're sifting among the wreckage and what they're buying. It includes Steph Link and some very popular names that they're saying look like they're discounted enough to have a good risk reward.
Wow, I mean, Steph, she's been gutsy. She has
Trying, yeah.
at times of market upset, so we'll see what she has to say. We look forward to that, Michael. Thank you. It's Mike Santoli. Don't forget overtime. Top of the hour. Seema, tell us more about cyber.
Well, Scott, the sell-off last week was notable, right? Investors today seem to be returning to this idea that security spend will remain one of the core backbones of IT budgets. And that was a point reiterated by Wolf analyst Josh Tilton, who says AI disruption or not, spending on cybersecurity budgets continues to expand, even with AI coming. They're upgrading CrowdStrike to buy $450 price target, also boosting sentiment. CEO Nikesh Arora buying $10 million of Palo Alto stock. In a blog post published today, Arora calling on OpenAI and Anthropic to be more responsible with the new models they release and partner with the cybersecurity incumbents as attacks become more sophisticated. Stocks across cyber off the highs of the day, but are higher. You'll see Palo Alto up about 5%. Cybersecurity giant CrowdStrike, SentinelOne also higher, Scott.
All right, Seema, thank you very much for that. All right, Christina, I mean, Tom and I were talking earlier about what's happened to these names. The question's why.
Yeah, the question's why. You talk about the continuous sell-off in memory, with most of last week's sell-off largely pinned on Google's TurboQuant, which is a way to compress AI models so they need less memory. But that fear, Scott, really looks overblown today. What's really driving the move is crowded positioning unwinding, momentum trades just getting flushed as risk comes off, and then stocks really digesting what some on the street are seeing as peak earnings, a continuous problem with Micron. You also have growing concerns about a pullback in OpenAI's spending today, feeding into the broader worries about AI CapEx pacing. The memory demand story, though, seems to still hold up. RBC, for example, many analysts say their supply chain checks in Asia showed no slowdown in AI data center component demand, including memory, with tight supply extending visibility through the year, which means maybe fundamentals are still intact. Scott?
All right, Christina, thanks for that. All right, Marta, we got less than 3 to go before this bell is going to ring. We're going to fight it out for the Dow at least to finish green. What's your take here?
Well, I mean, what we've seen since the conflict began has been, at least in equity markets, this kind of incremental leakage as we grapple with the duration and the extent of the damage. And now I think over the past few days, markets have come around to the idea that there really is potentially a worst case scenario out there. Of course, none of us really know if that's the case, but we have to grapple with it nonetheless.
So it sounds like you're just going to be cautious and wait before you decide to buy any of these dips in any of the areas of the market?
I mean, I think we're kind of threading the needle here, because I don't know if we're necessarily on the page that the economic damage will be as bad as others think. But we came into this period with pretty high valuations, and that's something that we have to take into account.
Which part of the market are you watching more closely than any other?
Well, I will tell you that we do see opportunities actually related to the AI scare earlier in the year. So members of the Mag 7, some of these software names, we think those are actually deep value names that could be long-term drivers of performance. But other than that, it's been a pretty kind of chromatic market in terms of where valuations are. You are seeing financials come off, but I think we do want to see this step down a bit more before we start to think this is interesting.
Are financials, are they making you nervous as they trade as they have?
Well, a little bit. I mean, when you struggle with what's going on with private credit and the software scare and what that could mean in terms of the underlying quality and then liquidity, I don't think you want to be dismissive of those concerns. But you're also starting to see prices respond to that.
It feels really that we have a show me market. Don't tell me and talk to me.
Yeah.
Show me what the results of any talks are or any other developments about the Strait and oil.
I think people are looking through the Truth Social comments at this point and trying to get a sense for what the actual on-the-ground conditions are.
Yeah, it certainly feels that way. I appreciate you being with us, Martha. Thank you. That's Martha Norton of Empower. Again, all right, so we're going to ring the bell here in the next couple of seconds, and the Dow right now is green. Can it hold that for those seconds? We will see. 45,204 and change is where the Dow Jones Industrial Average currently is. It's been hard for tech to get anything going. Again, those memory names that Christina was talking about, some of the other chip stocks, the mega caps haven't had a lot of confidence behind them either. You add it all up, that's the kind of market we're in. Dow green, everything else red. I'll see you tomorrow into overtime.
The bell's bringing an end to the trading day at the NYSE. Copper's holdings, not the NASDAQ. It is BlackRock in honor of a new Ethereum ETF. Welcome to Closing Bell Overtime. We're live from Studio B at the NASDAQ market site. I'm Melissa Lee along with Mike Santoli. Stocks mostly lower today as President Trump tries to ease concerns about the Iran war, and Jay Powell eases concerns about a Fed rate hike. Much more in the market straight ahead.
Our markets team is all over today's action. Christina Partsinevelos on the market movers. Pippa Stevens on oil as it settles above $100 a barrel. Eamon Javers has more on those comments from the president. Plus, Eunice Yoon live from China this hour on the potential ripple effect of soaring oil prices. So, Melissa, I guess marginally oversold conditions have not been enough, and so everybody looks at the tape and says you need more extremes. You have to have a little more damage done, a little more indiscriminate selling. Day like today will get you there, kind of, but it's interesting because rally attempts get knocked down, and we can't really embrace lower Treasury yields. So it's still kind of uncertain footing.
Yeah, and the volume has been light, which has been the trend, but the action has been, for the past 3 sessions, not good. We sort of closed towards the lows of the session on light volume, sort of listless, but again, to your point, not able to lift itself up. And we did see some massive flip-flops within the day within semiconductors, for instance. If you took a look at Seagate at the beginning of the session, it was up as much as 5%, finishing the day lower by 5%. Yeah. I mean, that is quite a reversal.
Yeah, I mean, I think you can squint and say, hey, look, the alternative asset managers were up and banks were flat, and maybe that means that the things that got hit earliest are getting some relief, and that, again, is the process rolling forward in terms of this correction. On the other hand, it could just be kind of mechanical reshuffling around.
But the bond market move, I mean, in terms of yields finally, responding to the idea that there could be a slowdown, that was an interesting sort of change in the pace of the...
Pretty dramatic on the charts if you could look from like midday Friday. Really sharp decline.
Exactly.
Yields, absolutely. Well, let's get to Christina Partsinevelos now as those once hot AI-related names continue to sell off, Christina.
Well, we're getting closing out one of the biggest unwind days of the year when investors really dump the stocks that have been running the hottest. Those fast-moving momentum names, that's why we have the momentum ETF up right here, are seeing some of their worst moves in quite a while. These are companies that tend to swing with the markets. And you talked about the unwind. Perfect example you can see later on in the day. Really, it's selling off optical stocks like Lumentum, Macam, Coherent, all down more than 6% across the board. Cloud-related names, memory chip names are all or were under very heavy pressure today. In fact, the 5 worst performers in the NASDAQ 100 are all memory stocks. Micron, Western Digital, also storage names too, Marvell, Seagate, and Lam Research. But the drop is more about just too many people being piled into these same trades and not necessarily about Google's TurboQuant story from just last week, which at this point many are saying just is overblown. On the upside, software stocks outperforming the semiconductors today. The SMH is already, though, down about 11%, almost 11% this month. Cybersecurity, though, software names, those climbed higher. CrowdStrike, Palo Alto, boosted by Palo Alto's after its CEO specifically bought $10 million worth of stock just last Friday, but he had a post today, so that added to the momentum. And in the broader market, financials were the best performing sector today, but it's really the insurance
insurance companies that led the way. Like you can see Arthur J. Gallagher, 4%, Marsh, et cetera, all these names higher. Guys?
Christina, thanks. Christina Partsinevelos. WTI and Brent continuing to rise today with U.S. crude selling above $100 a barrel for the first time since 2022. Let's bring in Pippa Stevens for the very latest. Pippa.
Hey, Melissa. The Brent May contract rolls tomorrow with the more actively traded June contract right around 108 right now, with WTI at 103. And the spread between the two Atlantic basin cargoes is starting to narrow as European and Asian refiners look to make up for the lost Middle East barrels. Kepler expects U.S. April exports to Asia to hit records, more than doubling typical levels. WTI cargoes into Rotterdam also moving to historically high premiums as Asian demand pulls barrels away from Europe, leading Morgan Stanley to say the Atlantic basin is no longer a buffer. It's now the marginal source of relief and is being repriced accordingly. Meantime, keep an eye on aluminum, rising after Iran targeted the two largest single-site smelters in the Middle East. Emirates Global Aluminum saying its site in Abu Dhabi sustained, quote, significant damage, with Aluminum Bahrain also hit. Together, the two facilities produce about 4% of global supply. Aluminum stocks, including Alcoa and Century Aluminum, seeing big gains today, but JP Morgan saying the metal could quickly run towards $4,000 per metric ton or even higher before a demand-driven unwind. Mike?
Pippa, thank you. Well, we're getting some fresh comments from New York Fed President John Williams. Steve Leisman has the details. Hi, Steve.
Hey, Mike, yeah, he's talking about the conflict in the Middle East, saying he sees substantial risk and high uncertainty in the economic outlook from especially those events. He says the Middle East conflict could result in a large supply shock, and you guys were just talking about this, raising inflation on the one hand and dampening economic activity on the other, putting the Fed in a particularly difficult position. He has said he's already seeing supply chain disruptions in energy and energy-related goods. Tariffs and high energy prices should raise headline inflation in the short term, but he's a little more optimistic, says the effects of both the energy price increases and tariffs should reverse, and that, of course, assumes that prices come down and hostilities end. It's a big part of his forecast that all this happens after hostilities cease. No sign on the good side on inflation, no sign that tariff increases are spilling over to the rest of the economy, and also adds that the labor market is not adding to inflationary pressures that are out there. Overall, he sees a resilient economy, GDP close to 2.5% this year, tailwinds from fiscal policy, favorable financial conditions, along with AI investment. He expects unemployment to edge down and inflation at 2 3/4 this year.